one board, one committee structure is relatively new, was just introduced from May 1st of 2015, and must have the board of directors and the one committee, that is the supervising committee. And the majority of the supervising committee members must be outside directors. This structure has become popular in the past 6 years. Today, 30% or 1,100 firms out of 3,600 adopt this structure. You might ask why. Well, I must say that even for the firms that are not one board, three committee companies, the corporate governance code encourages setting up of the compensation committee and nomination committee by election. And indeed, most firms today do this voluntarily, so that the differences in three structures are smaller than one might think. Now, the third point on defense, takeover defense. In Japan, shareholder activism and hostile takeover attempts continue to be popular today. The most popular defense plan in Japan is a unique one indeed. It is called the Advance Warning Plan. Today, about 280 listed firms adopt this defense plan. And recently, triggering of this advance warning plan is often litigated before the court. It's like the US poison pill structure. The company attempt to issue the poison pill and people go to court. For instance, Nagoya High Court permitted triggering in Nippo Sangyo case on April 22nd this year, while Tokyo High Court enjoined triggering this in Japan Asia Group case on April 23rd. The issue indeed is a legal issue under the Companies Act, and the courts play a very important role in this area in Japan. We were not quite sure what will happen in the future. Again, you might ask why. But I have to move to the final topic. That is, I would like to say a few words on so-called listed subsidiaries in Japan. In Japan, unlike in other Asian jurisdictions, it is rare that families or the state have the controlling stake in listed companies. But parent companies sometimes list their subsidiaries. So as of 2018, for example, the number of listed companies having a controlling shareholder is 628 out of 3,600, and that is 17%. The number of listed companies having a listed parent company is 311, that is 8.5%. In Western jurisdictions, the numbers of listed companies whose parent is also listed are in the US 0.5%, in the UK 0%, in France 2.2%, in Germany 2.1%. So in Japan, indeed, various rules have been and will be introduced by the Tokyo Stock Exchange and the Corporate Governance Code to discourage double listing or listed subsidiaries, in particular where their parents is listed as well. Well, why discourage them may be an interesting academic question. I will stop here, and thank you very much, and over back to you, Curtis.
Okay, thank you very much, Hideki. You really brought us up to speed very quickly on a lot of recent developments in Japan. We want to definitely come back and drill down into some of these. So next, I'll turn it over to Konse Kim for an update on Korea.
Okay. Can you see the slides now?
No.
No. Now? Is it?
Yes, perfect.
Okay, yeah. First of all, I'd like to thank the organizers for giving me this wonderful opportunity to participate in this panel on Asia. I have prepared some slides for today, so I will proceed according to the slides. Let me start with a few words about ownership structure. As you may know, big business firms in Korea, commonly referred to as chaebol, are under the tight control of controlling minority shareholders. I found no evidence showing any significant change in this existing ownership structure. The only change that is worth mentioning here is a sudden growth of retail investors in 2020. The total number of investors in the stock market increased by almost 50% in just 1 year. But other features of ownership structure remain largely the same. Let me move on to the general political environment and recent corporate governance reforms. Since 2017, Korea has been under a reformist government that is the most pro-labor and anti-big business in our modern history. Controlling almost a 2/3 majority in the National Assembly, the ruling party is capable of passing any reform bill they want. So far, however, the current regime has been lukewarm in pushing for serious corporate governance reform. To be fair, it did bring in some changes. They include, for example, introducing multiple derivative suits, requiring a large listed firm to have at least one female director, and requiring a large listed firm to make ESG disclosure from 2025. The regime, however, shows little interest in any radical reform that may significantly undermine ultimate control of the existing controlling shareholder. I think this lenient attitude toward chaebol is partly due to their lack of confidence in an alternative corporate governance structure replacing the chaebol system. In corporate governance area, Korea's legal and regulatory environment remain largely unchanged. In our corporate community, however, we do have some significant developments. Let me briefly mention just two of them. First of all, the meteoric rise of IT and biotech firms in recent years. 3 of these new technology firms now occupy the top 10 list of the listed firms, replacing more established chaebol firms. These firms are all relatively young and still run by founding entrepreneurs. It is still too early to tell whether this new breed of controlling shareholders will behave differently than their chaebol counterparts, particularly in relation to tunneling through related party transactions, and more importantly, business succession. The second development I want to mention is the growing difficulty of leaving the family business to the next generation. The most well-known example illustrating this difficulty is the case of Mr. Lee of Samsung Group, who is now in jail for the second time. This difficulty of keeping family control is primarily due to changes in law and culture. Our inheritance tax rates are high, and our succession law is egalitarian, prescribing the equal distribution of the estate among the siblings. Culture has changed as well. Parents are now far more egalitarian in dealing with their kids, and kids are now less hesitant to go to court if they think they were discriminated against. These changed circumstances will not lead to the disintegration of chaebol overnight, but may eventually make our ownership structure more dispersed. And let me finish this short presentation with a few words about the prospect of corporate governance reform. I believe we are unlikely to have any significant reform in near future at least. My prediction is largely due to the shrinking interest on the part of the general public, as well as the ruling elite in corporate governance matters. The decline of interest is again due to more pressing matters, such as deepening political division, COVID-19, economic inequality, and rising youth unemployment. Thank you very much.
Okay, thank you very much, Konsip. Again, very succinct overview of what's been happening, and you've given us much food for thought to drill into later in the discussion. So next, on to Angela. Yesterday's session on the role of the corporation society ended with a very interesting discussion about private ownership in China and its impact. The impact of recent developments on entrepreneurship in China. And so I'll turn it over to Angela to talk to us about what's been happening in China and the prospect for private ownership in China. Angela.
Hi, thanks, Curtis. And it was a great pleasure for me to join today's session and speak with a distinguished panel of scholars. And I have also prepared some slides. So my 5 minutes talk will focus on a very interesting, I actually think it's a very important development in China about state events and private retreat. And so this is actually based on a paper I'm working on with a colleague of mine, Liu Zhuang, and which we found that since 2017, there is a significant surge of equity transfer from private companies to state-owned firms. So this trend seems to be reversing a longstanding trend of that more and more state-owned firms were selling their shares to private firms, but all of a sudden, since 2017, we see this huge surge. For instance, in 2019, over 100 publicly listed private firms transfer over 5% of their equity to state-owned firms, and that lead to a worrying trend in China, because as you see recently, it appears that the government is exerting greater control over the private sector. And with all sorts of signs that you're seeing recently, like President Xi personally intervene into Ant Group's initial public offering. So Ant is the largest fintech company, and it was about to launch the biggest IPO in history, but it was the IPO was suspended just 48 hours before the launch. And there is now also an ongoing and sweeping law enforcement campaign against Chinese big tech, with companies like Alibaba, Meituan, Tencent. All of them have been subject to this massive campaign. And there have been ongoing calls on the Chinese firms, particularly not only the state-owned firms, but also the private firms, to adhere to the party's demand and to form a united front in this tough geopolitical environment. And also, and there are also more calls on installing, enhancing party buildings within private firms to have the party to play a bigger institutional role in governing private firms. So it seems like this new ownership change phenomenon is also, kind of echoing this trend of state events and private retreat. Now, what we found actually when we look closer at the data and do more analysis, what we found is actually it has less to do with the party's ideological grip on the private ownership, but more to do with some earlier reform initiatives that Xi's government promoted back during the early years of his tenure. So around 2012 to 2014, the Chinese government, particularly the financial regulator, they promulgated a series of liberalization reforms, and making it easier to make acquisitions in China, and also make it easier for private firms to obtain financing. Okay, and one of this measure was the equity pledge program, which allows the shareholders of private firms to pledge the stock to the securities brokerage companies. And you see here, since 2013, there is also a significant surge of private pledge in terms of and our data shows that by the end of 2018, there are 500 public listed private firms that pledge over 90% of their shares to the securities firms. Now, and you all know in 2015 there was an epic stock market crash, and that was what I saw this like kind of one of the major turning point in China's economic policy, because it was really since 2015 you saw this stock market crash caused the Chinese government to dial back many of the liberal economic reform initiatives. And it was since then the government started a massive deleveraging campaign, and which makes it very difficult for private firms to obtain financing. So in 2018, when there was another crash again, a lot of the private firms, particularly the large shareholders, private firms that have pledged a lot of their shares, were unable to obtain financing, and as a result, they cannot meet the margin calls. And that was the reason why a lot of these firms went bankrupt. And it was at that point the government intervened and called on the state-owned firms to bail out these private companies, and that's why we saw as this recent phenomenon of selling out private ownerships to state-owned firms. So it appears to me that this recent phenomenon of state advance and private retreat is actually seems to originate from a well-intentioned liberal market reform. But because of the pendulum swing in the Chinese government's financial policy, it actually lead to kind of unintended consequences of regressing this well-intentioned market reform. So, and that kind of refutes both the strengths and the weakness in the Chinese government's model. I mean, the Chinese government can react very quickly, can be very adaptable, but at the same time, this agility and it also becomes an inherent instability in the Chinese governance. And that's it.
Okay, thank you very much, Angela. And we obviously want to come back to the implications of what you've just reported out to us for entrepreneurship in China. That was a topic certainly that came up yesterday as well. So thank you for that. And our last presenter, over to you, Panna, for update on what's happening in Southeast Asia.
Hi, hello everyone. It's a great pleasure to be here today. Can you see my slide?
Yes.
Yeah. Okay. All right. Okay. So I don't know how much you know about Southeast Asia. So maybe I would like to start by introduce you some key figures so that you understand about this region. So Southeast Asia has many countries, so and with population about 600 million, and it's very diverse in many sense. A few things that I would like to highlight in terms of population. Indonesia is the largest one with 270 million, and what interesting about it is that it's full of young people with the median age of under 30 years old. And the smallest country is Singapore, tiny with about less than 6 million people. And now if you're looking at the GDP per capita, again, interesting. Singapore is an outlier where the GDP per capita close to 60,000. And other countries is very low, like the Philippines and Vietnam, just over 3,000 US dollars. Now, in terms of stock market, the size is very small, and you could look at the number of listed firms are really under 1,000, and only 3 countries that have market cap more than GDP. So any research, if we cover only listed firms, we only cover a really tiny part of the economy, or even any regulation that come in and hit listed firm is only tiny, right? Another interesting point that I should highlight is about the corruption in the region, and I'm going to use this the corruption index, the corruption perception index, Again, Singapore is ranked in the top 3 least corrupt, along with Scandinavian countries and Switzerland. And other countries, with the exception of Malaysia, rank much lower and seem to be getting worse. For example, my country, Thailand, the score has been worsening since 2015 after the military regime has been taking control over the country. Even Toyota Motors recently informed the US SEC of possible anti-bribery violations of the FCPA in Thailand. Now, in fact, if you look at the corruption level of Thailand, Indonesia, Philippines, and Vietnam, it's far worse than India, Brazil, and Colombia. And it's shocking, actually, when you look at these data. Now, if you are entrepreneurs, how would you operate in these countries with, institution problems? Yeah, smart entrepreneurs would first build political connections, right? And then you set up a lot of friends, a lot of networks. Yeah, this way you can acquire information, you can acquire favors. And then business owner would set up business groups, right? And create internal market to solve all these problems. Now, now let's look, we are trying to guess how big, how powerful these rich families are. So let's use recent Forbes estimation of the wealth of the top 50 richest. Yeah, and I think, in my opinion, the Forbes estimation is based on public information, in particular shareholdings of listed firms. So their wealth and the extent of their corporate control are likely to be underestimated. Anyway, but this gives us some sense of it. If you look at the figures, the top 50 families control their wealth related to GDP, and it is about 12% in Indonesia and Philippines, and in Malaysia it's about 16%, in Thailand 20%, and Singapore is 44%. And I think maybe Singapore represents more real figures because the country is, more transparent. It's easier to estimate the wealth, and really shocking to see that top 50 families controls about 44% of the country GDP. Okay, all right. Now, I would like to, look into this and highlight a few points here of what these people are doing. And first, on the countries, I don't have enough space, so I'm gonna put the information on Thailand, Philippines, and Indonesia here. And if you look at them, most of the super rich are either old money, who inherit the money from their father or grandfather, or old founders. And the fact that these big bosses are aging also raising concern about succession problems coming up soon. Now, the second point, these families are still making money from traditional businesses. For example, agribusiness, rice, corn, rubber, palm oil, coconuts. Several became successful from gaining access to regulated industry like banking, oil and gas, coal mines, media, and telecoms. And a few of them made their money from real estate, food, and retail like 7-Eleven chain and shopping malls. Yeah, and another point, there are only very few, actually a couple of founders that are under 60. I'm trying to see whether any startup managed to become, part of the super rich. And I don't know with, I use the 60 years old cutoff because I think maybe let's consider them as young people, and you only see a couple of them. And interestingly, when you look at what, the business that they have been working and making money from, it's actually like Thailand selling energy drink. And one green energy is pretty good, and Indonesia has one on the, digital banking. Now, in summary, we have not really seen the disruption by tech startups in Southeast Asia, and the number of unicorns that come up basically came from Indonesia and a little bit from Singapore. And why is that? Maybe we saw. Maybe Indonesia have huge markets in terms of size, full of young folks, and they have internet access, or perhaps because people live in 17,000 islands, and Indonesia have the landscape that might, offer some pain points for startups to solve. And in Singapore, clearly Temasek, the sovereign fund, stand out as a controlling shareholder in major companies. And in Vietnam, business group controlled by entrepreneurs have slowly emerged to challenge state-owned enterprises. Okay, I think I will stop here. Thank you.
Okay, thank you very much, Ipana. Again, a lot for us to talk about. Now, the challenge here for me as moderator is that we could spend the rest of our time on any one of these countries. But what I'd like to do is to identify some potential disruptors across the region. And of course, some of our speakers have alluded to these, but I'd like to drill down a little bit more deeply into some of them. And the first is shareholder activism. Obviously, there have been some high-profile incidents of shareholder activism. Currently, there's one ongoing in Japan, of course. Korea has also had some high-profile episodes of shareholder activism. So I'd like to ask our panelists to talk about the potential, what's been happening with shareholder activism in your country or region, and what do you see as the potential for shareholder activism, either domestic or foreign, in disrupting prevailing corporate ownership patterns and corporate governance patterns. So any of our panelists like to lead us off? Hideki, please.
Thank you very much. First, I would like to say that in Japan, ownership is pretty much diverse, generally speaking, if you compare it with other countries in Asia, perhaps in Europe as well, so that the ownership structure in Japan remains to be somewhere in between the US, UK on one hand and other jurisdictions on the other. Having said that, in Japan, activism is very popular today, both by institutions and other shareholders. And there are a couple of reasons for that, I think, but one of the reasons is that the shareholder rights under the Companies Act in Japan are strong, and therefore certain shareholders take advantage of this to make money. They are very, sometimes very successful. For instance, a recent case of Toshiba, the activist shareholder successfully called a shareholder meeting and appointed an investigator, and the investigators just investigating a couple of things with Toshiba and just published a report 2-3 days ago. Once again, this shareholder activist purpose, I believe, is to make money by doing something on exercising shareholder rights. One more point is that those activists do not intend to take control sometimes. They just want to make profits by being active. That's the current situation in Japan, but the activism is very popular today. Thank you.
Okay, thank you very much. Konsik, maybe would you like to say a few words about the situation in Korea? You're muted, Konsik.
My internet connection is very weak, so sometimes I miss the words, but I will try. There were a couple of instances of shareholder activism even before the pandemic, but not so many. And these activists, shareholder activists, were not trying to say in any way affect the existing ownership structure. And there was one instance where interestingly, a domestic fund tries to take control of a Korean Air, and it went on for some years. But recently, the Korean bank related to the government sided with the existing controlling shareholder, so they failed. It hasn't ended the dispute, but now, because of this pandemic, there is not much going on in the field of shareholder activism in Korea. Thank you.
Okay, thank you. Angela, obviously the situation is quite different in China, but please share your thoughts with us.
Yeah, actually shareholder activism is not common in China, and it's because the ownership structure is highly concentrated in Chinese publicly listed companies. And there's an enormous presence of retail investors in China. Around 2016, there were a number of notable activist campaigns. But so far, we see the Chinese institutional investors generally adopt a less confrontational and defensive approach. And also, as we just mentioned, the stock market crash in 2015 really is a milestone. And also the fact the shareholder activism, because after that, the government trying to tighten regulations and make it more difficult for some of the insurance companies to invest and make these acquisitions. And so some of the high-level executives at those activist institutional investors firm were put in jail. And then so we've seen less activities since 2017, around that time. And last year, there was one notable example of shareholder activism that when the institutional investors successfully blocked the plan of a major vaccines producer to transfer shareholding in its major subsidiaries, but that's basically it.
Okay, thank you very much. Yupana, anything of interest happening in Southeast Asia in terms of activism?
I don't have much to say because similar to what Angela talked about, ownership is concentrated, right? Using pyramidal structure to know where anybody could attack these families. Plus, they also have very strong political connection, and the government will come and help rescue them. And I don't see any interesting cases to talk. Maybe Dan can help later on.
Okay, thank you. And I see I am getting some questions in the chat and people have their hands raised. We'll turn to audience Q&A in just a minute. I see Wuchan and Jeff, and I have some questions in the chat as well. One other question I'd like to ask the panelists before we move to open Q&A, and that is, it was referenced most extensively by Yupana, but also Consik, and that is the startup ecosystem across Asia. To what extent are new firms and new firm formation disrupting traditional firms and traditional corporate governance structures? We heard Yupana quite extensively, but I'd like to hear from the others. And in particular, also for Angela, question is, what is the impact of what you've reported to us about, increasing state control or influence over private firms on entrepreneurship? How is that affecting the environment for entrepreneurship in China? So maybe I'll start with you, Angela. Could you say a few words about that?
Yeah, I mean, the Chinese regulatory environment was very, very supportive for startups. You may recall back in 2015, the Chinese State Council promulgated this Internet Plus initiative, which strongly pushed forward innovation and entrepreneurship. And over the past 5 years, we saw the Chinese government adopted a series of favorable policy for startup. There was stimulus package for venture capitalists, startups, and generous tax rebates. And even earlier this year, the central bank, the PBOC, announced favorable financing policies for small entrepreneurs and the startup companies. And also on the capital market side, the Shanghai Stock Exchange set up a STAR board, means the Science and Technology Innovation Board, that is kind of one model after NASDAQ. And this board focused on serving innovative growth companies, and it aimed to become an attractive venue for Chinese startup companies to get listed in China. And Ant Group was supposed to be the superstar that will be listed on the star board, and that was one of the reasons that IPO was expedited, because usually it would take more than 7 months to get IPO approval, but Ant only got 2 months, and got its IPO approved. But all this regulatory policies and the favorable environment seems to shift overnight since the debacle of Ant Group's IPO. And you saw from the really top leadership send out very clear signal that we should go ahead and rein in these tech companies because the oversized influence of these companies in our daily life and the possession of troves of data and I think fundamentally the whole debacle really originated from the Ant problem, and then being concerned about this kind of fintech business impact on the financial stability in China. And I do share with the government's concern. I think some of the concerns are perfectly legitimate, but the problem is this very dramatic and sudden pendulum swing, similar to what I just talked about this in the securities market. Now you see this similar dramatic reversal of regulatory environment for Chinese startups does cause huge panic among private investors, foreign investors, as well as Chinese entrepreneurs. And you saw the exit of a number of prominent Chinese entrepreneurs from the leadership role in their company, like from Pinduoduo, a Chinese e-commerce giant, and another Meituan's ByteDance CEO Zhang Yiming also stepped down, right? I mean, so all these are not very, well, I have to fair to say, this is not a very happy time for Chinese tech companies. But as to how much it will really affect entrepreneurship in China, I don't think it will fundamentally cause too much damage to the entrepreneurship, because so far the regulatory environment is still aimed at the biggest firms. So supposedly it will create, I mean, you know, if this goes well and the government's intention is all benign, this should create more room for the growth of smaller companies, because it gives them the opportunity to grow outside of the ecosystem of Alibaba and Tencent. So to some extent, this dramatic reversal do facilitate the growth of some of the entrepreneurship. We might even see more innovation in China. But at the same time, this dramatic reversal does also cause inherent instability in the system, and that do compromise investor confidence.
Okay, thank you very much for that. Hideki, can I ask you to say a few words about the startup ecosystem in Japan, both in terms of the policy and also what's actually happening on the ground?
Yeah. No, thank you very much. And indeed, the startups in Japan have been growing, and the number of IPOs have been increasing. But the speed is rather modest or slow, and it's not disruptive. On the regulatory side, sometime very soon, by the way, by the end of this month, the Financial Services Agency, which is the regulator in securities regulation in Japan, is expected to make an announcement that the securities regulation in this area will be relaxed to encourage startups, like Regulation D and the related rules in the United States. However, in my mind, this may not be the sufficient condition, and more generally, the question of equity finance in public market versus private market is or continues to be the key and puzzling question. We really need academic research in this area. Thank you.
Okay, thank you. Konsik, anything that you'd like to add to what you stated earlier with respect to Korea's environment for startups?
Thank you. I mean, the government, I mean, as I've told you, government has been saying that they are not saying, but they are regarded as being anti-big business, but they are saying that they are pro startups. So they are trying to be, adopting favorable policies toward the startups. I mean, for example, they are they have not yet succeeded, but they have been talking about introducing this dual class voting shares for the startup companies. But I mean, the question is whether or not these entrepreneurs, new breed of entrepreneurs, will act differently than the tribal owners. It's too early to tell, and also it may be dangerous to generalize these people because they are different. I mean, they are individuals. So there is some sign that I mean, some of the controlling shareholders are not as attached as tribal owners to share ownership, I mean, ownership control. But who knows? I mean, it's still too early to tell.
Okay, thank you. Yupana, anything further you'd like to add on this point? You're muted.
Okay, just would like to add a bit about Singapore. I think Singapore has a very nice ecosystem for startup, make the best in the region, and a lot of government is supportive. Very easy to set up a company. If you go to Thailand, it will take you with tons of documentation to open up a company. It will take you a couple of weeks. You know, in Singapore, a piece of cake, right? And there's lots of VC, a lot of money. Even SoftBank, Japanese, or whoever are in Singapore. So it's very easy to raise funding. You just need to have good ideas. And then again, like what I agree with what Kongseck talking about, but to rise big enough to challenge the big businesses is a long way to go.
Okay. Thank you. Let's go to, I'm getting a number of questions now, so let's go to audience Q&A, roughly in the order in which I've received the questions. Let me go to Jeff, then Wuchan, and then we'll go to a couple of questions in the chat, and I'm going to ask those questioners to ask their questions live if possible. So Jeff, over to you.
Right. So this is really a question for Angela. So, I mean, the way you've explained it, in effect, there was a margin call in 2015 that the state provided a bailout. And so the question is whether the shares have gone to the SOEs because of the sale of the securities firms who found themselves undersecured when the margin call was made, whether they're sales by private shareholders, the small owners, or whether the firms themselves have sold shares to the SOEs. Because it seems to me, in answering that question, one could get at whether, in fact, the greater role of SOEs is in fact because of the government's asserting control over these firms, or in effect is a form of a bailout, as your initial story suggested. So I'm curious as to whether there's data on that.
Right. I mean, we don't have the very clear data on the because the pledge comes from the shareholders, right? I mean, so what we can observe from the data, we can only see the stock transfer from the firm to the state-owned firm, so what we also need to rely on some qualitative evidence, which are the reportings and analysis from analysts that it was the Chinese government that have been pushing, and including the Chinese state asset regulator, that have been pushing the state-owned firms to bail out these companies. And so, and that was the point where we saw this transfer. But you make a very good observation here that we need more data to support the analysis.
But let me just follow up, because if the SOEs got shares directly from the issuers, then that seems to me a little inconsistent with the story, in effect, the bailout story, the margin loan bailout story, because those are debts either by the securities firms which had lent money to the shareholders or perhaps the shareholders themselves. But there's no reason why the issuer of those shares should have been affected by the debt overhang of the securities firms or the shareholders who had borrowed money against shares which then declined in value. So isn't this rather, I guess what I'm pushing towards, doesn't your data suggest more of a government takeover story for its objectives in state direction of the economy rather than, in effect, a bailout of financially embarrassed parties within the financial system for financial stability goals?
Right. I mean, you can perfectly make that interpretation as well, because you can say the state is taking advantage of the financial trouble of these private firms. And that's why it was aggressively acquiring these private firms. And that's an excellent point that you make. We need to think about whether we have other data to try to tease out what exactly is the motivation here. But the qualitative evidence that we have suggests that, the state-owned firms are actually not interested in acquiring these companies. It was more a top-down government mandate that asked these state-owned firms to go ahead and help this troubled private firms, because the local government do not want the private firms to go bankrupt. That which will cause instability and unemployment. So it's almost like a political mandate that the state-owned firms can go ahead and help the private firms. But the other interpretation could be plausible. But we do see the state actively intervene here. It's not like the state-owned firm volunteer to go ahead and take advantage of this excellent opportunity.
Thank you. I would just say those two interpretations are not mutually exclusive. I mean, the state can have an interest both in rescuing firms and as a byproduct of that increasing state control over the firms. But in any event, we're getting lots of questions here, which is terrific. So next over to Wuchan.
Yes, I have a question regarding double listing in Japan. So this is a comment and question for Professor Kanda. In Korea, double listing is pervasive. I think there are more double listing in Korea than in Japan, the mother company being listed as well as a subsidiary company. My question is, so in case of Korea, the reason why I think there is a double listing is that the controlling family, they want to preserve their control over the group while they are expanding the company by external financing. So they need both to be listed. But my question is, I understand that there's no controlling family in big Japanese companies. So my question is, why from the very beginning, why is there double listing in Japan? Is there a reason, something different from Korea? That's my question.
Thank you very much. It's a very good question. Indeed, a couple of different types. One typical type is by M&A. Let's say a listed company purchases another listing company so that they keep that company listing for the time being, at least. On the other hand, if a listed company want to sell its part, they sometimes spins off that part into another independent or the listed company and then sell it off to another company. This is one situation, the process of M&A. Another explanation that the parent company wants to use subsidiaries, listed subsidiaries, in order to make profits for accounting purposes. And also another situation exists. By the way, however, in other countries, like in the United States, for example, keeping subsidiaries listed is a risk because you have a public minority shareholders, and perhaps you are subject to litigation risk when you as a group do something, so that the double listing is usually unfavorable. And on the other hand, in Japan, there are lots of debates and discussions. We're not entirely sure, but the Tokyo Stock Exchange about 10 years ago made an announcement that they should be discouraged. And so the current legal issues, not quite responding to your central question, but the current litigation now relates to the going private transactions. Because of this discouragement, certain listed subsidiaries are moving toward 100% subsidiary by cash out or going private transactions, so that people go to court on the ground that this price is unfair. People means minority public shareholders. That's what's going on. The SoftBank Yahoo group resists or rejects government policy, and they keep expanding listing subsidiaries. Indeed, they have probably 10 subsidiary listing, but that's quite unique, and they don't follow the government policy. But that's what's going on. So I guess in general, going back to your original question, there are a couple of reasons, but mainly two reasons. I think having subsidiaries listed may have some advantages for accounting purposes, maybe reputation, recruiting purposes, and more Japanese reasons, perhaps on one hand, and the process of M&A on the other. There are two main categories in Japan. Thank you very much.
Thank you. Tobias.
Yeah, thanks. Let me just come back to this activism question, because what we see here in Europe, where the ownership structures are also concentrated, you see some kind of different campaigns brought by activists, and particularly brought against companies where you have deeply entrenched families or even governments. And do you see anything of that sort in Japan? Because there's a wonderful paper by Kobe Castile for the US, surveying the landscape, where you can observe something similar. I was wondering if you see anything of that sort, that certain activists target specifically these firms with concentrated ownership structures.
Could I respond?
Please.
Okay. Oh, thank you very much. Indeed, Japan, I mean, compared with other jurisdictions in Asia, as I said, the ownership is not quite concentrated. Therefore, it's easy for activists to do anything. The question is that in what situations do activists do? Well, I think you're quite right. That is, they usually go to the troubled firms. And my anecdote was 3 years ago, I attended a conference in Hong Kong, speaking with lots of activists, hedge funds, and other funds in Hong Kong base. And I asked this question, the Japanese companies do not show growth these days, but why are you so active in Japan? And so they answered this way, oh, you ask us very stupid question. There is much opportunity to make money in Japan. That's why we go to Japan. So I don't know. I don't have empirical evidence. We need more empirical studies on that. But I have the impression that the activists are active for troubled firms in order to make money. That's what's happening in Japan. Thank you.
Can I add into this a little bit?
Please.
Maybe Professor Kanda, I think activists also are after the cash. Could Japanese firms, maybe similar to Korean chaebols, have a lot of cash in the balance sheet, right?
I think yes and no. Yeah, but what I mean, usually people say yes, but when you look at statistics, the amount of cash
it's huge.
It's not huge indeed. As a percentage matter, it does not change. It didn't change in the past 30 years. The amount of, how can I say, the bad assets, if I may say, or the assets of the poor poorly performed sections remain large, the probably amount of cash as a percentage matter. So probably if you talk about the actual amount of cash, and perhaps it amounts to some degree. But yes, in the sense that the activists are interested in that because that's much easier to make profit, to get money out of the target company. In that sense, the answer is yes, but no, statistically, I don't think. But this point, of course, can be debated. But it is surprisingly the cash portion as a percentage of their balance sheet in Japanese large companies, all listed companies, it has been quite stable. It's amazing. But we'll be happy to send you data if you are interested. Right? Thank you.
Marco.
Yeah, thank you, Curtis. So one theme that really came through was the role of the government in Asia. I think I heard that in each case. So maybe it's a bit too long question, but let me just try and ask each one of you a question about the government. So Angela, in the case of Japan, I mean, what people in Europe, I mean, we have the G7 now taking place at this time. And we also heard yesterday that people are very concerned about the inability to actually invest in China in a meaningful way, let alone having shareholder rights. So, what do you see? What do you see in terms of this demand for reciprocity, equal rights for foreigners to invest in China, whereas Chinese companies can, of course, invest in other countries? And then for Upana, in some sense, Singapore is a model. I mean, you showed it on your graph. So we get this capture idea that these oligarchs capture the government. But, people have said this for transition economies a long time. Once the oligarchs are very rich, they want to protect their wealth, and Singapore is a model. So is there any prospect that they'll support Singapore? And then final question for you, Hideki. So in the Toshiba case, the Japanese press reported that one of the shareholders was approached by the government, and I didn't read the Japanese original, but in case of support for the activists, the word barbecue was mentioned. So is the Japanese attitude stewardship code yes, activism no? That's the most provocative, so I've left that for you last, Hideki.
Should I respond first? Thanks very much for your questions. And this is a point I also treasure this as an opportunity because I'm the only speaker from China that I want to send a message to the rest of the world that China very much welcome foreign investment for a number of reasons. First, China advocate for globalization help with the Chinese economy. Second, foreign investment play a very important role as a political force for the Chinese government to lobby their own government, right? I mean, especially during the current geopolitical climate where, China has made a lot of, China has become like an enemy for a lot of countries. And so foreign investment in China is a very important stabilizing political force for the Chinese government. So what I see the government is doing is taking simultaneously a carrot and a stick approach. On the one hand, it further opened its door. It welcomed Wall Street to invest in China, open up more financial services opportunities, and including the earlier sign up of the EU-China trade deal, which supposedly make it much easier for European businesses to invest in China. So you see more carrot extending to foreign firms. You see Tesla opening the largest factory in China. So all these things, but at the same time, you also see a stick approach. China just promulgated its anti-sanction law the day before yesterday, and it's exerting pressure on foreign businesses in China to lobby their home countries to drop sanctions on Chinese companies, right? I mean, so foreign firms to some extent are held hostage by the Chinese government because Chinese government think that Chinese firms are also held hostage by the foreign governments, have been treated unfairly. In this respect, I do have optimisms for foreign investment in China.
Thank you. I just want to interject here a program note. We're rapidly running out of time. So if Hideki and Yupana could give brief answers, I'm going to try to just collect up the questions. And I would ask the panelists to take a look at the chat. We're not going to have time to get to the questions in the chat, but I think if some of you could respond directly to the questioners to answer their questions in the chat, that'd be helpful. So Hideki and Yupana, over to you. If you could be very brief with your response, we can get a couple more questions in.
Yeah. Yes, thank you very much, Marco, and nice to see you again. Well, the two points. One is the Toshiba is exceptional or general is a matter of debate. Surely the Sony and Hitachi are very different from Toshiba. Because of the past history in the 10 years, Toshiba did accounting fraud and other things. And the governmental relationship, the government sometimes has a keen interest in national security and other reasons. They have the Foreign Exchange and Control Act, like US Patriot Act and things like this. So within that framework, the government shows interest. What happened, I'm not entirely sure, but was reported, for example, a person from the government contacted Harvard Foundation and asked them not to vote against management, and then Harvard followed it. And that was what was reported. I'm not sure what happened, but that kind of things could happen. Has nothing to do with stewardship code, I guess. Thank you.
Yupana? Yupana, do you want to respond or on Singapore? You're muted. Still can't hear you.
Can they unmute?
Yes, it's fine now.
Fine now? Can you hear me?
Yes.
Okay, very quick. I think you call them oligarchs again in Southeast Asia. And then, business group owners are as powerful in Singapore.
Yupana, so I'm sorry to interrupt you, Yupana. You seem to have an unstable connection. It's very hard to hear you. So with apologies, maybe you can follow up with Marco directly. I'm going to just, we're essentially out of time. Dan, you get the last word for a very, very brief question.
Thanks, Curtis. Yeah, no, just to say to Angela, fascinating presentation. My quick question is, there seems to be a lot of evidence that the Chinese government is able to wield its regulatory power over private firms and over even private institutional investors, at least domestic ones. And so my question is, what is the ultimate motivation? Is there a feeling that they're losing control, the sort of informal control? Because it seems they have a lot of control over the private firm, which makes me think, well, why are they formally trying to pull this back? Is there a sense that they're losing that informal control? So that's the question.
Very brief response to a big question, Angela. You have about 30 seconds.
Well, I don't think what's happening in China is unique to China. All over the world, the governments are trying to exert greater control over big tech. And it's just that the way and the approach that the Chinese government do this is so sudden and so dramatic that caused a huge panic among the investors and on the entrepreneurs. So and the same story with the securities market. I mean, the government clearly did not intend wasn't intending to. I don't think it was the government's intent to take control of these private firms, because private firm at the end of the day, it matters hugely for the legitimacy of the Chinese Communist Party, because economic prosperity is fundamentally matters for the performance legitimacy of the party. So they're not going to, make all the private firms become state-owned firms. I don't think that's the intention. It's more of the inherent problem of the Chinese governance model that led to this kind of big pendulum swing in Chinese governance.
Thank you. Well, with apologies to those still left on the queue, I want to thank our panelists for a terrific discussion. And I think it's my turn to turn it over to the next panel. Claudia, I think I'm turning it over to you at this point. So again, thank you very much for a really fascinating discussion.
Thank you.
Thank you, Curtis.
Thank you, Curtis.
So the next session, so I'll be chairing the next session, and I hope is at least as interesting as the panel that panel discussion that we just had. And so we will have 2 papers, and presenters will present in 20 minutes, then discussants will discuss in 20 minutes as well, and we'll leave it open for Q&A from the audience. So if you can type, please, your questions over the chat or ask them at the end, that would be great. And so without further delay, the first paper is going to be tunneling through group trademarks, and Woo-Chem Kim from Korea University Business School is going to tell us all about it. So Woo-Chem, the floor is yours.
Okay, thank you. First of all, for the organizers for putting this paper in the program. And this is a paper about tunneling. So we're trying to find a new tunneling channel by the controlling shareholders of the business group. And it's going to be about trademarks. This is a co-work with my students, Woo-Jung. And let me try to motivate the paper first. So we know what a trademark is. It's the one that... Yes.
May I just suggest that you go on full screen so that we can have it larger?
This full screen?
I don't think we are seeing it as full screen.
Okay. All right. So that's not full screen?
Nope.
Nope. All right. Okay. So that's problematic.
Well, we can see it if you don't manage to go on full screen. It's not a big deal. I just wanted to let you know.
So is this a little bit better?
It is a bit better, yes.
Okay.
Yeah, so why don't we continue like this?
Okay, I'll do it like this. So okay. All right. So the motivation is a trademark, and trademark identifies the company or the product or the service. So the owner of the trademark is called the licensor, and it would enter licensing contract with a licensee, basically giving the trademark to the company, and in return we'll be collecting what's known as royalties. So there's nothing wrong with this transaction if the terms are negotiated at arm's length. But however, if the contract is between a related party, there can be some alternative goal. And one example that has been discussed at OECD some years ago is a transfer pricing among the member firms of multinationals using trademarks. So you would let a company in a low tax jurisdiction to own a trademark and collect fees, so that other member firms in a high tax jurisdiction would pay less. But I think there's another example that companies may use trademark for some other alternative purposes. And we're trying to find this from group trademarks, business group trademarks. And this is a trademark, a name and a logo, as you can see here, that identifies the business group. And these are some of the examples. And the research question I have is, do business group controlling families misuse group trademarks to benefit themselves at the expense of outside minority shareholders? So basically a tunneling paper. This is a table showing you some top 20 groups, how much they're collecting. As you can see on the very far right column, there's a large variation in the aggregate royalties collected by the licensor firms. And if you look at the second column, the number of licensor firm in each of the group is usually one. There's one single licensor firm entering an agreement with all the not all, but many of the member firms and collecting the royalties. And if you look at the last 2 and 3 columns, the member firms are larger than licensee firms. So not all the member firms are entering the contract with the licensor. So let me show you an example of a particular group. So this is Chae Tae-won, the controlling shareholder of SK Group. And the firm called SK is the holding company, the mother company that controls all the other subsidiary companies. And here I am showing you the 6 member firms that are paying royalties, the top 6 loyalty paying member firms. And it's pretty large. And on the upper right, I'm showing you the total aggregate royalty. It's around 184 billion Korean won. That's around 150 million US dollar. And that is around 4.5 times larger than how much SK, the mother company, is using for its advertisement. So this advertisement expense would include to promote the brand value of SK, the butterfly logo that you can see there. But the royalties that it collects, it's much larger. So I think there can be 2 channels of tunneling. One is unfair transfer of the trademark ownership itself, right? So it could have been that some other firms were registered owners of the trademark, but it has been transferred to another company at a price that is beneficial in favor of the controlling family and so on. But we don't see this transaction much, so I cannot really make use of this for my empirical study. And even if it is there, it's not, the detailed terms are not disclosed. So instead, I'm going to focus on the loyalty transaction itself, okay? So that is because thanks to the 2018 rule change, where the member firms of large business groups were mandated to disclose the details of the loyalties that they pay as a licensee firm to the licensor firms. So let me talk about this disclosure. So there was an old system before 2018, but it was incomplete. Only a part of the loyalty transaction was disclosed. And the Fair Trade Commission says that 67.1% of the loyalty transaction were not disclosed under the old regime. But the new regime was introduced in 2018, and I think it's better to explain this using this timeline. So if you look at the timeline, let's go to 2018 January. That's when it was announced that the government will adopt a new rule. And then the details of the rule was announced in March of 2018, and it was implemented in May. But what the firms were supposed to disclose is not the 2018 trademark transaction, it was the 2017 transactions, which means that during 2017, when the firms were paying royalties and the licensor firm was collecting it, they did not know that there would be any new rule that would mandate them to disclose to the public. So this is a good setting for me because I will not have much confounding effect. And also in 2017, controlling families had no reason to disguise their tunneling activities. So the coefficients, the estimates that I would get is not going to be biased. The empirical strategy is the following. There is a challenge. Whenever we do tunneling studies, we're not really sure it is tunneling because we have to ultimately compare the actual terms and the fair terms, but the fair terms are not known. It's very hard to estimate. So like most of the tunneling studies, we're going to take an indirect approach. What we're going to do is we're going to predict the patterns of loyalty transactions in the presence of tunneling. We're going to make a lot of predictions, and the predictions are going to be based upon economic incentives, and we're going to use the controlling family's cash flow rights in each of the member firms. And then we'll test each of the predictions using the data and see whether it is supported or not. So that's the strategy. And before I go into the tables, let me just give you the main findings of this paper. So the first result is that firms with high family cash flow rights. So this is the firm that the family really cares about. They have a lot of economic stake in this company. They're the ones that are highly likely to become a licensor firm to collect the loyalties. Second, the firms are more likely to be licensee firms, so they're going to be the payers of the loyalty, and they pay higher loyalty payments if the controlling family's cash flow rights are further below those in the licensor firm. So what I'm doing is I'm computing this cash flow rights differential. This is the cash flow rights the family has in the licensor firm that is on the top, subtracted by the cash flow rights of the firms that are paying the loyalties. So if it is positive, it means that there's a huge divergence. And this is the situation where the controlling families would benefit if the licensee firm pays excessively to the licensor firm. And then after having shown that, we'll look at what happens to the dividend payout by the licensee firms and the firm value. So that's number 3. So I'm going to look at the elasticity of demand payout or share repurchases in respect to loyalty payments, and see if it becomes lower if the cash flow right differential increases, and also whether the firm value of the licensee firm drops more if the differential is higher. And then lastly, I'm going to show you that this tendency from number 2 to 4 is going to be stronger in a particular type of a licensed firm. These are the pure holding companies. Pure holding companies are defined as the holding companies that does not engage in any other businesses. The only business they have is controlling their subsidiaries and collecting dividends. And on top of that, they may hold a license, the trademark, and they may collect the royalties. That's the only business they have. So we're predicting that they have no other alternative channels of tunneling, no other related part transactions that can enter to benefit themselves. So they would have a stronger incentive to do so using the trademark payments and receipt. So those are the hypotheses and the finding. And the contribution of this paper is that I think we're contributing to the tunneling literature, obviously, because we think that we found another important channel. Business groups, especially family controlled business groups, may expropriate minority shareholders. And slightly contributing to the dividend literature, because in our study, we show that higher the trademark payments by the licensee firm, they pay less dividends to the minority shareholders of the company. So it's a governance related determinant that we identify, and also contributing to the blockholder literature. So this is the one that is related to Professor Kanda's discussion on Japan, in Japan. So we have a double listing problem. And the mother company is a controlling blockholder of the subsidiary that is listed. And there are some studies, US studies, showing that there's an expropriation going on if both of the companies are listed. And we show this in our paper using trademark transactions. These are the key variables, and probably the most important variable is the cash flow rights, because it measures economic incentive, and the cash flow rights differential, which is basically the difference between the family's cash flow rights in the licensor firm subtracted by the family's cash flow rights in the licensee firms. And it's going to be bounded to be 0 because the negative value has not much of a meaning. So it's either 0 and positive. If it's more positive, there's a stronger incentive to use a trademark as a tunneling device. Okay, the first prediction was that families with high cash flow rights are going to be more likely to be the licensor firm. So we basically run a probing regression and try to see whether this coefficient on cash flow right is positive, significant. We do find that. So you can see the coefficients in the box. It's highly statistically significant. I did some economic analysis trying to show you that it's also economically significant. And if you go to the second prediction, it was about who is going to be the licensee firm. And we have to understand that there's a formula that is used by the Korean business groups. The trademark is usually a certain fraction of sales adjusted by some of the factors that they think is important. So mainly it is going to be that the firms with large sales are going to be the licensee firm, because from the controlling shareholders' point of view, if you try to collect loyalty from a very small, tiny company, there's not much you can actually collect. So we think that sales volume is going to be the most basic determinant. But on top of that, the link between sales and the probability of being a licensee firm is going to be amplified if the cash flow right differential is larger. So we're going to look at the coefficient on the interaction term and see if it is positive. And we do find that here. So you can see this statistical significance, and you can see the economic significance there. But this is a result for pure holding company groups. As I have told you, we think that these pure holding companies, when they become the licensor, they have a stronger incentive to engage internally, because that's the only channel they have. So when I ran the same regressions using a sample of other business groups, we don't find this result. No interaction term is significant. When you go to the trademark payments, the actual payments, again, sales is going to be a very strong determinant of the volume of trademark payments by the licensee firm, but this relationship is going to be stronger for the licensee firms with high cash flow rights differential. So we predict a positive coefficient on the interaction term, and we do find that here as well. But this is for the pure holding company. We don't find this result in other business groups, which have less of an incentive to tunnel. And this is trying to explain why it makes sense for the controlling family to divert dividend payout by the licensee firm to a trademark loyalty payment to the mother firm. So now here you can see that the controlling family has ownership only in the licensor firm, and the licensor firm has two subsidiaries. One has a 20% equity stake, the other one has an 80% equity stake. And if you calculate the cash flow rights, it's much lower for subsidiary A. It's only 18%. For subsidiary B is 48%. And if you do a simple experiment, you can see that by shifting dividend payout to loyalty payouts, the controlling family benefits in both of the cases, but they would benefit much more if the cash flow rights of the subsidiary is much lower. So we predict that, So we predict that the elasticity of dividend payout or stock repurchase in respect to loyalty payments is going to get lower, and an extreme case is going to become negative if the cash flow right differentials are high. So we run those two regressions, one dividend, the other stock repurchase, and we predict that the coefficient on the trademark is positive, but the interaction term is negative, and for a very high differential, the whole thing may even turn into a negative. So we do find that here. So at the bottom of the table, I'm showing you the experiment when using differential is 0, when the differential is 50%. If the differential is 50%, actually there is a trade-off. The more dividend you pay out, the more loyalty the licensee firm pays out, there will be less of a dividend payout to the minority shareholders. So I am almost done. So firm value. So ultimately, this will point to the fact that these licensee firms are expropriated. So this should be reflected in the share price. So we look at the Tobin's Q, the firm value measure, and we do see that the more trademark loyalty payments these subsidiaries make to the mother firm, the loyalty payments, the more they do it. And especially the firms with high cash flow right differentials, firm value is going to be depressed. So we do show that immediately after the 2018 disclosure, and we even see some evidence of that even before the disclosure, because it's not really hard to predict which ones are being expropriated if you know the ownership structure of the firm. So I'm actually done. I hope I'm within the time limit. Thank you.
Thank you, Woo-Chun. That was perfect, right on time. And the discussant is then Pachniak from NUS. Then the floor is yours now.
Thank you a lot. And Thanks a lot to Wu-Chan. Just 1 second here. My slides do not seem to be working. There we go. Yeah, so it's an excellent paper. If you've read it, you know that. If you haven't read it, then you should read the paper. At the start of the paper, I guess the authors, Wu-Chan and his colleague, suggest that maybe this paper, people will see it as just a Korean story. I don't think that's a worry at all, and I agree with them completely that this is a paper with broad applicability for somebody who's keenly interested in corporate law in Asia. Definitely, this paper examines family firms. It examines tunneling in corporate groups, ubiquitous throughout Asia, important throughout the world. And then there's this new channel of tunneling. And I've written, again, not from an empirical basis, but from a corporate law theoretical basis on tunneling. And I would have never thought in my wildest dreams to think about tunneling through trademarks. So, that is a terrific finding, which is great. And I could go on for another 20 minutes saying great things about the paper, but that's not my job here. Yeah. My job is to sort of pick out some of the things that could possibly be improved on. And I think, taking a step back, there was one question that popped into my mind repeatedly when I was reading the paper, and it was this: were the corporate structures of these successful business groups created primarily for the purpose of tunneling through trademarks? And the answer that I have is likely not. Now, why not? Why do I say that? There are a number of legitimate business reasons that I think explain fairly well the empirical results that they have found, both at the group level and at the firm level. And as Wu-Chan mentioned correctly, and credit to the authors for bringing this out up front in the paper, this paper is extremely difficult. It's extremely difficult to prove tunneling, because the direct evidence of tunneling, to prove directly that there is tunneling through trademarks, you need evidence that the controlled firm, that the licensor is charging above market price to the licensee, or else you're not going to have tunneling. But that data isn't available. So because they don't have the ability to look at these third-party transactions and then compare it to the actual transactions taking place between the licensor and licensee, what they have to do is they have to look at the group level, and then they look at the firm level, and they say, if we find these characteristics at the group level, and if we find these characteristics between the licensor, the licensee, and the controlling family, then we can infer from that that tunneling must be going on. And again, what I'm going to do in the next 15 minutes is I'm going to suggest that, yes, all of the empirical information is correct, but many times I think there was a different inference that could be drawn, a much simpler inference that suggests legitimate business reasons for the relationships and the group structure, not necessarily tunneling. Now I'm going to do something which I don't think I've ever done in a presentation, but we're on Zoom and we're all sort of sitting in our homes, so I thought I will do something a bit fun. I'll ask you to close your eyes. Yeah, I promise there's a point to this. Close your eyes and try to picture the logo, the trademark of a Korean firm that is the most valuable trademark. I suspect most of you thought of Samsung. If you didn't think of Samsung, I suspect most of you thought of Hyundai, LG. I did a quick internet search, right? And what do you find with famous trademarks or valuable trademarks in Korea? almost all of these trademarks are trademarks that have been created by family firms, right? Now, why is this important in the context of this paper? Well, the authors say this in the paper: in the absence of tunneling, one should not expect any difference in the extent of the trademark royalty transactions across groups with different control structures. In the presence of tunneling, however, we expect a greater extent of trademark royalty transaction in groups that are more prone to tunnel. For example, we expect greater transactions in family-controlled businesses or business groups than in other groups, such as groups that are management-controlled or state-controlled. What I would suggest is in fact that could be very much incorrect. Why? Because it seems in Korea that in fact family firms have been the most successful in creating valuable trademarks. And therefore, regardless of tunneling, in the absence of tunneling, you would expect in family groups their trademarks to be more valuable. And therefore, you will find the empirical evidence that trademark royalty transactions within family groups are a greater percentage of sales and make up all of the empirical measures that they use for trademark royalty transactions. So to me, this actually, there is a link between the firm structure and trademark royalty transactions. The empirical evidence may be correct, but the inference drawn from it is not tunneling, but rather that family firms have been very successful in Korea in creating valuable trademarks. Another group level inference that we're asked to draw is this: we expect a greater extent of trademark royalty transactions in groups where pure holding companies, those are the holding companies with no business operation of their own, are licensor firms than in groups where licensor firms have their own business. The reason that the authors give for this is they say, well, if we have a pure holding company, what's a pure holding company again? A pure holding company is a company that only owns the trademark. It's their only business to license it. And the authors say, well, in that type of situation, the holding company only has a trademark to use for tunneling. So therefore, we'll find a greater level of transactions in that group with pure holding companies. Now, I have an alternative and I think a much simpler business explanation for this, which is that in groups that create an entity just to hold the trademark, you would think that in those groups, the trademarks are particularly valuable, or else they wouldn't be creating a pure holding company to hold it. So in those groups, regardless of tunneling, you would still find a greater extent of trademark royalty transactions. Again, a simple business explanation, not challenging the empirical evidence, but rather challenging the inference that may be drawn from it. Now I take you from the group level to the firm level, okay, which they do in their paper. And when I go from the group level to the firm level, at the firm level, they make one very strong point, which Wu Chan brought up in his presentation as well, which is that the family controlling firm will have greater cash flow rights, which are a result of their direct shareholder ownership in the licensor firm. And this makes perfect sense, because if you want to tunnel, the family controller would have to have greater cash flow rights, greater ownership in the licensor firm than the licensee firm. And if they price the licensing rights at above market value, then they will shift wealth from the firm that they own less of to the firm they own more of. That's tunneling. Makes perfect sense. However, I can think of several business reasons, a number of which were not mentioned in the paper, for why the family would want to have greater control over the licensor firm. Again, nothing to do with tunneling. I'm sure maybe some of you have already thought of those reasons. one reason is reputation. The most important thing for families is probably their reputation. The most important thing for a firm's reputation is their trademark. If you're going to put the trademark if you're going to select a licensor firm, you're going to want to select it as the one that the family has the greatest amount of control rights over. Again, that will produce the same empirical result that the families will have the greatest cash flow rights, the greatest ownership rights over the licensor firm, but not for a tunneling reason, for a pure business reason. I can give you another organizational reason relating to business. We look at this simple chart, and Wu Chan showed similar, the SK chart was similar in his presentation. And this is a chart you'll see in a pyramid structure, right? And if I were to ask you without telling you anything else, and to say, put tunneling out of your head, which firm in this simple chart is going to be the licensor, and which firms are going to be the licensee? I would suspect that almost everybody would pick the top firm in the chart as the licensor and the other firms as the licensee. If I was to ask you another question, which is, which firm on this chart would the family controller own the greatest amount of shares in? I think almost everybody would say the firm on the top of the pyramid, not some random firm on the bottom of the pyramid. Well, if that's the case, then you're going to get the empirical evidence that the licensor firm has greater family control or ownership, and therefore has greater cash flow rights. Again, nothing to do with tunneling. The age of the firm. This is discussed in the paper. Wu Chan didn't discuss it, but it was on one of the slides. They did find empirical evidence that licensor firms tend to be older. Again, this makes sense from a historical business perspective. If you think that a company starts up and then they expand as a group, the original company that the family owns the greatest direct shares in gets the trademark license first. They don't bother to transfer it. You're probably going to find that the older firms are also the ones at the top of the pyramid, and the ones that the family want the trademark in, they're the licensors. Again, business story, nothing to do with tunneling. Taxes. Wu Chan brought up taxes. They found that indeed, for tax purposes, some firms are made the licensor and the licensee, and this is a way to shift from high tax to low tax. Again, they test this very well in the paper, and they show that when you control for it, you still find evidence of tunneling. So I think they were very smart. It was very good for them to control for this, test it. But my point is this, that if you put all of these four things together, two of which were never even considered in the paper, this looks a lot more like me, that a lot of this, which is the empirical end result, the inference drawn could be, and in my mind, on a preponderance of evidence, would seem to have more to do with business reasons than it does have to do with tunneling. Wu Chan mentioned this interesting finding of CFR diff firms with a negative value. And if you recall, just to refresh your memory, what does that mean? That means that the family controller actually has more cash flow rights in the licensee than the licensor. So they say we disregard these and we code them as zero because no tunneling can take place. I completely agree. Why do I agree? Because in fact, if in this case, the licensor was selling the licensing rights at above market value, you wouldn't have tunneling. And I say this a bit in jest, you would have funneling, because you would have, the end result would be that a wealth would be transferred out of the licensee firm into the licensor firm, which the family has less cash flow rights of. So that's never going to happen. Now, why do I bring up these firms? I find this very interesting. And although I agree with their empirical approach, I think they need to think about why this is occurring. Why do I think this is important? Because this is showing us that there are corporate groups in Korea that are not structured at all to engage in tunneling through trademarks. And my question is why? If this is pervasive, why do we have one group of firms that definitely is not doing this at all, and other firms which you suggest are? And my suggestion is maybe these other firms are in fact also just carrying on and doing their structure for business reasons as well. I'm getting close to the end of my comments, but I have this smoking gun argument, which I think could be useful to test. Wu Chan told us that that the families and the controllers didn't know that the legislative change was coming. And if they didn't know the legislative change was coming, we should have found that that in the data there was disclosure prior to the change in the law, but the disclosure only occurred when a licensor firm had collected over 5 billion Korean won, or over 5% of their sales from a single licensee. Now, what I would expect to find if these firms are hell-bent on tunneling through trademarks is you find a lot of cluster around 4.99 billion or 4.99%, because that would help them avoid having to disclose it. And I just wonder whether they looked into that. If they looked into that, or if they do look into that and they don't find this cluster, it means that firms weren't actively working to avoid disclosure. Why wouldn't they? Because they're not worried about disclosing, because the business, they're not tunneling. If they find it, there's smoke, okay? But if they don't find it, there's no smoke. If there's no smoke, there's no fire. Big picture. What do I think? I think they're right. I think they're right on one level, and maybe there's some questions on another level. I think they have illuminated a channel of tunneling. I think this probably goes on. I'm not saying, and there's a lot of positive empirical stuff. I didn't focus on the positive empirical stuff. But my question is, how much of this is going on? How pervasive is it? How important is it? And I think a lot of this circumstantial, or what they're calling indirect evidence, leads to other conclusions that can be explained by simple business reasons. And I think they need to look into some of those other business reasons, which I think are quite clear, to explain their empirical evidence, or find other ways to test those other business reasons for their empirical findings, which don't draw the natural inference of tunneling. And you really have to also think of the group they're looking at. The group that is being looked at here are only the very successful groups, because these are all groups that the Fair Trade Commission has said have to disclose, which means they have $5 billion of assets, or for financial firms, 5 billion of market cap. So in these very successful firms, you have to ask yourself, is the whole firm set up to tunnel through trademarks? That would seem to me to be a bit of a stretch for very successful group companies. I have a last wish with I think I have a minute left, and it is this, and it's a bit of a frivolous wish, but I'm going to make it anyways. If you look in the footnotes, and as a legal scholar, I read the footnotes sometimes before the paper, one of the things is that they exclude Samsung from the paper, and they give very good reasons why they exclude certain groups and they include other groups, but then they exclude groups and then they include 3 back in. And this is just frivolous, but when you look at Samsung, it's a juggernaut. It's massive in terms of trademark value in the world. And when somebody like me reads the paper, who doesn't do a lot of empirical stuff, but knows Korea, you want to read about Samsung, right? So I would say find a way to include Samsung. Don't exclude the very most important, which has a huge outsized value in Korea. Exclude it and then re-include other firms. Please include Samsung. With that, I just say thank you very much. The author's terrific paper. I would have never thought of tunneling through trademarks. I'm sure it happens. And I'm sure you'll have great responses that will show that I'm a mere corporate law scholar with very poor empirical knowledge. And so thank you very much.
Thank you so much, Dan, for the great discussion. I will invite Wu Shan to maybe take some minutes to respond, and then I'll just open the floor for questions.
Okay, thank you. I have some immediate responses. Actually, Don gave me a very nice perspective from the business management point of view, which financial economists would probably not give. So thank you very much. But so my counter argument is that, so one of the arguments you made was there are many Korean successful family business groups that have a very high brand value, like Samsung Group and Hyundai Motor Group. But however, these are the groups that actually collect less when it comes to the trademark royalties. So they are excluded from the sample because there are multiple licensors. But when you look at one of my table, when I rank the groups in terms of how much they collect, they're actually at the bottom. The smaller ones, they, even though the size is smaller, they have less brand value, they collect even more. So that's going against the business, the perspective that the groups with higher brand value is legitimate. They are legitimate to collect more. Another one is because these are successful ones, they don't have to engage in other businesses. They can just set up a pure holding company and do so. But again, you know, Samsung does not do that. And the Hyundai Motors does not do that either. So maybe that I should develop on this and try to respond to any suggestions that future referees might have that are in line with your discussion. Another one is, so I really want to differentiate whether a firm becomes a registered owner and whether it actually collects the royalty. There are some business groups in my data where they are the registered owners of the trademark, right? Because if you look at the organization structure, as you have said, the one at the top naturally becomes the one, they should be the one, the old one, the one on top should be the one who should be the registered owner. But it's a different thing whether they massively collect loyalty payments from their subsidiaries 4.5 times larger than the expenses that they have used. So this is not normal. So which motivated me to study this. So I just want to mention that. And another one is clustering issue. That's a very neat idea. But the problem is we want to find clustering happening just below the threshold. But we don't have that, right? We only know the ones that are above the threshold. So we cannot detect whether there's clustering or not. So it's unfortunate for us. And again, leaving out Samsung Group and the Hyundai Motor Group, the top two, was inevitable because they have multiple licensed firms. And one of our key variables was cash flow rights differential. And another comment I would like to make is we have the result even excluding those very enormously large business groups who has a very enormously large brand value. So we have it even among the smaller ones. So that's my defense. But I think your comments are very valid. And I think we should rewrite our paper, maybe some paragraphs, trying to address some of the concerns that might arise in line with yours. Thank you.
Thank you so much. Do we have questions from the audience? Does anyone want to? Okay, so we have Ernest. Ernest, do you want to speak that?
Thanks. Very interesting paper, which I'm fascinating. I wouldn't have thought about this either. I'm just still, maybe I missed that, but I mean, why is it so difficult to get this hypothetical fair value of licensing of trademarks? I understand this is a rare thing, of course, and I mean, Dan discussed the reputational issues and all of this involved. I understand this, but I mean, for example, licensing to foreign firms for foreign markets or something like that. Is there so little evidence on that? So it's impressive the enormous indirect route that you have to take. And I'm just wondering what evidence we potentially could have about the direct route.
I think the problem we have is we are investigating the group trademarks. So for example, LG Group, the one that collected the most in our data, LG Group would probably not lend out LG trademark to non-member firms. Once they do that, that's like inviting to become a member firm. So there was no such transaction, I'm afraid, and we couldn't actually compare our trademark rates with those rates. It just
so there's literally nothing around. There's no way to. I mean, obviously, you can't find this systematically, but I thought maybe in certain markets, in certain stages of development, you may be able to trace something. But you said there's nothing to be seen.
Yeah.
Okay.
Thank you.
Thank you. Any more questions? I see there was a question from the audience, not from the panel, but I don't see it anymore.
Yeah, this is Varghese. I had a question. I had raised a hand. So
okay, sure. Yeah, please ask your question then.
Yeah, I was just wondering whether the excessive royalty payment also could be influenced by some of the tax incidents. Suppose instead of paying royalty, if the subsidiaries try to pay dividend, there could be two taxation possible. Like the subsidiary itself could be suffering tax, and the holding company also would be suffering tax. So if they show it as royalty at the subsidiary level, it would be a cost to the subsidiary company, and only one income would be there for the holding company. So the overall tax liability of the group would be reduced if excessive royalty payment would be there. Whether you have factored into that possibility?
So the family owns a controlling equity stake in the mother firm that has the license. And then these licensed firms holds equity stake in the licensee firms that are one, paying dividends or paying trademark royalties. So either case, whether it's a trademark loyalty or a dividend, once it arrives at the mother company, that's a profit to the mother company, and they are subject to the same corporate income tax rate. So there's no actually a difference between the two when it comes to tax.
Yeah, may I ask a follow-up question? Because actually, see, there could be, I mean, I don't know, tax treatment of dividend income from subsidiaries could be different for different jurisdictions. There are at least some jurisdictions where the subsidiary pays, I mean, dividend, but after deducting the tax on the profit it makes. So it pays dividend, and the dividend income in the hands of the holding company also is taxed. On the other hand, if you pay as royalty, so the royalty would be a cost to the subsidiary. So there is no tax on that. I mean, the corporate tax on that. So when you, when you send it to your holding company, only the holding company would pay whatever the corporate tax applicable. So I feel that at least in some jurisdictions it would make a difference, I guess.
Yes. So as Don has discussed, we consider the effect of tax saving by the licensee company that is paying royalty, because that would be considered as a cost, and that will lower the tax bill. Even after controlling that, we were still able to find our results.
Very good. Any more questions? Yeah, Kwong, do you want to ask your question?
Yeah. So as being a bit familiar with the Korean chaebol system, understand that as companies go down a generation and beyond, some of these family conglomerates are split into multiple separate smaller conglomerates, all sharing the same SK or GS or whatnot, the license. In those cases, do you see a difference between the license fees that are paid for firms that are within the main, well, what might call like the main trunk of the chaebol, versus other firms that are still within the broader family, but in a slightly different like chaebol split off? For example, like SK, I think has like two or three divisions that are kind of split among different sons of the family. So. Yeah.
Oh, so I see. So you're trying to compare SK group. So there are some mini groups within the same group which are controlled by the cousins, You want me to compare that with the ones that actually split, like LG, GS, and all that, whether there's a greater similarity in case of SK compared to the separated LG groups. I have not looked into that. Maybe there could be some greater similarity within SK. But even within the same business group, each of the licensee firms, they have different contracts. So there are, those contracts are approved by the board of the individual licensee firms. The formulas and the trademark rates are all different. But yes, definitely I could investigate and see whether there is any greater similarity for such groups. Yes, thank you.
Very good. Any more questions? I have a question for you, Wu-Chang. So what was coming through my mind was this idea that if there is indeed expropriation of minority shareholders through this mechanism, so do we see any consequences of this type of behavior by these groups, right? So is it the case that they are having extra trouble when raising external financing with new shareholders, or even say when it comes to raising external capital with banks? So do we see this reflected somehow in their ability to raise capital, right? Because I wouldn't see this as having no consequences on that side.
So we did find evidence that dividends becomes lower and the firm value will be lower, but we have not found any consequences by the banks or any having difficulty in issuing new shares. I have not found any of that. Maybe because these are large business group member firms, so they do have an internal capital market, and they usually, instead of doing any new equity issuances, they have a strong tendency of using retained earning. So maybe that is, why I cannot find any consequences. But no, not yet. Maybe we should search. Thank you.
No, I think actually it makes a lot of sense, right? That given that they have their own internal capital markets, that they are less or they are more immune to these type of consequences. I think that's quite interesting. Any more questions from the audience?
Yeah, I will jump in if there's
please.
Still a few minutes, and if there's no other question. I would be interested, like I love the paper, Wu-Chang. It is truly a great paper and got me thinking a lot. And I have written in this area, and honestly, I think you've uncovered something wonderful. What I was wondering in terms of your explanation, like I did find though, as I brought up, one of my points was about the negative values, right, for the CFR diff, right, and for those groups, right. It is interesting to try to think about, well, why do you have some groups setting up the structure to do this? And then obviously, right, I think we would agree that in those negative CFR diff groups, there's definitely no tunneling, right? And it makes you think of, okay, what is the difference there? Is it just we have sort of good firms, bad firms, and some are not motivated to do this and others are? That seems to go against sort of the general intuition that, self-interested controlling shareholders will naturally tunnel when they can, right? So that is, I guess that's one point. The second point is on how this affects minority shareholders, which correctly, I think you hit the nail on the head at the end of the day, that this is going to be the big concern out of your whole project, right? Is this actually something which is draining value through, is tunneling through trademarks a lag or stealing essentially from the minority shareholders? You do, of course, find that empirically for the pure holding companies, but you don't find that right, for the non-pure holding companies. And I found that also a bit the same sort of question, right? Why would you, if you're going to posit some sort of explanation, why do you think you find that difference? Why is there no effect on minority shareholders, or at least the empirical evidence didn't show anything for the non-pure holding companies? And then are we limited just to really worrying about, we don't worry about non-pure holding companies, we don't worry about negative CFR diff, and we're only left with this small pool at the end of the day, which whittles things down quite a bit. Yeah, so just your reaction on that.
Okay, 3 minutes. Okay. So the business groups that have like negative cash flow rise differentials, they're the ones that are not structured with a pure holding company business group. So it's probably going to be like Samsung Group or Hyundai Motor Group, where there is no obvious holding company. So there's no holding company in Samsung Group or Hyundai Motors Group. So, and also on top of that, they have multiple firms with licenses. Usually the large ones would have their own licenses. And because of that, and also another factor is that controlling families, their ownership is not concentrated in a single firm in those firms, right? So these are the firms with negative cash flow rise differential. The controlling families have ownership in multiple firms. There's no obvious one single firm that is going to be the licensed serve firm. That really discourages the controlling family to aggressively collect loyalties for the purpose of tunneling, because you can't. There's no obvious firm that you can use as a vehicle to expropriate. I think that's what is going on. Maybe not a satisfactory answer for you, but
just one, I guess one tiny follow-up again is, a few times in your response, you've brought up Samsung, which makes me go back to the point of why not include Samsung? Because Samsung and Hyundai seem to be good examples to rebut, or at least to shed some light on some of these other points. And I understand, I'm not a, like, if you looked at my math compared to yours, I'm like a primary school child, yeah. So I'm not here to tell you what you can do empirically and you can't. But I understand, like, your explanations seem compelling to me, that you have multiple licensors, right? But maybe at least descriptively, you do talk descriptively about groups, right? So it may make some sense to descriptively talk about Samsung and Hyundai for some of these other issues. Maybe, I don't know. A, because they're interesting. B, because what you've been saying in your response seems very compelling to me. But you've been bringing up Samsung and Hyundai, right? And so that begs that question of exclusion.
Okay, so your comment is well taken. For technical reason, I left it out, Samsung Group and Hyundai Motors Group, but I could have a more descriptive section trying to cover Samsung Group and trying to explain that the result would probably not change even if I put it in. I will try to explore that venue. Thank you.
Fantastic. Thanks so much. Let's move on to the next paper. So we have Philip Kruger from University of Geneva presenting the sustainability wage gap.
Great, thank you. Can you all see my slides?
Yeah, that's perfect.
Okay, great. So I'd like to start by thanking the organizers for putting the paper on the program. So this is joint work with Daniel Metzger, who's at Erasmus University of Rotterdam, and Jackson Wu, who's at the Stockholm School of Economics. And the starting point for this paper is really this idea that perhaps one reason for why firms engage in sustainability activities, or why they invest in ESG policies, is that this might allow these firms to attract more talented workers. Okay? Perhaps because workers have explicit preferences for working for sustainable organizations. And therefore, accept to work for firms at lower wages. Now, this idea is not necessarily new, right? And it has been advocated a lot in management circles. So for instance, in 2008 already, the MIT Stone Management Review ran a piece on how using CSR or sustainability could be a way to win the war for talent. Management commentators in Forbes, for instance, have highlighted that corporate social responsibility might help attracting top talent. And in another piece, they even go so far as to suggest that some workers, and in particular talented workers, might want to not only receive a paycheck, but also work for purposeful firms or organizations. Now, this idea, I think, is quite appealing, or this narrative. However, we think that there's relatively little large-scale empirical evidence backing this up. Okay, and this is really where we come in with our paper and try to answer a relatively simple research question, which is whether workers or employees in general, so we don't have white collar workers in mind, so we have employees in mind, whether they actually value the sustainability of the organizations they work for. And we get at this question kind of from two different angles. Okay, so first of all, we're kind of interested in really establishing like some correlations, if you will, or partial correlations. Looking at whether more sustainable firms actually pay lower wages, and then kind of fixing talent or holding fixed talent, and then there's kind of a related or a reverse hypothesis here, which would be, fixing a wage. Do we observe that more sustainable firms are better at attracting and retaining talented workers? Okay, so this is really what this paper is about. So I really have to watch time because I don't want to go over time. Now, let me quickly outline how I'd like to structure today's talk, and also give you some of the main takeaways in case I lose you or I actually don't manage time well enough. So I'll first talk a bit about how we measure sustainability in this paper, and specifically we focus on one sub-dimension of sustainability, namely the environmental sustainability of organizations or firms. And to do so, we propose a novel and survey-based measure at the sector level. Okay, and we focus really on the sector level here because we think that workers can form meaningful beliefs about the sustainability of a sector. Okay, it might be more complicated doing that at the firm level, but we also have firm level tests. I'll then talk a bit about the data we use in this paper, because I think we have very interesting data, not only on wages, but also on talent. And then I'll present some of the main results or main takeaways. And so what we document in this paper is that firms that operate in the most environmentally sustainable sectors tend to pay about 10% lower wages than otherwise to otherwise similar low workers. And so we coined this wage differential or wage gap, the sustainability wage gap. So essentially, workers that work for firms in the most sustainable sectors, they earn less than otherwise similar workers. We then explore sort of heterogeneity in this effect by looking at the most educated and most highly skilled workers. And we find that this sustainability wage gap is more pronounced for the most highly skilled workers. So they seem to care even more about the sustainability of the employees they work for. And we also document that the sustainability wage gap is more pronounced in more recent periods. And then finally, we also show that firms that operate in high sustainability sectors are also better at retaining and attracting high-skilled workers. Now, if I have time at the end, I'll also discuss some alternative explanations and threats to identification that we carry out. Now, let me jump into how we measure sustainability. So as I said, we focus on the environmental component of sustainability, and mainly because we think that this is an intuitive dimension workers understand. And so what we do in this paper, we use a survey instrument to classify industrial sectors or economic activities in terms of their environmental sustainability. And more specifically, we ask bachelor students in economics and management to classify economic activities. So we ask them to, so we give them a set of sectors and ask them to classify them from being environmentally sustainable to being environmentally unsustainable. Okay, so we code sustainable answers or sustainable responsibles with a 5 and unsustainable sectors with a 1. We always allow for a do not know response because sometimes it's difficult classifying these sectors. And then what we do is we take sector averages, so essentially using all the survey responses for a given sector to calculate the consensus view on a given economic sector as to whether the sector is environmentally sustainable or not. And this is sort of what you get. So in terms of the most sustainable sectors, you get sectors such as education, health, recycling, or social work. Okay, so arguably sectors that, like I would at least think are sustainable from an environmental perspective. And if you look at the other tail, or at the other tail of the distribution, the lowest rated sectors are those related to fossil fuel energy sources, production involving chemicals, and air transport. So we think that this measure, so this survey-based classification, captures meaningful beliefs about the environmental or sustainability of sectors. Now, let me quickly say something on the wage and talent data we have. So essentially, we use data from Sweden for the entire Swedish worker population between 2001 and 2017. So we have very standard labor data, such as the wage of individuals, their gender, their age, their potential experience, their years of education. But we also have very detailed data on the occupation, so the specific job that an individual has. So for instance, if that individual is working as a secretary, engineer, manager, so we have occupation data. But I think most importantly, we even observe their cognitive and non-cognitive skills. Okay, so these data come from military enlistment tests, okay, for the male subpopulation. So in Sweden, the male population has to undergo both a cognitive and a non-cognitive intelligence test, which we observe. Okay, so we can control for the cognitive and non-cognitive skills of an individual, which you would think are important determinants of their wages. Now, let me illustrate some of the main finding in a graphical way. So what we do in this bin scatter plot here is we sort wages by the sustainability of the organization for which the specific workers work for. Okay, going from low sustainability to high sustainability. And then we calculate the average wage for each of these 20 sustainability bins. And what you can see here is there seems to be a considerable gap or difference between workers that work in the sectors with the lowest sustainability compared to the sectors with the highest sustainability. When we estimate more traditional wage regressions, so when we take the log of wages and regress them on a dummy variable that indicates the highest sustainability sectors, controlling for sort of more traditional determinants of wages, as well as our skills measures and year occupation fixed effects, we find that essentially workers, let's say otherwise similar workers that work in the sectors with the highest sustainability earn approximately 10% lower wages. Now, we estimate these regressions separately for women and men, mainly because the skills measures are a bit different. But we find very similar results when we look at the female subpopulation. Okay, so the women also earn less when they work. Let's say otherwise similar women also earn less when they work in more sustainable organizations. Now, in the next step, what we do is we explore the cross-section and time series of this sustainability wage gap. Okay, and so focusing first on the cross-section of talent, because I think there are reasons to believe that perhaps the most talented individuals have even stronger preferences for working for sustainable organizations. Okay, and so we do so by simply including an interaction term with between the sustainability measures and our measures of talent. And then we also explore the time series of this effect by including triple interactions. Okay, so looking at between our sustainability measure, talent measures, and the linear time trend. Okay, so to see whether this sustainability wage gap has become more important over time for the most talented individuals. Now, we think these tests that explore the cross-section and time series of the sustainability wage gap are important for two reasons. So first of all, we think that the hypothesis of whether the most talented individuals care even more about sustainability is interesting in its own right, because this carries very important policy implications for firms, right? So if firms can attract the most talented workers by giving them purpose, that's an important insight for firms. However, we also think that these tests exploring the cross-section and time series are important from an identification perspective. Okay? Because in these regressions, where we compare workers within the same firm, allows us to control for firm fixed effects. Okay? Now, we think that these tests exploiting the heterogeneity of these effects are also important, because any alternative explanation would also have to explain such heterogeneous effects. Now, what do we find in these two regressions? Essentially, we find that the sustainability wage gap is even larger or more pronounced, so in absolute terms, for more skilled individuals. Okay, so for university degree holders and for individuals that are in the highest skill group. Okay, so essentially among the 5% of workers with the highest cognitive and non-cognitive skills. We also find that this gap, or the sustainability wage gap for the highest skilled individuals, is increasing over time. Okay, so it has become more important over time. Now, when we look at the mirror image, so whether sustainability allows firms to attract and retain the most highly talented individuals, we also find evidence that the most talented workers are more likely to work in firms operating in more sustainable sectors. And they are also more likely to stay with their firms. Now, in the couple of minutes I have left now, I think 3.5, I'd like to talk a bit about identification. So we acknowledge that we don't have any exogenous variation in the form of a natural experiment or an instrument for our sustainability measure. However, we do control for important dimensions that are likely to have a first order impact on wages and that are typically unobservable to the researcher. So specifically, we can control for occupation year fixed effects, essentially comparing two individuals in the same occupation at the same time, but in two different sectors. And we can also control for the cognitive and non-cognitive abilities of the workers, which are arguably some of the most important determinants of wages. Now, as I said, we also study these heterogeneous effects, right, using these interaction terms. And we think any alternative explanation would also need to explain why the wage gap is more pronounced for the workers of the highest skilled and why they are increasing over time. Now, let me finish with a couple of additional tests that we carry out in this paper. So first of all, we control for other industry characteristics that might or might not be correlated with sustainability. So for instance, we control for firing risk. Okay, so the percentage, or let's say the likelihood that an individual loses his or her job at the industry level. Okay, we also control for health risk by looking at hospitalizations and sick days in the industry. And we also control for whether the sector is very compatible with family outcomes, okay, by looking at the extent to which workers in the industries are married or have children. So including all of these controls doesn't change our conclusions. Now, as additional tests, we also focus on a sample of full-time workers, okay, because the tests before included both part-time and full-time workers. And we also restrict ourselves to occupations that exist in all industries. Okay, so essentially occupations that allow to more easily move across sectors. Again, our findings are robust to these tests. We also control for omitted factors at the worker level. So we estimate some specifications that include worker fixed effects. However, we think that there are methodological problems with this specification because switching sectors is not necessarily random. However, in these regressions, we still find a significant sustainability wage gap. And then we go on and study cases where one could argue that the job switches are more exogenously induced, okay, by looking at job switches due to bankruptcies or large layoffs. Again, the sustainability wage gap is robust to these alternative tests. So I'm almost out of time. We also use standard ESG scores as our sustainability measure, as a robustness test. However, as these and find a significant sustainability wage gap. However, these measures are only available for publicly listed firms and in most recent periods. Let me quickly conclude. So I think we provide evidence that employees value to work for environmentally sustainable companies and accept lower wages. So we think our research has very important insights for firms' competitiveness, given in particular because the sustainability wage gap is strongest for the highest skilled workers and is becoming more important over time. And so perhaps an important determinant of attracting millennials in Generation Z, which have arguably stronger sustainability preference. Now, we also think our research carries implications for firm value, which we discuss in the paper. I'm a bit over time. Thanks a lot for your attention, and I'm very much looking forward to the discussion and your comments and questions.
Very good. Thank you, Philip. The discussant is Mark Rowe from Harvard Law School. Mark. If you would like to share your slides.
Let's see if I can click on the right thing. You should see some perfect slides now.
Yeah.
Okay.
That's perfect.
So thanks, Claudia, and thanks to the organizers and Philip for having me here as a commentator on this paper. It's a very nice paper, and one of the reasons for the thanks, I might not have read it as carefully had I not been set up to comment on the paper. So the thesis, as you just heard from Philip, is sustainable firms are going to save on their labor costs, particularly save on the labor costs of their most skilled employees. And this idea, in some form or another, has been around in the sustainability literature and thinking and among sustainability activists for a little while. What Philip and co-authors have done is they found a nice treasure trove of good data from Sweden, where they can test a lot of the things and a lot of the alternative hypotheses, possible omitted variables, and eliminate or reduce the likelihood of several of the most important ones. So there are surveys about intentions. Do you really believe in sustainability? People can believe but not put their money where their mouth is. The authors are able to tie some aspects of intentions and beliefs with dollars on the line. What is the salary? Some other potential omitted variables that would probably occur to many people when looking at the project are the sustainable firms attracting less capable employees and then paying them less? Well, they've got some good information about cognitive ability, and they didn't call it social skills, but non-cognitive skills. They've got some good data on this, and the indication is these employees are not less talented. If anything, they're more talented. So what they've also got is they've got some nice independent evidence on cognitive and non-cognitive skills, which can significantly, largely eliminate this, reduce this as a probability. So, for management people, there's also a potential message here. Sustainable firms are going to do well. They've got better cash flow, and a lot of that cash flow is coming from paying high quality employees less than they would have to pay if the firm were less or not sustainable. So the simple message for management is there's an opportunity out there. Become a more sustainable firm, and it's not going to be just the cost structure of sustainability, but the saving structure of reducing your labor costs. And this could end up being a not a cost sector, but a profit opportunity. So the interpretation, the author's interpretation makes a whole lot of intuitive sense. People get significant value from their associations. And if the association is one that people truly prefer, they'll put their money where their mouth is and take a lower salary, even though they're productive. And there's a whole series of concentric good news messages. It's better for the employees. They're happier, even though they're slightly less well paid. It's better for the firm. If enough firms do this, it's better for the environment. Among sustainability activists, as I'm reading some of the literature, the tone of the paper might not be as positive as some of the sustainability activists would like it. In that the channel that's making the sustainability work for the firms is lower wages. And for some, I think, significant portion of the sustainability movement in the United States, the goal is we want the firm to be sustainable, and sustainability, whoops, sorry about that. And sustainability means better wages, not worse wages. Now, Sweden might be different from the United States on this. And the relevant employee base that Philip and co-authors are looking at are mostly professionals, talented workers. They're not minimum wage, $7.25 an hour employees. But still, the overall tone in some significant portion of the sustainability activism in the United States is this isn't going to be built on employees' backs. It's going to be some sort of a win-win situation. And if it's anybody who pays, it's not going to be employees. So just to sharpen the tonal aspect of this, doesn't take away from any of the findings. I think a lot of sustainability people would be unhappy with this result. That the goal is, well, if the firm looks more carefully at its supply chain to pick out bad inputs who are exploiting employees in a nasty sort of way, they're going to get a better, more stable supply chain. Not that the workers are going to be part of those who are going to pay for the sustainability. Or the value is going to come from Patagonia being able, because it's a sustainable, environmentally friendly firm, being able to charge a premium price to well-to-do consumers and not a hit to workers' pay. And if anybody pays, it's going to be capital, because sustainable-oriented investors are willing to take a little bit less on capital returns than they would otherwise. And the message could be, a positive one for the analysis, which is there's no free lunch. Somebody has to pay for this somewhere along the line, and it works out that there are talented employees who are willing to essentially pay for the environmental friendliness of the firm. Some alternative possibilities to work out that to eliminate, and that maybe the data would allow them to be eliminated. One possibility is, are there just a lot of millennial workers with high IQs, high skills, so they take a lower wage? Is there a supply issue going on? There's also, talented workers in the paper prefer sustainability more and are more willing to accept lower wages. Seems plausible, but you kind of wonder whether the talent correlation with sustainability, how strong it is. That is, a lot of people have preferences independent of their talent, and you could imagine just that preference for sustainable firms is independent of talent and hence pay structure. It just works out very nicely for the paper that there is this correlation. Seems to be some causality aspects, which the paper picks up quickly and deals with. Good firms seem to share the wealth. And one possible reverse causality issue is firms that have good results are willing to spend some of their results on more sustainable operations. And here the authors have a nice sharp response. This shouldn't result in lower wages, and it seems to be resulting in lower wages. If it's sustainability that's if it's good results, firm with rents, that's causing the sustainability, well, that shouldn't hit wages. It may even lead to higher wages. There's a significant literature that firms with rents end up paying higher wages to their employees, and this is the reverse, suggesting that the good results are coming from the lower wages. They might be able to get at this a little bit more specifically. They've got some HHI data, and while the IO people say HHI, the index of concentration, is not the be-all and end-all of understanding whether we've got market power and significant rents, it's a beginning, and the data's there. Perhaps they've run it. So it could be interesting to check what's the market structure of the industries in which the wages are lowest and the sustainability is highest. Are they firms with high rents? And if they are firms with high rents, there might be more work to exclude that as a driver. There's another aspect of this, which I'm not a partisan of, but it's a significant aspect in this literature. And the other aspect is what could be happening is we're simultaneously getting firms or sectors that have noticeable monopoly and monopsony power. So monopsony could be doing some of the work that the authors are finding in terms of lower wages. So you can see the bare bones version. Firm or an industry is monopolistically organized, oligopolistically organized, and it's able to garner significant rents because it's monopoly organized. If the market power extends to the labor market and it has a monopsony or some monopsony power, then it could be simultaneously raising the price of its product and lowering the cost of its labor inputs. Now, I'm not particularly sympathetic to the monopsony explanation that's been running around in the United States. I think most of it is explained by a loss over the last 2 or 3 decades of labor rents for different reasons. But the idea is out there, and it's persuaded a lot of people, and it looks like the authors have some of the data that could test this this alternative. But just to give it another slight spin, if there's monopsony power in a lot of the tech industries because, say, there are just a lot of people who only want to do tech and can't do anything else, well, in the labor economics, there is frequently a surplus from matching the employee's skill with the firm's needs. That gets split in different ways in the labor literature. If there's a monopsony firm, that surplus is going to be disproportionately obtained by the firm and not by the employees. So one thing to eliminate. A question that I had running through the paper, maybe it's there, I didn't see it, is just as informational. What's the size of what's going on? Is there a way to ascertain whether each dollar of savings in employee costs leads to $1 in profit or $1 in sustainable expenses? Or is there a gap between the two? Is some of the employee cost savings being lost somewhere? By one, and I have it here, very, very back of the envelope calculation, the amounts are potentially that the paper is uncovering are quite large. So in the median firm in one set, 1/3 of the costs are in wages. The paper, Philip's presentation actually undersold some of the findings, and some of the findings are that the wage savings are in the order of 10 to 20%, not just 10%. Little uncertain as to whether they're for all employees in the industry or the firm, or only the targeted talented. But take it if it's all, and Philip will know whether it's only half or some fraction. But if it's all, that means the firm is losing 3% to 6% of total costs are being reduced by being a sustainable firm that can pay employees less. 3 to 6% of total cost is a substantial amount, on average, whatever, 4.5%. For firms that are selling things and making profits of 5% of revenues, this is a very big number. And so one of the curiosities coming away from the paper is it really this big? Is it a smaller number? If it is this big, where is it going? How much is going into sustainable expenses? How much of it is going into increased profits? How much of it is being burnt up along the way? Package deal. And the authors, I call it a package deal, the authors have a different vocabulary, are employees taking a lower salary because they're getting other benefits elsewhere in their employment package. The authors have a bunch of things, job turnover, productivity and the like, that are suggesting that the employees that are taking a lower salary are not making it back elsewhere in their package. Still, you could think of some things that don't get that aren't tested. Is it hours worked? Are people getting, are able to work in the sustainable industry 40 hours a week instead of 50 hours a week? Is the nature of the firm different in a way that is privately beneficial to the employee? And here I'd want to talk about this for a minute or two. So does environmentally sound mean good for me as somebody who lives in the neighborhood but doesn't work at the firm? And does it also mean good for the employees, but not in the social psychological sense of feeling good about working at an environmentally sound firm, but working atmosphere? And by working atmosphere, I don't just mean the interpersonal relationships, but the atmosphere itself. So if you're working at an environmentally sound firm, you're less likely to have to breathe in the fumes of an environmentally unsound manufacturer. So Phil put this up, let me put it up again. So the sustainable firms, the 10 most sustainable up on top, the 10 least sustainable on the bottom. And let me highlight a little bit. So for the sustainable firms, education, physical well-being, maybe that's working at a gym, recreation, sports activities, cultural activities, R&D, human health, medicine, I guess, legal, accounting. So these are sustainable industries. The bottom 10 for sustainable, the least sustainable industries are disproportionately manufacturing and mining, extraction of crude petroleum, mining of uranium, manufacture of textile, manufacture of chemicals. You could imagine that among people choosing their job, they look at firms in these different sectors and they say, well, if I go work at a firm, a manufacturer, look at all that stuff that I got to breathe in every day. There's a potential sustainability benefit in that the firm pollutes less, but at least I could imagine some employees saying, I don't care about what happens to the environment, global warming, climate change, or the like. I just don't want to breathe that stuff in when I'm working from 9 to 5 or 8 to 6. And this, I guess, potential omitted variable, it correlates with environmentally unsustainable firms but the motivation could be different. It's not that I feel good socially and psychologically working at a pro-social ESG firm. I just feel good for my own selfish sense of, I don't want to breathe this stuff every day. It has a potential social benefit in that I demand a premium wage, which makes, internalizes a little bit of the externalities, but it's not my principal motivation. Instead, what I'd rather do is work in the environment on the right, and I don't ask for a premium wage if I'm working in the environment on the right, because a clean workplace is the kind of workplace that I want. At least possible, and probably something to eliminate from the as one of the possibilities. Do some people just like a clean work environment for its own selfish reasons? Few other things. This just with words. So the 10 most sustainable industries are including education, social work, health, veterinary. So, here we are today, educators, and I know I can't speak for everybody in the Zoom room, but when I was thinking of whether I wanted to become a professor or not, mostly the thought was, and I suspect this maps onto the thinking of a very large portion of the people on the Zoom meeting today, was not that this is a sustainable industry, but if somebody's actually going to pay me to read books, write a little bit, and then go talk to colleagues and students about what I've just read, I can't believe that people will actually pay me to do that. And it's just a superior job to, my next best in terms of skills, which is probably working in one of those factories. So, question: is it a taste for this kind of work as opposed to a taste for ESG? It might be very hard to untangle. Another question, which really isn't needed for the paper, but it's just something that I think will occur to readers' minds when going through. It looks like there's a lot of demand for ESG-oriented workspaces. People want this, and want this so much, the paper is saying, that they'll take a pay cut, which then raises this question: why is it that we don't have mandated ESG results? That is, for a fair amount of the corporate effort to do more ESG is a sensibility that environmental regulation is not as strong as it should be. But if there's so many people who are willing to take a pay cut to be associated with a firm that's doing ESG, what's holding the polity back from simply mandating more of that ESG? Is it old people who aren't ESG oriented, who are forming enough of a political roadblock? Is it something else that's going on? There seems to be a too low a response in the polity for what seems to be a high response in the workplace. A couple of other questions which are really going beyond the paper. It's not something the authors have to handle, although it comes up here and there. External validity. The main evidence is from Sweden. Question is, does it travel outside of Sweden? It's very plausible that it does, but maybe Sweden is different. Maybe the social and value system of Swedish professionals and people with talent is different. Other possibilities that other Swedish institutions are different. I can think of a couple that might have an impact. I'll tell you what: marginal tax rate. So, and here, I'm not a tax lawyer, and I did not consult the actual tax sources. I just went to online sources. Marginal tax rate in Sweden seems to be in the vicinity of 60%. The marginal tax rate on income in the United States is in the vicinity of 40%. And it looks like the higher Swedish rate kicks in faster than the higher US rate. So here it's approximately a 20% difference. So if I'm working in Sweden and thinking, am I going to give up some of my salary for ESG benefits, either personal or public, I calculate that that's only going to cost me, depending on my salary, 40 cents of each dollar that I give up after taxes. In the United States, it's going to cost me 60 cents of each dollar. And closely related to that is, and here I may just not have a good enough sense of Sweden. I'm extrapolating from other European countries. That provision of public social value is greater in a lot of other countries than in the United States. In the United States, you kind of got to get it into your take-home pay, or you don't get the benefit. In a lot of other European societies, you can get that from public provision. Stable. Is the result stable? There's a related paper in the legal literature that might be worth looking at. It's a very similar thesis by Barzuza, Curtis, and Weber, which is along the lines that younger people now in the United States are much more attuned to climate change. And in their thesis, they're bringing it to their investment portfolio. And these two papers fit together, I think quite nicely. A question that occurs is, how permanent is this? In that millennials, younger people, their value system might lead them to take a hit to their investment returns today. That's the Barzuza, Curtis, Weber thesis, or the thesis of this paper, take a hit at the office in terms of salary, but for similar reasons. It's their value system says, I'm just not going to be associated with a polluting firm. Question is, how stable is this over the next several decades? When the millennials finally have capital of their own, will they not reverse their priorities, but change their priorities? And so things that were deal breakers when they were 26 are just considerations when they're 46. I don't know. If they do change their values, it wouldn't be the first generation that did that. Looking around at the faces on the screen, I see Henry. I see a couple of other people that I see Jeffrey Gordon of the 60s generation. But there was certainly a sense in the 60s that as soon as we're in charge of things, the whole world will be different among a lot of my peers. Well, the 60s generation grew up and didn't really change things. And it's more the 60s generation that changed than that the world changed from the value system of the 60s generation of their values in the 1960s. Is this going to be true for the millennials and Gen Zs that are part of this paper? I don't know, but at least put a question mark there. So conclusion, I think they get a lot of stuff that's important in that they drill down deeper than I've seen otherwise on where ESG value is coming from. They've got a good set of data. They're able to eliminate or reduce the likelihood of several alternative hypotheses. Interpretation, as I said at the beginning, it's not the goal of at least one substantial segment of sustainable activists to make employees pay for the sustainability. People want it to come out of something, to be paid for somewhere else. And what the authors are finding is kind of a no free lunch story, which is it's being redistributed from employees with high environmental tastes in their interpretation to environmental betterment. Alternative to look at is that while this seems to be some of the effect in that we're getting less of this because employees are willing to take a hit and pay for less of this, it might be that at least some of the employees, maybe a lot of the employees, are just looking to avoid this, a personal cost, and prefer a different, cleaner work environment for themselves, regardless of what they think about for the rest of the world. Thank you.
Thank you, Mark. Philip, would you like to respond? And
I would like to respond
we have a few questions.
So I'd just like to respond by thanking Mark for this great discussion. I mean, it's like I can't respond to all of the points, and I mean, obviously, it would be great if you could send us the slides, and then we can digest all of these comments. Perhaps I just pick one of them. I mean, it was also the last one you brought up about this motivation, right? The selfish motivation versus the altruistic motivation. I mean, it's true that we cannot really distinguish that, but I think it's not necessarily important for our paper, right? To ultimately explain why they choose to work for more sustainable companies or in more sustainable sectors, right? I agree that it might be different from an interpretation perspective, but I think it's not. I mean, whether you decide to work for Patagonia, because you want to work in a nicer environment, or because because of selfish reasons, or because you think that Patagonia is a great company that furthers environmental sustainability. I mean, yeah, of course, we don't know, right? But I think for us, it's not necessarily a problem. I mean, a lot of your points, they're great, and we'll discuss them, or we'll see what we can do. I mean, there's obviously things we cannot do, and we will acknowledge that. And yeah, thanks a lot for the discussion. Maybe some questions.
Yeah, let's perhaps get some questions from the audience, and I'll just collect the questions, and maybe you can just wrap up by answering.
Yeah, I can
them together with
maybe from the chat. Maybe there was Holger Sparman. So it's right that it's correct that our measure is an industry measure, but we also have tests with traditional ESG scores at the firm level, and we get similar results there. So I guess in terms of the management implications, I think the firm level evidence, which I haven't presented today, would be more relevant, but we find similar effects there. Now, we don't use that measure in the main tests because it's a much smaller sample because of being limited to publicly listed companies. Now, Tobias, he asked about the population of survey subjects. This is something we're looking into right now. We want to redo the survey, using sort of a broader population of individuals, and perhaps also getting at that question of the correlation between talent and preferences for sustainability. Maybe to pick up one other comment from Mark's discussion, we're also thinking about more things we can do to control for at the industry level, right? I mean, kind of to rule out alternative explanations. Now, the point by Varghese on lower wages in sustainable industries is the expectations for higher wages in the future. This is also something we discussed, and we're currently thinking about how to address it. It's a possibility. Historically, we don't see that, right? In the whole sample. So we don't see that. Let's say let's say individuals who start out working in a sustainable sector, in the future, kind of get ahead of in terms of wages, in terms of the unsustainable sectors, right? But there's probably more we can do there. Maybe some other questions. Oh, sorry, there's still other questions.
Yeah, maybe we can go Charlotte, then Nick, then Roberta. I'm just following the order on my screen.
Yeah, please go ahead.
Charlotte, do you want to ask your question?
Yes, thank you. Thanks. Interesting paper. But there was one thing I wasn't sure how to think about, right? So you're asking the question whether people are willing to work for less because they get these non-pecuniary benefits. But how should I think about, how do you guys think about people's outside opportunities? Because what I had in mind was that, so if you have a finance degree, you can find work in many different sectors, including the finance sector, which pays quite a lot, right? But if I have a degree in education, it's going to be much harder for me to find work in the finance sector or in the manufacturing mining sector, right? So it seems to me that there's something about outside opportunities and where you actually can choose between different jobs that is really hard to think about, in particular in the part of the analysis where you're sort of focusing on industries rather than within industries.
So I agree with you, but I think we can get at that where we restrict ourselves to certain occupations that are more transferable. So we have like some tests where we look at how dispersed is an occupation across sectors. Okay, and then we limit the analysis to those occupations that are highly dispersed, right? Where you would think that people can move across sectors, right? So and then we still find that let's say an individual working in like a job like a secretary, for instance, still earns less in low sustainability versus a high sustainability test. So I agree, maybe in the baseline test, outside opportunities play a role, but I mean we control for these occupation fixed effects, and then we even restrict the sample to those occupations which we think should be like where there's a lot of outside opportunities. Hope that answers the question.
Nick, do you want to ask your question now?
So Philip, great paper. Basically, I had the same question as Charlotte, but I have a different suggestion. So maybe you can, instead of using occupation, maybe you can focus on skills, in the sense that there's some papers that, for example, use, let's say, IT skills, management skills, and so on. Some of them, like IT skills, are very transferable, while some other skills are not. And so there's some categories and some classifications which make it quite easy. And it's, I think, slightly better than occupation, because the type of occupation might be the same, but actually it's the skills that may vary. And so that could be just
an interesting point, right? I mean, like using the talent distribution, but like I probably also would have to explain the whole like occupation fixed effects a bit better. I mean, they're quite granular. They might actually capture something like IT, and it's true. Like instead of taking sort of a kind of an agnostic view, just looking how they are dispersed, one could actually look at let's say like along your lines, which are occupations which are very transferable, and then use it as
something. Yeah,
that's a nice suggestion. Thanks.
Roberta, do you want to go next, please?
So I had a suggestion. So I was concerned, similarly to one of Mark's point about the riskiness, since the top 10 and the top 10 in both sections, there's a big difference in risk. You could sort of put something in like what for your public companies, stock volatility. If you have accounting data for the private and the others, you could look at the riskiness across time of their return on assets or things like that, and to control for that, because one would expect if the sustainable industries are less risky, their salaries presumably would. Lots of papers look at a risk. You could also maybe just use Viscusi's risk premium and how that compares, because he had this data about riskier industry people got higher wages.
That's a good point, but maybe I should clarify as well. Now, we have controls for the industry level risk, right? We look at accident rates, and hospitalizations of the workers at the industry level, time varying, right? And so I guess that's like an even better measure for risk, right? I mean, and actually, I think that also addresses kind of a lot of these points on, do we prefer a safe versus, an unsafe work environment? And we have these as controls, very granular controls, right? How many.
So do you, how does that difference, the 10%, how does that compare to the premium of Viscusi's work and others, right? For those,
I mean,
even if you're controlling, you might be putting that in as a variable, but that's still not telling you the magnitude of your differential and how that compares to what they would get if you.
So you're thinking about like interaction, you're thinking like of an interaction effect then, right? I mean,
yes.
Yeah, we could look at that. But I think like the important point here is that essentially the premium in itself that we calculate is almost unchanged when we control for, sick days, hospitalizations, kind of.
Right, I understand that, but I'm just saying, sort of, I think that was the magnitude you're finding was about the magnitude of the risk premium in Viscusi's work, although I haven't looked at it, I didn't relook at it.
Happy to.
And so that would be the thing that you want to.
I completely agree. So I think we can do a lot more in like looking at these interactions and like how does it compare to other industry characteristics. So I'll be like I didn't catch the name of that reference.
I'll put it into the chat. KIP
Awesome.
Viscusi.
That's awesome. Yeah, so we'll have a look at that. Thanks.
Fantastic. Philip, I think there's just a couple of questions from not the panelists, but the participants. So David is asking, I wonder if in addition to the positive pro-social aspects of ESG, you may be observing fear of cancel culture, fear of being associated with a stigmatized firm or industry, and then would it be possible, so that's Mustafa, would it be possible to assume some of the results being driven by selection bias, the population surveyed are subject to fairly similar admission process?
I'll do the second one first. I mean, one could think so, but I mean, we're looking into this, right? Using different survey populations. Personally, I don't think it's going to move much, but I mean, it's a point we don't know yet. Yeah, of course. I mean, David, it might be some of this, but again, I think that's not necessarily a problem for us, right? Because like let's say workers, because they don't want to be stigmatized, be working in these industries, they don't select into them, right? I mean that's kind of the point we're trying to make. So I think as it kind of echoes a bit the comments of Mark, why is this? Because individuals don't want to breathe, unhealthy air at the workplace, or because of altruistic motivations or other motivations. I mean, that's a super tough question to get at. I think what we're trying to say is that, look, if you look at revealed preferences, of individuals, I mean, they seem to be selecting in these kind of ways, right? So, why they care about this? I mean, we don't want to go there, right? I mean, it's super difficult to answer, but I mean, it seems to be the case. Just looking at archival wage data, that people select in these ways, and accordingly earn lower wages. I think that's maybe I didn't highlight this enough. So this is kind of the main point we want to make here.
Very good. Thanks so much, Philip. Well, and I would like to thank all of the presenters and all of the discussants and the participants for the great session. We have a break now, and Elaine was asking me to tell you just to make sure that we will all be back at 4:15, and then I'll handle it to Roberta, who's going to chair the next session. So 11 minutes break now. So thanks everyone.
Hello, Mark.
Okay, welcome back everyone to our session starting at 11:15. I think I see at least the number of participants is increasing rapidly. So I am going to turn our session over to our first paper. The presenter is Charlotte Ostergaard from BI Norwegian Business School. Charlotte, you have till 20 minutes is 11:35. Please
Okay,
share the
sounds
screen
good.
with us and start.
Thank you very much. Let me just find my slides. Okay, so thank you very much for having us on the program. I want to start by just introducing my co-authors on this paper. So it's Irina Kocek, who is a former PhD student at BI. She's now at Nord University. And then Amir Sasong is a colleague of mine at BI. So in this paper, we're going to look at successors in family-owned firms. And in particular, we are interested in the performance by these successors after they have taken over, and comparing that performance to the performance of the firms before they took over. So it's sort of well established now that family-owned firms prefer to have somebody from the family run the firm on a daily basis. So they typically have CEOs from that come from the controlling family. And when it comes time for that CEO to retire, it's also well known that a lot of family firms have preferences for having an intergenerational succession. So they want to pick a new CEO that comes from the controlling family as well. But there's a group of papers that shows quite convincingly that that such family successors tend to underperform family firms that choose to go with professional CEOs. So you can think about it in terms of the father-son sort of succession. That's sort of the easiest way to think about it. So this means that families that choose the son to succeed the father, those sons actually perform worse than families that, instead of choosing somebody from the family, go out in the market for professional CEOs and hire somebody unrelated to the outgoing CEO to continue with the firm onwards. So the effect that I think most people have in mind when they sort of think about why this is what you might want to call a small pool effect. So it's obvious that if families have preferences for picking new CEOs from within the family, the pool that they have to choose from is really not very large, right? Compared to if you go out in the market for professional CEOs. So almost statistically or mechanically, you're likely to pick somebody of inferior talent. So in this paper, we're sort of building or digging deeper below this finding. So what we show in this paper is that the underperformance of family successors relative to professional CEOs is really entirely driven by what we call inside family successors. And what we mean by inside family successors is successors who come from the same family as the outgoing CEO and the controlling family, but who has worked in the firm or who works in the firm at the point in time in which he's recruited to take over the reins. So inside family successors are successors that are picked from within the firm. We show, perform inferior. They perform inferior compared to outside family successors, which are successors that also come from the same family as the outgoing CEO, but who work outside the family firm at the point in time in which they're picked to take over. And we show that these outside family successors perform as well as professional CEOs. The second thing that we document is that in our sample, at least, inside family successions are extremely common. And actually, these inside family successors have quite little work experience outside the family firm on average. So let me give you the setting. So we're working with Norwegian administrative data. So from the population of Norwegian firms, we identify all family firms that have CEO transition. And we have a 15-year, we have data we look at CEO transitions in family firms from 2005 to 2011. In our paper, a family-controlled firm is one where the outgoing CEO's family owns at least 33.4% of the shares. According to Norwegian law, that gives them a negative majority. So that means we allow for family firms that have minority shareholders. And another important criteria of our sample is that we make sure that the outgoing CEO's family, which is also the controlling family, retains control after CEO transition. So those CEO transitions that are associated with the family selling out part of their stake below this threshold or selling out completely, those successions we throw away. So we only look at successions in family firms where the family has control before and after. So when we compare these two CEOs and we're trying to figure out whether the incoming CEO is related to the outgoing CEO, what we count as family or relation is anyone who is a spouse of the outgoing CEO, who's a sibling, a parent, a child, an in-law, a nephew, an aunt, an uncle, or niece or cousin. So we have sort of a quite wide group of people that to choose from, or that may potentially take over the reins. So we look at transitions from 2005 to 2011, but we actually have more data than that. We have data starting in 2001, going all the way up to 2015, so for a 15-year period. The data we have is accounting data for the firms, and then we have a bunch of socioeconomic characteristics of the incoming and the outgoing CEOs and their families. And we do this on purpose because we're going to be looking at changes in performance. So we want to have 4 years of accounting data on each side in order to make sure that the changes in performance that we estimate are actually kind of permanent changes. So we don't want to sort of have the results be, influenced by 1 or 2 years that have sort of very high or very low performance. So in total, we find 2,579 successions in family-owned firms. And 69% of those are family successions. So that means the incoming CEO is from the same family as the outgoing CEO. 31% are professional successions. So the family goes out and picks somebody who's unrelated to continue the management of the firm. And our first result is to discover that actually in these family successions, the vast majority of successors are these what we call inside successors. That is, they already work in the firm at the point in time in which they take over. So a whole 70.5% of family successors are inside successors. 29.5% are outside successors. I should say here that our definition of inside-outside is sort of based on a threshold 3 years prior to the time the CEO succession takes place. So what we're asking is basically, where was the successor 3 years in advance of taking over? Was he inside the family firm or was he working somewhere else? And we want to have this gap because what we don't want is that we don't want to categorize somebody who works in a different firm and then comes home and works in the family firm for a year and then takes over. We don't want to categorize him as an insider. So to be a meaningful inside successor, you have to have been in place at least 3 years in advance of taking over. If we look at the kind of successions that take place in this sample of family-controlled firms, if we look at the insiders first, we can see that most successions are actually parent-son, and in fact are going to be father-son successions. 58.7% are parent-son successions. In fact, 44.3% is parent-oldest-son successions. If we look at the outside successors, parent-son successions are also the most frequent type of successions, but they're a relatively smaller group, 47.1%. Parent-daughter successions have about the same frequency in both subsamples. What differs is that in the outside successor group, there are more partner successions. So that means the outgoing CEO's partner comes in and takes over. And if we then look at the past work experience of these successors? What do they actually look like? So I'm going to show you here the data for son successors, and that's because, for reasons that I'll mention later, most of our regressions we actually run on the sample of these groups here where you have parent-son successions only. So what we can see is that in our sample from 2005 to 11, which is our regression sample, inside successors have on average worked 6.7 years in the firm before the time they take over. And only 20% of them, as far as we can see in our data, have formal work experience outside the family firm. Outside successors, of course, by definition, all of them have work experience outside the family firm. They have on average 2.3 employers. Insiders have on average 0.4 employers. And actually only 18% of outside successors have formal past employment in the family firm. On average, that employment lies 6.3 years back in time, and more than half of it was part-time. Now, we have an issue with truncation, right? Because we can only go back we only know where people were employed back to 2001. So we're worried a little bit about truncation here. So what we do to sort of double check this pattern up here is that we look at those CEO transitions that lie after 2011. So those that we're basically not using because we want to have these 4 years of accounting data to estimate performance. So this sample down here, they are giving us data 12, 14 years back in time. And when we look at this sample here, what we see is actually that inside successors have worked on average 10 years in the family firm before they take over. Now, there are more of them that have worked outside the family firm, but it's still only 33%. The outside successors, there is still only 18% of those that we observe having past formal employment in the family firm. We also look at other characteristics. I'm going to highlight age here. So if we look at the outside successors, what we observe is that those of them that have had past employment in the family firm, they leave the family firm at about age 26 and they return at about age 35 on average. Insiders take over when they're a few years older, 37, 38. So that means the first takeaway is that really a large majority of family successors are recruited internally and they have remarkably little outside work experience. In fact, in our sample, 2/3 of inside successors, we cannot observe them having worked anywhere else. And this, of course, raises the question of why are you positioning successors so early in the firm? Why are families doing that? We can think of two reasons. So the first one has to do with that maybe this is something about fostering identity or loyalty to the family and its business and the idea of the family and what it is. So there's a lot of anecdotal evidence that children of business families feel a lot of pressure and guilt if they want to work outside the family firm. So that could be one explanation. The other explanation is a more economic explanation. That would be something about, well, that if, so there's one school of thought that think that intangible skills and assets, firm-specific intangible skills and assets are sort of the competitive advantage of firms. And if that's the case, then you can sort of see why you want to place your successor in the firm well in advance of taking over, because you need to transfer these intangible skills and assets to him, right? In fact, there are several papers in the family firm literature that argue that family firms have a comparative advantage in transferring such assets and skills exactly because the transfer occurs between members of the same family. But that explanation would also dictate that inside successors perform superiorly to outside successors, and that's not actually what we find. So here is our result in a nutshell. We look at different performance measures. I'm showing you here the annual growth rate in operating revenue, and basically what we find is the following. So when we look at so date 0 here, that's the time of CEO succession. And what we observe consistently across different measures is that inside successors, their performance deteriorates in absolute terms. Whereas outside and professional successors, their performance improves, or statistically speaking, it stays at the same level. What is, I should say first actually that the negative number here doesn't mean that the outside successors take over firms that are operating with losses. The performance here is industry and year adjusted. So this means that outside successors tend to take over firms that are underperforming their industry peers. And it's sort of clear that that treatment designation here is probably not random relative to how well the firms are doing, right? So there's some kind of level effect going on here. So when we run our regressions, we're going to be working with a firm level panel, and we're going to be estimating firm fixed effects. So these firm fixed effects, they're going to be taking care of these differences in levels. And what we're going to be looking at is we're basically going to be estimating the average level of performance after CEO transition. And then we're going to be comparing that to the average performance level of a given firm overall in the sample. And then we're going to be testing whether there is an uptick in the average level of performance. So what we're estimating in the regressions is the changes in average performance. And this also explains why we want those 4 extra years of data on each side. So just to give you a few coefficients. So you can see here, so this is the regression that corresponds to the picture I just showed you here. We have the annual growth rate of operating revenue. And what we estimate is that inside successors, average performance drops by 8%, 8.44% following them taking over, whereas outside successors improve by 2%. It's not statistically significant for this particular performance measure, and professional successors improve by 4%, 4.8%. When we then test whether these coefficients are different, what we tend to find is that inside successors underperform outside successors, and that's highly statistically significant, you can see here. Whereas when we compare the coefficient of the outside and the professional successors, there is no statistical difference. So the second takeaway is that inside successors' performance deteriorates in absolute terms. It's not just relative, it's the absolute terms it actually deteriorates, whereas outside successors perform on par with professional CEOs. And actually, I'm not going to show you this on the slide, but if you just look at the magnitude of the difference in the coefficients, it's clear that the difference that the literature has documented previously between family and professional CEOs, that difference is entirely explained by the difference in insider and outsider family successions.
So you have about 3 minutes left, Charlotte.
Okay, so what's the mechanism for this result? Well, the mechanism that we find is very intriguing is this idea of maybe outside work brings you some kind of cognitive diversity, simply more tools in your toolbox. So you can sort of imagine that if you grow up in the family firm bubble, you're going to internalize your parents' beliefs and business norms, right? Whereas if you have experience to a variety of business cultures, you're maybe going to be able to think outside the box a little bit more. So we provide some evidence for this story in the paper. So one thing we do is that we try to look at how much outside work experience do you have? How many employers have you worked for how long time have you been away for the family firm? And remember that insiders have also been away. Some insiders have been away, so we have variation in both groups, so we can do this. And then we find that when we add controls for this, we can kill the significance between the inside and the outside coefficient estimates. We don't remove the pattern, the pattern is still there, but the significant goes away. So it seems that there is some kind of explanatory power here. The other thing we do is that we compare inside and outside professional CEOs, because it turns actually out that half of the professional CEOs are already in place in the family firm by the time they get hired. And you can easily imagine that how a controlling family want to pick somebody whose mindset is sort of loyal to or consistent with their idea of what their business is. Remember that it's the family retains control after the professional CEO comes in. And when we look at these professional CEOs, we find exactly the same pattern. insiders underperform, outsiders grow the business. We also try to control for some various observable mechanisms. So I think I'm going to skip that in the interest of time and just go to the last slide, which is that obviously a thought that one gets here is that, well, there could be something that's unobservable to me, the kind of attrition going on here. For example, something like talent or skill of these successors. So talent or skill would probably not be unobservable to the business community in where these sons operate, right? So what you could imagine is that the most talented children get outside offers. So being an outsider is actually a signal of your inherent talent or skill. So I'm not sure we're ever going to be able to completely rule this out. And there could be more than one explanation for our results, but I'm not sure it matters so much either, because if it's really skill that's driving this, then the lesson from our results are that families should not put a lot of pressure on their kids to work in the firm. They should not try to tie them to the firm. Instead, what they should do is let their kids go out and get jobs outside, and that may actually help you pick the most skillful family member to take over when that time comes around. We do try in the paper to sort of formally see if we can rule out self-selection. So we run some, we have some instruments for insider outsider, that difference, that basically go along this idea that if an industry is very homogeneous, it's going to be easier for you to find an outsider. Whereas if firms rely very much on firm-specific assets, then the pool of outsiders is going to be eligible for taking over in your firm is going to be smaller. So we have some instruments that try to get at that, and we're basically able to reproduce our results. One thing that we started doing now
I
that
think we're a little out of time, so why don't you just
okay, that's fine. Yeah, I'm sorry, I can't see if you were signaling, so I only see the slides, but I will wrap up. Yeah. So families tend to embed successors with the firm early. 2/3 of successors don't have any outside work experience. But outside work experience seems actually to have an independent positive effect on the performance of family successors. And we are sort of interested in this idea about cognitive diversity. Thank you very much.
Thank you, Charlotte. Our discussant is John Morley from Yale Law School.
Hi, thanks very much. And thanks for that excellent presentation, Charlotte. This is a fascinating paper, I think very well executed. I find it convincing, and I don't have much critical to say about it. But I just want to make a number of observations because it's such an interesting paper. So the first is that this paper serves as a reminder to me and people like me that notwithstanding our obsession in the United States with publicly listed companies, family firms are a very big deal, particularly in other parts of the world where widespread public ownership is not so common. Family firms also pose very different kinds of governance problems. In the United States, we're obsessed with the collective action problem in firms with diffuse ownership, but family firms have their own distinctive kinds of problems, which I think are equally interesting. Another observation I want to make is that I don't think I'm crazy. The reason is that I'm one of the few professors in the United States who teaches both corporate law and trusts and estates. And when people say those are divergent fields with no relation to one another, I say that actually in small legal practice, business planning and family succession planning are often one and the same. Many people with modestly sized fortunes have family firms, and when they approach estate planners, they end up getting business planning as well. Another thing I want to observe is just that, wow, Norway has amazingly detailed data about its people. I mean, in addition to having lots and lots of data about the income and assets of very small firms, we also have data about relations among the owners of these firms. It's astonishing, and I suppose it's a signal to those of us outside of Norway to continue using Norway as a laboratory for studies of firm governance. And people in Norway, I think, have been doing this for some time now, but it sharpens my attention to the issue. I want to make one observation that I think will help us understand the data and the results, and that is that if I'm reading this correctly, these companies are mostly pretty small companies. the data, the sample is cut off at the bottom end at firms with total assets, that is with balance sheets of $124,000. So we're talking about very small companies there. And the average balance sheet for firms in the sample is $1.18 million. And because this is an average number that could be affected by, because there's no upper bound on the size of firms, and the lower bound is just at $124,000. When we look at an average number, which of course is very sensitive to the upper bound, that suggests to me that across the full distribution, we're dealing with pretty small firms. And Charlotte can confirm that or not, but that's my basic intuition here. And that suggests to me that what we're dealing with here is not Bloomberg or Purdue Pharma, the family that was owned by the big firm that was owned by the Sackers. We're not dealing with really big firms with complicated governance problems. We're dealing with small businesses here. And that suggests to me, that doesn't invalidate the results at all. It just informs how we interpret them. I think one observation is that in a firm like this, profits can be difficult to differentiate from salary. If we look at the profitability of the firm, that may not be the measure that is most relevant to the people in control of the firm. So consider, for example, my uncle's restaurant. I have an uncle named Joe Morley who runs a barbecue restaurant called Joe Morley's Barbecue in Midvale, Utah. And his son, my cousin Brent, has run the restaurant basically his whole career. And I think in this restaurant, what matters less is the profitability than the total sum of salaries across the firm. And in other words, the principal measure of the firm's success is the salaries it pays to its senior employees rather than the profits it distributes to them. And so if we look at profit-based measures of performance, it can be a little complicated. Another observation is that in firms such as this, it can be difficult to identify the real moment of transition. My uncle Joe is now in his late 60s, and he's not been really deeply engaged in the firm for at least 10 or 15 years. His son basically operates it from day to day. And yet, formally speaking, Joe is the CEO. When then did the real transition occur? I don't know. It's sort of a continuum in which his son Brent became increasingly involved in the firm. And at what point did the transition really happen? I don't know. For purposes of bureaucratic reporting, we can say it was the moment when Joe formally stopped being the CEO. But again, Joe is still the formal CEO, notwithstanding the fact that he ceased to be seriously engaged in the day-to-day operations of the firm years ago. Another observation is that the logic behind having family members join the firm early could have something to do with a complicated process of generational bargaining. Ordinarily, when somebody founds a firm and comes to the end of his involvement with the firm, he'll sell it, let's say, to a non-family buyer. In this case, in this paper, those kinds of transitions are excluded. But that's the basic concept, right? You found something and then you sell it. Well, if you're transitioning it to a member of your family, there's not necessarily going to be a moment of actual acquisition. That doesn't mean, however, that the business hasn't been sold. It just means that the acquisition price has been paid over a long period of time, perhaps in the form of labor. Consider, for example, law firms. Often in small law firms where it's just one guy, he'll sell the practice to a buyer at the moment he wants to retire. And it's possible to identify the purchase price at the moment the practice was sold. But in bigger law firms, when partners transition out, what do they get for having spent so many years building a firm that their successors will subsequently occupy? Well, the answer is they got all of the labor supplied by those successors over a long period of time. And in this sense, maybe Cravath is like a family firm. In Cravath, almost all of the people promoted to partnership and therefore to ownership and senior management of the firm come from inside the firm. And they have no experience working for any other employer other than the firm. And one explanation for that peculiar model of transition is that the process of supplying labor, first as an associate, as an underpaid associate, and then as an underpaid junior partner, is a form of payment for the acquisition price, right? I'm buying the firm. If I'm a junior person in the firm, I buy my position from the more senior partners with decades of underpaid labor. Maybe that's part of what's happening here. I don't know. Just an interesting comparison. All right, so the central challenge in the paper is to discern whether or not what it is that accounts for the connection between inside work experience and subsequent poor performance. One explanation is that, well, family members who don't work outside the firm are less intrinsically capable. Because they don't have the same level of ability, they don't have the same value on the external job market, and so therefore they default to working inside the firm. That's one story. Another possible story is that, well, they have the same, inside family successors have the same level of ability as a natural ability as outside family successors. They just have less valuable work experience. And that's the interpretation that Charlotte and her co-authors adopt of this data. And I think it's a sensible one. But let's just think through how that interpretation is reached to make sure we understand it and what the strengths and weaknesses of that interpretation are. So in order to make the claim that outside work experience is directly causally related with subsequent poor performance, lack of outside work experience is directly causally related to subsequent poor performance rather than merely correlationally related through an intrinsic difference in ability. In order to reach that conclusion, Charlotte and her co-authors use a series of instrumental variables. Instrumental variables is a difficult approach that rarely succeeds, but in this instance, I think it's doing pretty well. They need two categories of instruments. The first is that they need an instrument that's correlated with the propensity to select a family successor over an outside successor. And they use gender. Basically, the logic is that firms are more likely to choose family members as successors when the family members are male. And that has to be uncorrelated with ability, but correlated with the propensity to choose a family successor. An interesting question is, well, is gender uncorrelated with ability? I think the answer is yes. One could argue that in a sexist world, there are factors that might diminish the successfulness of female CEOs, notwithstanding the fact that they might have similar ability. I don't know, but I think it's a good instrumental variable because I think gender is uncorrelated with ability for the most part. There's a second set of instruments that are correlated with the propensity of selecting an inside family successor over an outside family successor. And I think there are three instruments that are used here. One is the partial correlation of a measure of return on assets of individual firms with that same measure for other firms in the industry as a whole. Another is the percent of CEO turnovers in a firm's industry that are filled by outside CEOs rather than inside CEOs. Both of those strike me as being correlated with the propensity for choosing an inside over an outside family successor, but not with the ability of the family successors. And so I think those instruments work. I'm a little curious about the final instrument though, which is education. I think I just maybe don't understand this, and perhaps Charlotte, you could explain. So the instrument here is the average level of education of CEOs in the industry. My concern here is that, I'm not sure exactly how the pattern of correlation is supposed to work here. I think the way it's supposed to work is to suggest that what we need here is a variable that's correlated with this distinctiveness of firms within the of individual firms rather than the commonality of firms across the industry. And it seems to me that education, in its tendency towards universalization, in its tendency towards the production and communication of knowledge that is trans-substantive, that's correlated with the homogeneity of an industry rather than with the distinctiveness of firms in an industry. In other words, a firm with an industry with a high level of education would seem to me to be one in which firm level knowledge is not likely to be specific. That is, in which the industry is homogeneous rather than heterogeneous. In other words, if the kind of knowledge I need to operate this business is the kind of generic knowledge I can acquire from a business school, then this business is not very distinctive or unusual, right? Universities are in the business of communicating universal knowledge rather than local specific knowledge. But maybe I just don't understand how that works, and I'd be curious to know more. In any event, it's a fascinating paper with really important implications, not just for the world, but also for the individuals who operate these family firms. Thanks for the opportunity to comment.
Thanks,
Charlotte, would you like to take some time to respond?
Yes, I see that just 10 minutes left, so I'll just respond to a few things. Thank you so much for your very thoughtful comments here. That was very helpful. I just want to say about the size of firms. So these are not, all mom and pop stores, right? So a lot of those we've gotten rid of. This is always an issue when you work with Scandinavian register data, that Scandinavian economies are simply smaller than the US. So the firms just look ridiculously small, right, to you guys. But I think what we need to do is that we need to document more that these companies actually have employees and so on. So I think that was very helpful. In terms of like what's the real moment of transition, so I think you definitely have a point there, right? Because that must be quite fluent, in particular in family firms. So Norwegian, so in Norway you have actually a register of all firms, and in that register you have to always associate. You have to always indicate who have different roles in the firm. So formally, if there's a change in the CEO, that has to be registered in this particular registry. Who are the board members and so on. So of course, you are right that I cannot know whether the son has really taken over 5 years before they report to the registry that he is now the new CEO. But there is sort of a formal procedure around this, and since CEOs and board members have some legal responsibilities, I sort of hesitate to think that people are completely ad hoc in terms of this. But that's actually where we know what people's roles in the companies are. And then I liked your idea about generational bargaining. So I'll think about that. That was interesting. I hadn't thought about that before. Yeah, and with the education, the idea was basically that if you need an engineering degree or something like very specialized, then that it's not everyone who can sort of acquire those skills. So that was sort of what we were after. But I'll think about your intuition that it actually goes the other way around. So I'll think about that. So thanks for that.
So while we give the audience a chance, I have a couple of questions about your data, so I'll use the prerogative as chair to start off our discussion. And so I have 3 questions. One is, I know you have a control variable for age, and I'm wondering of age of the firm. I'm wondering if you could do something about looking at this in terms of what generation is the succession occurring at? Is this the founder or later? And maybe your results would be even stronger or go one way or the other if it's been several generations or it's the first one. So that'd be one question about maybe using that in your data. Another one was whether or not the outsiders ever worked at if you have data on, did they ever start at the firm and then go outside and then come back? And if that makes any difference in their performance. Like, do you need to know, it's sort of like if you think about in our own context of universities, do you hire an insider versus an outsider as your dean or your president? And you may hire someone who looks like an outsider, but they really were they knew something about your school in the first place. So I'm wondering if that makes a difference in the success of the outsiders or not. And then the third question I was just wondering about, it's not a focus of your discussion, but in the firms that had professional outsiders, right? Did they have any children at all who ever worked in the company? I mean, they might have children, but they never worked in the company. Did they have any? So is this like sort of, they had someone who worked in the company, they decided it's not going to work out, and they had better sense than the families that didn't have professionals? Or is there something about, some firms attract, you can get an outsider to perform and some you can't based on the nature of the family in terms of I mean, I don't, I'm just wondering if there's any kind of issue about selection effect or something like that with respect to the difference in those firms. It was interesting that it wasn't that they were performing poorly and brought an outsider in. Right? The only one that looked like it was going down were the ones who continued to have insider successors. Now, I don't know if that meant you couldn't get an outsider or there wasn't any outsider, but I think that was sort of an interesting thing. Anyway, that's a couple of questions for you.
Yeah, thank you. So we can certainly, I mean, we can't go very far back in time. So in terms of like figuring out exactly what generation it is, as opposed to just using the firm's age, we can't do. But what we can do is certainly control for whether the founder of the firm is the outgoing CEO. So that's certainly something we could do. And then your second question about the outsider. So this is one of the things that we're working on. So you'll notice that the paper is still preliminary. So one of the things that we've got a few more years of data, and some of the things that we're trying to figure out now is exactly what has sort of been the life cycle, so to speak, or the work cycle of these outside successors, and sort of trying to understand better who they are and why they have left the firm. Did they leave the firm in order to take an education, and then they stayed out for some years and then they came back, or how exactly has their cycle, sort of work cycle, developed? So I don't have much more to say about that at this point. With respect to children, so there really isn't differences across family successors and professional CEO successors, whether the outgoing CEO has children or not. So that they're pretty much the same. One thing we noticed is that outside family successors, so disregarding the professional CEOs, but outside family successors, there, in that case, the outgoing CEO, so the father, is more often divorced. And we've tried to think about ways of exploiting that, but we haven't really. So in the end, we can't really use it for anything. It doesn't have a lot of explanatory power for anything. But thanks, I'll definitely record this.
Okay, there was a question in the chat from Callie Jordan. How culturally specific may these results be? What about the role of gender? Would the observation in Asia be different? And here, let me note, there were papers, I apologize, I should have relooked at them before today, about how Japanese family firms adopted sons for their succession issues. And I take it that was maybe a very unique Japanese custom. I've forgotten the results about that. I don't know if there's anyone in the audience who's familiar. I think they did better, but I don't want to assert that. But anyway, maybe you could address Callie's. And I take it we don't have adoption succession in Norway. So I think it was pretty cultural specific.
Yeah, no, so I'm aware of that paper. That's a very cool paper. So I'm not sure if our results would transfer to Asia, because I have a sense that family businesses in Asia have some very specific features. What I do know is that our results are very similar to a famous paper in the QJE, which is where this firstborn gender instrument that John was talking about actually comes from. So there was sort of no way for us not to use that. We had to use that. So there was a very famous paper in the QJE, I think from some years, 10 years back or something, that are sort of the first ones to sort of really, really convincingly document that these professional CEOs perform better. So our paper basically completely validates that result. We find exactly the same. So certainly what I can say is that Norway and Denmark are very similar in that respect. Presumably, some of these effects also extend to Europe and the US, I would guess, because the cultures are relatively similar. But Asia, I'm unsure, also because I have a feeling that you have business groups that operate in a slightly different way. So I simply don't know.
There's a question. Apologize, Varghese. Am I pronouncing it correctly, or please correct me? You need to unmute yourself.
Yeah, since there was a question about regarding, I belong to India. So what I'm going to say is largely anecdotal. So one of the biggest corporation here would be Reliance Industries. So it's again a controlled corporation basically. So it's a basically Ambani family. So the founder, Mr. Dhirubhai, had daughters and sons, and it is his son who has who is the boss there after his this thing, probably suggesting that sons are preferred. And there is another company would be Tata. Many of you would have heard of it. And the last chairman, Mr. Ratan Tata, I understand that he didn't have any children. So he appointed another minority shareholder, but still a influential shareholder, his son, Cyrus Mistry. And very recently, the relationship between them became very bad, and he was fired. And now apparently a professional CEO is appointed for the holding company of the conglomerate.
So I guess that minority shareholder would have been a professional CEO in our sample, or in our way of categorizing people as well, right? So he didn't have children, and then he turned to professional CEO. So I guess that's one thing I love about these conferences in the last year, is that it's so nice to see people's life outside of academia. So that's really great. So I think the paper in some sense doesn't have a whole lot to say about why do you go for a professional CEO, other than we sort of validate the results of this Danish paper. So I think that our focus is sort of mostly on this, given that so somehow you don't go with a professional CEO, what's the difference between the insider and the outsider family successors? I'm not sure we have sort of a whole lot to add to why is it actually that you make that decision to go with a professional CEO. As I said, it's not because there's anything sort of obvious in terms of people don't have any kids, or so we've looked at things like, does the outgoing CEO have a firstborn son? How many firstborn sons are there among his siblings that are also owners of the family firm? And we've looked at all of these things, and sort of the only sort of thing that seems like a pattern that sticks out is that in those outside successions where it's the partner of the outgoing CEO that comes in and takes over, in those cases, the outgoing CEO's children are often so young that it wouldn't make any sense for them to take over as CEO. So it looks as if those partners could be some kind of interim solution. But that's sort of the only thing that has really stuck out to us. Yeah.
Nikolai.
Hi, Charlotte. A very quick question. So recently I've been working on succession planning, which is the idea that firms should have a formal process to select both internal and external CEOs. And it turns out many US firms, for example, large and small, don't have such a plan, so they're not prepared. So I was wondering if you actually can use, I don't know if you have any information, but given that you have so much data, maybe you can find some way to differentiate among family firms in terms of whether they have something like a more formal planning process versus some that don't, because that will really help you both with the professional, hiring a professional CEO, but maybe also with the talent question, where you can use this if it was planned that the son, let's say, would go work for a firm and then come back. Maybe there is some way to kind of disentangle this. I know it's difficult, but maybe you have some good data on that.
So I'm not sure if there's sort of data that readily exists, but we have connections with the family associations here. So maybe that was one could sort of think about doing a survey or something. It's a great suggestion to try to think in those along those lines. So thanks a lot for that.
I see one more question. Go ahead, Kwan Young Jin, if I'm pronouncing it correctly, sorry.
Yeah, so I saw in your paper that you did have some sample of the firms that were sold at the time of the transition. So it's not just the outside CEO coming in. It's that the ownership stake is transferred as well. Among the firms that have an outside CEO coming in, does the performance differ among the firms where the family keeps the control versus ownership control versus the firms that the family sells the stake, i.e., like there's no longer the separation?
Right. So that's actually a very interesting category of firms that, of course, we throw out, right? Because so if you compare it to this Danish paper that I was, or paper with Danish data that I was referencing or referring to before, so one of the things that we can see in our data is we actually can observe whether the family retains control afterwards. They don't do that. They just observe that the CEO identity changes. And earlier in the process, we actually thought that we had sort of found a problem in their paper because the group of firms where the family sells out to another family or typically actually performs super well ex post. But then later it turned out that actually we perfectly replicated their data, so we really get completely the same results. But it's really striking that the group of firms that performs the best ex post, that's actually the ones where the family sells out completely. Yeah, I don't know why are they coming in with more equity capital, more external financing, or resources of some kind. I don't know, but it's something that in the back of our mind, it might be interesting to investigate at some later stage in a different project.
Would the performance of the outside CEO drop to the level of say the inside CEO if you exclude the effect of the firms that have sold out entirely?
So those firms we throw out completely.
Okay.
So at no point do we have those firms in the regression. So we only talk about, we only look at family firms where it's the same family that's in control before and after.
Okay.
Okay. So I think that exhausts our question list. Thank you very much, Charlotte, for a fascinating paper and presentation, and for John and all of our participant questioners. And so we are going to move then to our next paper and just start a little bit early. I would normally say that means longer time for lunch, but this is a virtual lunch, so we'll just have more time for questions, I suppose, at the end. The presenter for the next paper will be Roberto Talarita, who's at Harvard Law School. And with that, please take it away. And
thank you. Gonna share my screen.
so we're at 12:08, so you have till 12:28.
Okay, great. Thank you. So this is joint work with Lucian Bebchuk and Kobe Castiel, who are here. We'll take some questions. Lucian will do the easy, medium, difficulty one, Kobe the toughest. The paper is called For Whom Corporate Leaders Bargain, and the motivation behind this is the current heated debate around stakeholderism or stakeholder governance, which is the view that corporate leaders should be given discretion to take into account the well-being of stakeholders as an independent end when they make business decisions. There have been a very classic work supporting this view in the 80s and 90s, and some recent prominent authors advocating this view. Prominent business groups, like most notably the Business Roundtables in 2019 with their statement on the purpose of the corporation, the World Economic Forum in Davos, several letters of Larry Fink to BlackRock portfolio company CEOs, urging companies embracing purpose, and recently also the ongoing project of the restatement of corporate governance by the American Law Institute is considering the introduction of some stakeholderist elements in the restatement. So it's an important debate. On the other end of the debate, there is an agency critique. Lucian and I have a paper last year, The Illusory Promise of Stakeholder Governance, where we examined the incentives that directors and CEOs face, and we conclude that they should be expected not to produce meaningful benefit for stakeholders if they are given the discretion to do so. And at the core of this dispute, there is an empirical question. What would happen if we gave directors this broad discretion to take into account stakeholder interests as independent ends? Would they use this power to produce benefits for stakeholders or not? And this paper tries to answer this question by testing it in a setting that is particularly useful for resolving the dispute. Private equity acquisitions of companies incorporated in states with a constituency statute. As you know, these statutes were adopted in a majority of US states in the 80s and early 90s, and they authorized directors to consider the interests of stakeholders, not just of shareholders, when they assess acquisition offers. And private equity acquisition are a very good example of transactions that pose significant risk to shareholders because they move assets into the hands of asset managers with very powerful incentives to maximize shareholder values. So we test this as an experiment of stakeholderism to see what outcomes it produced. We constructed a database of acquisition by private equity firms of target companies incorporated in states that had a constituency statutes at the time of the deal. Transactions are announced between 2000 and 2019, so 20 years of private equity deals. We excluded deals below 50 million in 2019 dollars. And our final sample includes 110 transactions with targets incorporated in 17 different states with constituency statutes. We hand collected and hand coded information from the proxy statements for the merger filed by the company and the final merger agreements, which contain all the detailed contractual terms. So we collect information about the bargaining process leading to the transaction and the final terms of the deal. So first of all, we found that corporate leaders engage in substantial bargaining and negotiation. And this is a lengthy and fruitful process because in 78% of the cases, the final terms in the merger agreement are better for the target company than the initial offer. It's a process of particularly long, 194 days on average. There are, in many cases, offered by other parties, which creates, of course, pressure on the buyers. There are discussions with other parties in almost 90% of the cases, and multiple offers by the final buyer. So corporate leaders negotiate these deals and obtain improvements during this process. But for whom did they bargain? For whom they obtain these benefits? This is the key question of the paper. And I'll examine briefly the various groups. So shareholders obtain substantial premia over the pre-announcement stock price unaffected by information about the deal. So 30% is the average premium for the entire sample, 25 the medium, and the top 20 largest acquisition, it's 23% the average premium. So substantial benefit for shareholders. And executives get significant financial payoffs as well, both as shareholders because they own stock in their own company and as executives. So transaction bonuses, additional payments, and also the promise. Sometimes it's a formal commitment, sometimes it's an announcement to retain them in the new company. So after the transaction. So there are substantial gains for shareholders and executives, but what about stakeholders, which was the purpose of stakeholder statutes? Employees are the most important group. They are explicitly identified by all constituency statutes governing our transaction, the transaction in our sample, as a protected stakeholder group. And private equity acquisitions pose a clear risk for them. Davis et al., a paper 2018, they found that private equity acquisitions are followed by a reduction in employment. But corporate leaders made very little use of their bargaining power and their discretionary power under the constituency statutes to negotiate constraints on the buyer to fire employees. In 97% of the cases, there's no such contractual clause. And the only protection we found in many deals is a transitional period, a one-year period, where the buyer cannot change the salaries and benefits of the employees that it decides to retain, but it is not obligated to retain those employees. And after the 1 year, it can get rid of them. And importantly, in no cases, these protections are enforceable by the employees. They're not party to the merger agreement, and these contracts typically include a clause excluding enforceability by third-party beneficiaries. The other stakeholders group, the situation for them is even worse. Customers, suppliers, and creditors are recognized by a vast majority of constituency statutes governing the deals in our sample, but we found virtually no cases where corporate leaders negotiate protections for them. Communities, environments, and other stakeholders, the situation is similar. No contractual protection at all. In a small number of deals, there's some soft commitment to keep the headquarters in the same location where it is before the deal, but it's a very vague commitment. There's no specific definition of what the headquarters means in particular, some definition in terms of assets or number of employees or other criteria to check the compliance with this commitment. And importantly, this is not enforceable, once again, by third parties. It's not like the local community, local residents, or the mayor can sue the buyer if it decides to move the headquarters to another place. So it's mostly a cosmetic provision in a small number of deals. So what do we learn from this experiment? So the main conclusion is clearly that the constituency statutes failed to deliver their promised benefits for stakeholders. But we are also interested in something, in what we can infer and learn from this experiment for stakeholderism in general. Constituency statutes have a very similar approach to what modern advocates for stakeholderism support. Which is this harnessing the discretion of corporate leaders in order to protect stakeholders. So before embracing stakeholderism, it is necessary, we believe, to examine and to understand why the constituency statutes experiment failed. So in the paper, we examine 5 possible explanations of why this is the case. I will just highlight the most important. So, but we conclude that the most likely driver is that corporate leaders' incentives are such that they should not be expected to produce any benefits for stakeholders. So they have incentives not to benefit stakeholders beyond what is instrumentally useful for shareholders and shareholder interests. So one of the main possible objection could be that maybe corporate leaders did want to negotiate some benefits for stakeholders, but since target shareholders need to approve the deal. They anticipated this, and they refrained from doing this because otherwise shareholders wouldn't have approved the deal. We think this is unlikely because most deals have substantial premiums for shareholders, and there is room. There would have been room for buying some benefits for stakeholders at the expense of a small fraction of the premium. And also deals approved by the widest margins, they have no better protections than other deals. So we find this an implausible explanation. And in any case, if this is true, if this were true for constituency statutes, it would be true also for stakeholderism in general. There is no concrete stakeholderist proposals that suggests to disenfranchise shareholders or to modify voting rights for shareholders. It's not like the Business Roundtable statement says that shareholders shouldn't approve mergers or other important decisions that right now they have voting rights on. Some other observers might say, and they say that norms are changing, and for decades shareholder-centric corporate norms have shaped corporate leaders' decisions, but now this is changing and stakeholderism would change it even further. But we find this unlikely too because we looked at a subsample of most recent deals from 2017 to 2019, and despite the rampant stakeholder rhetoric, we find no meaningful difference in terms of stakeholder protections. So we don't believe that corporate leaders alone can shape this. So our conclusion is that the incentives of corporate leaders, the most important factors explaining our results. Constituency statutes did give corporate leaders discretion to negotiate for stakeholders, but they did not change their incentives to do so. So they had and continue to have incentives not to serve stakeholders. A couple of, before concluding, a couple of points that clarify some aspects of our study. First of all, we studied sales in states governed by constituency statutes, but we did not study sales in other states without constituency statutes. And the reason is that the hypothesis we are exploring is that the discretion provided by constituency statutes, whether this discretion improved the terms of the mergers for stakeholders. So in order to show this, we need to show two things. First, that in transactions governed by constituency statutes, there are significant stakeholder protections. And then we should show that these protections are greater or more meaningful than those found in similar deals in states without constituency statutes. But since we do not find anything to show that the first element is there, we do not find any meaningful protections under constituency statutes. The conclusion is already evident. We saw no need to do any comparison because we found virtually zero protections in the treatment, if you will, group. Another point, another comment that we got in the past is that maybe maybe constituency statutes are helping stakeholders through a different channel. They are corporate leaders are using the power under constituency statutes to reject deals that would have been bad for stakeholders. So through this channel, there would be some benefits for stakeholders. But this is implausible in our view because what happens where a company receives a private equity offer for an acquisition, which produce overall efficiency gains, so which is good for shareholders, but in the hypothesis is bad for stakeholders, they could certainly reject it, but this would be bad for shareholders as well. But they could also negotiate a redistribution of some value from shareholders to stakeholders and still keep the efficiency gain overall and make both groups happy. And since we found no meaningful instances of stakeholder protections, we find it implausible that there are several or even many instances where corporate leaders use this discretion to turn down offers that would have been good for shareholders but bad for stakeholders. So our conclusion is that this experiment and the failure of this experiment must serve as a warning for advocates of stakeholderism and for the idea that we should rely on the discretion of corporate leaders to protect stakeholder interests. They had the chance to do so in many states for now almost 4 decades in some states. They had the power to do so in M&A deals. And when we looked at 20 years of this activity, we found no meaningful protection. So the available evidence does not provide a basis for expecting that discretion-based stakeholderism would benefit stakeholders. Thank you.
Thank you very much, Roberto. Our discussant is Renee Stoltz from Ohio State.
Can you see my slides?
Yes, we can. They're just not in the slideshow format. There they are. Perfect.
Okay. Many thanks for inviting me to discuss this paper. This is a great paper. It provides a lot of food for thought. So I will have a number of observations. The paper is forthcoming, so I'm going to stay away from the weeds and take a more high-level perspective. Now, this is about stakeholderism, the 2020 or 21 version. But we have had those discussions before most of us were born. And in 1932, Merrick Dodd, a Harvard Law School professor, like the authors, wrote a paper titled "For Whom Are Corporate Managers Trustees?" And so the title is quite similar to the one we have here. And the authors in this paper want to say that corporate managers are essentially trustees for themselves and the shareholders. The Merrick Dodd paper responded to a paper by Burl, which argued for kind of the shareholder maximization view that has been prevalent. But Dodd, in his article, says he believes that public opinion, which ultimately makes law, has made and is today making substantial strides in the direction of a view of the business corporation as an economic institution which has a social service as well as a profit-making function. In many ways, that describes at least some versions of stakeholderism. It probably describes it well the Davos view of stakeholderism. Now, Klaus Schwab, the leader of Davos, wrote an article explaining the Davos Manifesto. And in that article, he says that stakeholder capitalism positions private corporations as trustees of society, and is clearly the best response to today's social and environmental challenges. And then he asks, why is it that the attitudes have begun to change? And he attributes that to Greta Thunberg. And then he says that business leaders now have an incredible opportunity. By giving stakeholder capitalism concrete meaning, they can move beyond their legal obligations and uphold their duty to society. So you can see in the duty to society, it's a continuity from the 30s to 2020 in terms of this stakeholderism. So the paper addresses what does it mean, what does stakeholderism mean in practice? And BKT have a test to distinguish between shareholder wealth and maximization and stakeholderism. Now they describe it as a stakeholderism view holds that the welfare of each group of corporate shareholders is relevant and valuable independent of its effect on the welfare of shareholders. One way to think about this is that for the authors, it is not stakeholderism if it doesn't hurt shareholders in some states of the world. But you can think of optimal policies for shareholders that ex post are costly to shareholders. And so I think it's a little bit, the condition has to be a little bit more complicated. Now you can think of a lot of things that can be optimal, where it can be optimal for shareholders to put a high weight on stakeholder welfare. And the paper that we just heard from Philip would be evidence of that. Now, if we take it at face value, that you pay less if you have some policies that favor stakeholders, now you have lower wages, then you might be maximizing shareholder wealth. Now, in general, with costly and incomplete contracting, a corporation can create value for shareholders through commitments to stakeholders. Now, for instance, it can make costly investments to create a reputation of fair dealing. Obviously, to build such a reputation, you have to take actions that at the time are costly for shareholders. Now, BKT kind of dismiss this or don't want to consider it, calling it a form of enlightened shareholder wealth maximization, and they say that's not stakeholderism. I think the distinction is between the two is probably not as sharp as they want to make it. So in their papers, they want to put stakeholderism to the test they have defined. They want to investigate whether corporate leaders, when permitted or asked to do so, give up shareholder dollars to benefit stakeholders. They focus on a very specific type of transactions, PE acquisitions. They construct a fantastic database. Now they have to be commended for that, as well as for writing a very interesting paper. The paper only works in the US setting. In the US setting, states have adopted various statutes that creates obstacles to hostile acquisitions. There are many papers written on the impact of those statutes. But one type of statute is less studied than the ones that more directly impede hostile acquisitions, the constituency statutes. They're also called directors' duties laws. These laws permit directors to consider the welfare of stakeholders. So BKT look at states where those laws are in effect to see whether corporate leaders bargain in favor of stakeholders. They motivate their focus on PE acquisitions by saying that there is evidence that PE acquisitions endanger the welfare of stakeholders, and as some of the value created may come from breaking implicit contracts. However, they are kind of a strange acquisition to look at because now those acquisitions that create value precisely because they enable a fundamental restructuring that would be hard to achieve in public markets. Now, the typical PE acquisition will take the firm private. And by definition, now fundamental restructuring of firms are going to involve changes for stakeholders. And those changes are in some sense a component of the values that is being created. So you worry about a selection bias, no, which is that the corporate leaders who choose to respond to a PE acquisition offer or generate such an offer have already decided that this is how value can be created. They may have decided that the current way the corporation is functioning is not sustainable and something has to be done to change. Now, those PE acquisitions sometimes come exogenously to the firm, but often they are generated by management itself. And so those leaders who generate such an acquisition offer obviously are already committed to creating values that way. And so it's really hard to think that if the corporate leaders have chosen to go the PE route, that then they would want to restrict the discretion of the acquirer to create the values that they see by a fundamental restructuring. And so in some sense, it's a setting when one is least likely to see corporate leaders try to protect stakeholders. The authors focus on whether they can find explicit contracts, but writing contracts to protect stakeholders seems to be really hard to do. Now that they are all lawyers, so they know better than I do, but certainly from the perspective of financial economists, it would seem to be hard to do. Hard to do in such a way that it doesn't reduce flexibility in a way that would hurt stakeholders in the long run. But now, obviously, there could be discussions about stakeholders who will be treated. And in many of the acquisitions, there are multiple bidders. And so the PE acquirer might, the target or the acquired firm may choose a PE acquirer that is more stakeholder friendly than another, or might have implicit commitments. So we don't know about that. Now, it may be that it doesn't make sense to think that this would be taking place, but it would be nice to see what the authors have to say about that. They have this agency view. Now, Roberto talked about their earlier paper. The view is really that corporate leaders benefit from increasing shareholder wealth. So they are not going to use their discretion to benefit stakeholders at the expense of shareholder wealth. To me, that seems a little bit naive as kind of a general proposition. Now, the corporate leaders operate in a world where they are affected by culture, social networks, politics. Actions that are acceptable in some countries at some time may not be acceptable in the same countries at other time. Corporate leaders often like to be popular, like to be praised, like to have their actions be socially acceptable. And they may also choose the path of least resistance. And now here is an example of things changing. The person in the middle is Jamie Dimon. Now kneeling like that for the non-American was kind of a symbol of the BLM movement, and he participated in that. Now, choosing the path of least resistance now is something that's easier in the States with anti-takeover statutes. And now, to me, one of the most important papers on the impact of those anti-takeover statutes is the Bertrand and Muller-Nathan paper in QJE. Because their claim is that these statutes make it possible for corporate leaders to enjoy a quiet life. And they show that as a result, among other things, wages are higher. Okay, now this could be a good thing, but it also suggests that it opens the door to inefficiency, which may be bad for stakeholders in the long run. Okay, and so there is more evidence on constituency statutes than there's an interesting paper by Flammer and Kapocek, which argues that those statutes lead to a significant increase in the number of patents and citations per patent. And kind of the argument is that those statutes allow management to focus on the long run, that it's more easy for firms to experiment when they have that kind of protection. An interesting paper by Kramers, Guernsey, and Seppi argues that Tobin skew increases with the passage of constituency statutes, so value increases. And there's a paper recently that is forthcoming by Gao, Li, and Ma, saying that those statutes decrease the cost of debt. Now, so all those papers seem to imply that there are real effects from those statutes. The BKT papers suggest that there are no real effects. And so there's a tension here. Not everybody can be right. So the bottom line, the evidence on constituency statutes seems to indicate that they may have some impact. The Q evidence would suggest that they have a positive impact. But now we also have evidence on the anti-takeover statutes that they can have a negative impact. The obvious question is, why do they have a positive impact if they do? Do corporate leaders really need a constituency statute to pay attention to stakeholders? Do they really need those statutes to be insulated from the takeover market? They seem to be doing pretty well when they want to without that. So we can turn back to Davos to reach the conclusion here. Now, we talked about kind of the stakeholder view of BKT. It seems to be quite narrower than the stakeholder view, certainly, of Davos. Now it seems to be more encompassing. And now Schwab is certainly not alone in this view. For many, stakeholder capitalism is about climate inequality and sustainability. Now there's this famous saying by Clausewitz that war is a continuation of political intercourse with the addition of other means. Stakeholder capitalism might be the continuation of political intercourse with the addition of other means, namely the corporations. So now in that sense, stakeholder capitalism tries to achieve societal goals. But now the corporations, as they are constituted now, now makes the world better by providing good products at low costs. You would think that competition would discipline them to do that well. It's really unclear how stakeholder capitalism in any of its forms can get those corporations to do that. So now the concern is that supporters of stakeholder capitalism often want corporations to achieve what they can't achieve by political means. And the worry with that is that it will lead to inefficiency by having corporations focus on other things than what they are supposed to achieve. Additional concern, now my previous discussant, the previous discussant, and I seem to be the only discussant who doesn't have a beard, but the previous discussant talked about the obsession in the US with public corporations. But now obviously, the more you impose things on corporations that they don't want to do, or that might not be good for them from the perspective of owners, the more you push corporations into leaving the public markets. We already have that problem of fewer and fewer public firms. And so it's a legitimate worry to think that more focused on social welfare from corporations through benefiting stakeholders and pursuing social goals could lead to a further decrease in public firms. So conclusions, allowing corporate leaders to take into account the interest of stakeholders does not mean that they will do so. That's a big lesson from the authors. But great corporations benefit society by being an engine for economic growth. We should make sure that they keep doing their job. Climate and inequality should be best addressed through other channels and governance. We can conclude by letting Burl have the last word. He responded to the Dodd paper. In his response, he said, "No, I submit that you cannot abandon emphasis on what we would call the shareholder maximization view until such time as you are prepared to offer a clear and reasonably enforceable scheme of responsibilities to someone else." We are not there. Thank you.
Thank you, Renee. So I think, Lucian, are you going to handle the response?
Let me maybe just first of all thank Renee for the insightful comments, which are going to be very helpful to us in revising the paper. Few quick reactions. There was obviously a lot in Renee's presentation. One is, let me agree strongly with Renee's concluding line. Renee said that he believes that climate inequality, presumably other stakeholder interests, should be addressed through channels other than governance. And we fully agree with this. And indeed, this work and our other work, as well as some ongoing work, are intended to provide support for this proposition by showing that at least discretion-based governance mechanisms are not going to benefit those various societal interests and are going to be counterproductive in important ways. Going back to earlier in Renee's presentation, let me just offer quick reactions to some methodological issues that he raised. First, even though we stress the version of stakeholderism that we think is most important and consequentialist and consequential, our results also speak to other versions of stakeholderism. So take, for example, the version of stakeholderism that Renee talked about, enlightened stakeholder value, where we really care about shareholders, but in order to induce ex-ante investments by stakeholders, we have some implicit promises to treat stakeholders well exposed. This goes back, as many of you know, to Schleifer and Summers and so forth. Now, in our paper, we actually show that ex post, when the time comes to reward stakeholders for their ex-ante investments, corporate leaders do not seem to operate in a way that recognizes those implicit promises. It doesn't provide stakeholders at this crucial point in time of selling to a buyer any protections. Secondly, Renee was wondering whether the private equity sales setting is as useful as we think it is for testing this question. By the way, we did the same analysis for a sample of about 100 sales to strategic buyers, and we find similar patterns, namely practically no protection for stakeholders, and we have been debating internally whether to add it to an already long paper. But the reason why we think private equity is a good setting, and perhaps a very good setting, is that the risks are large for our stakeholders. And Renee was saying, look, but a main benefit, a main source of gains for private equity deals is that the buyer will have some freedom to break some things and to make big changes. And therefore, we fully agree with Renee that you wouldn't expect to see a deal that completely eliminates a discretion from the buyer. However, given that there are substantial gains because we see such large premiums going for the shareholders, it means that there is substantial surplus that for stakeholder-oriented leaders, you should expect to see those deals with slightly, at least with somewhat softer treatment of stakeholders and a somewhat softer, somewhat lower premium. You could have the same deal still go forward. The shareholders would get a somewhat lower premium and the stakeholders would get some protection. And the last comment that I'll react to is Renee was wondering maybe there is some protection in the form of implicit promises on the private equity buyer. The reason why we are skeptical is twofold. First of all, when it comes to the corporate leaders themselves, they get the promises explicitly. You could imagine easily they get implicit promises to keep them in their job, but no, that's written and hardwired into the contract big time with full detail. That's one thing. Secondly, it's easy to see, perhaps not a perfect, fully detailed aero-debris treatment of all states, but there are some very simple protections that you could imagine. For example, suppose you just have protection that says, given that we expect that there is a risk of substantial layoff of employees, how about that employees that are being fired will get a certain amount of money and a nice gold watch? That can definitely happen and would soften the blow to fired employees, but we don't see anything of that nature in virtually all cases that we study. So let me stop here, and some of the other big picture issues will probably come up in the rest of the discussion.
Okay, so I'm just going to make one brief comment, and then there's a question in the chat, and then we'll go to the hands that are raising. And there's another set of data that is probative, or at least to some people. There are a bunch of event studies that were done on other constituency statutes, and that I think is useful maybe for your thesis. I would note that there's a more parsimonious explanation that the academic literature gave at the time, although it was just saying this was all rhetoric about stakeholders and that the point of these statutes were just to benefit managers so that they could prevent bids and benefit themselves. And I think your data actually show they're getting, that is consistent. They're getting big side payments, although we don't know whether that would also be true in non-other constituency states. I did look at your two companies that had stakeholder benefits, health, whatever, one with an H and the other one. And one had lower sort of benefits to the managers and shareholders on average, but the other was higher. So it doesn't say anything about the trade-off, but my event study that was multiple statutes had no significant price effects. And that would be consistent with shareholders thinking that it would be the results that you get in your paper. There were a couple of studies on individual statutes that had negative effects, but those are statutes that also had other provisions in them, like the Pennsylvania statute, so they're not directly related to that. But I think that might be supportive of some aspects of the time would be like you skeptical that it would have any impact. Let me read Jeff Gordon's question.
But a quick reaction, can I offer a quick reaction? So we very much agree with this. So our findings, we think, are consistent with the evidence that you and some of the studies that Renee cited, but they just add a piece that comes from our
Yes, I think your work is a great idea to look at this.
The agreement. So basically, there is all this literature starting with Romano and Mark Rhodes that documented that at the time there was lobbying by managers seeking to get entrenchment. And Renee was saying there are a lot of studies that find real effects, and those real effects might come from the entrenchment element. And you know, in the literature, there are some people that think that insulation of managers from the marketplace is positive, some think it's negative, but there is obviously a piece there that is real. What we are adding is that, consistent with the Romano and Rowe view at the time, that this is not aimed at helping stakeholders, but rather managers. We looked with the benefit of hindsight, going all the way to the present, and looking at the deals, we document that indeed, up to this date, there is no use of this in the many deals we study to provide benefits to stakeholders.
So in the order of hands, I have Holger, Ernst, and then Jeff. Jeff had a question in chat that he put first. Is that what you want to ask, or Jeff? And I'll put him ahead of you other two, and then we'll move to Holger and Ernst.
Right. So this is really
Jeff Gordon, for those who can't see who he is at Columbia.
Yeah, this is in follow-up from the claim that there were that the agreements as they found them were unenforceable. That there were in some cases there were the 1-year delay in layoffs, in some community protection. I mean, it seems to me that one could. The fact of enforceability doesn't mean that they don't have an effect. So the Davis et al. Study shows the average effect of layoffs and other employee effects across a broad sample of PE deals. And so one would want to, it seemed to me, compare the deals in which there were the protections that are allegedly unenforceable against the Davis et al. Results. And indeed, one might look in constituency statute states to see the employee effects for firms in those states as against the Davis et al. Average results for employee effects in PE deals in a general way, to see if the fact of enforceability in a legal sense might not limit the effect of the behavior change as we can observe it if you compare the the general run with these particular cases and the states more in a general way.
Jeff, thanks a lot. We need to clarify this and sharpen it in the paper, that there is this piece that we are pointing out, and lawyers, would enjoy it, that there are some that where you find limited protections, the agreements go out of their way to exclude enforceability. But the main point that underlies our conclusion is that the main thing that employees worry, being fired, for that, there are no provisions in 97% of the cases, so zero. So it's not that there is a limitation on firing and then it says that it's not enforceable. The lack of enforceability is only for those limited effect provisions that say that if you are not fired, for the first year, we are not going to change your salary, which is not such a big deal because it takes time for somebody to move in and to make changes. But basically, even before we go to enforceability, there is zero commitment not to fire you from moment zero, and there is zero commitment to reduce your compensation after 1 year. So the big effect, so the lack of enforceability, it's kind of the icing on the cake of our results. But the main dimension that makes it so little in terms of stakeholder protection is that there is just nothing there even before you get to enforceability.
Holger Smaman?
I just wanted to mention in reaction to Renee's great comments that there may be a way to reconcile Lucian's and Kobe's and Roberto's findings with those other papers that Renee mentioned, which is that some of those old results, and I think showing generally that the effects, to the extent some were found, actually were the results of various errors in those papers, starting with Katan and Kahan 2016, reviewing some individual errors in some papers, then more systematically Karpov and Vidri in the JF 2018, showing that it's very important to control for various other things that happen at the same time, because these laws were all enacted sort of simultaneously. And then my paper with Alan Hu that we gave at the AFA this year, showing that there's a big issue in how you calculate your standard errors, so inference in these papers, a very big issue. And a paper by Andrew Baker was summarizing the recent application of these panel models with fixed effects. And all of these papers sort of conclude, I think, Karpov and Vidri not as forcefully, but the other three of these laws, constituency statutes included, actually don't hold up. And I don't say that to criticize those old papers. Obviously, we're making progress and that's all great, but that just maybe is a way to reconcile these findings, and then we don't have to get hung up in, maybe it's this, maybe it's that. No, I think the evidence actually in that sense is pretty consistent that there was no effect.
Thanks, Holger. So we need to think about this, but the point well taken. Our position on this would be that whether or not there is an effect of the kind that was documented in earlier papers, but you are saying might not be there after the new papers, is that whatever effect was there might have had to do with insulation with market forces, which we know from a large body financial economics might have an effect in one direction or another. And what we're trying to do is just a narrow test of the direct effect ex post on keeping promises explicit or implicit to provide stakeholder protection.
Ernst?
Yes, thank you. Very nice paper, Roberto and Lucian. Interesting, really. There's something that I was wondering about. I mean, we know that PE acquisitions are often quite different from, let's say, tender offers or standard takeovers. So these are different, not just different people, but these are also different cases very often. In fact, in Europe, it's quite often the case that PE acquisitions are basically the last remedy before bankruptcy. Firms that are in dire straits and are taken over by some PE people who then try to turn it around. If that is indeed the case, which is a specific situation, then it may in fact be that the alternative to not having an acquisition is even worse than continuing and keeping the promises, namely bankruptcy. So in that sense, it would be interesting what it means to break those implicit promises that you were discussing, because it might well be that at least for some firms, these promises would have to be broken in any case through bankruptcy. So do you have information about the background situation of those firms, and how does that sort of fit into the overall framework of what alternatives or outside options would have been?
Okay, thanks a lot for this. That's related to the discussion that Renee and I had before about the private equity setting. So two things. One is we have information about our deals. There is also information about the universe as a whole from the work by Steve Kaplan and others. And in our sample, many of those deals are not of firms in financial distress. They are actually quote unquote cash cows that enable the private equity buyer to finance this substantially with debt. However, even in cases where your account might be very accurate, our claim is not that they should not have sold to a private equity buyer that is going to have those high-powered incentives to maximize the bottom line. Our point is different. We are saying, if you are stakeholder-oriented, you should still do the deal there is on average 30% premium to be pocketed. That's the size of the pie. And you would say it's an economic series, but that's the pie. It can be divided in many different ways among all the stakeholders in the company. And we are saying, if you look at the deal terms, you see that the full 30% is allocated to the shareholders. Some surplus is given to the executives themselves through continued employment and bonuses. The employees and all the other stakeholders do not get anything extra beyond kind of the hardwired entitlements they have to begin with. And we are saying, if you are stakeholder oriented, why don't you do a deal in which you throw a little, maybe some amount or at least some crumbs? We don't even see crumbs going for the other stakeholders. And that's, rather than not having the deal, is what we would expect to see, but we don't see in the transactions.
So I'm not sure if Ron still has this question. So let me ask another question. I'm thinking about, when these statutes were adopted, it was many years ago in a different environment for acquisitions than we have today. So I'm wondering, is the reason why you decided to look at current ones because you think managers today should be more sensitive to stakeholder issues than they were in the past? And that relates to another question. I thought it was a very nice idea to look at this, but one might say sort of it's an end game. These managers are exiting. If we don't think they're going to show up as public company CEOs thereafter, then they might not be as sensitive to these issues or care about them compared to people who are in current positions. And so I'm wondering what you think about, in terms of that kind of comparison. I tend to agree with you that the incentive contracts of current executives are also currently geared mainly to stock appreciation, although some companies apparently are changing them to have some ESG component. But what do you think about that? If that was what a stakeholder objection might be to your.
Right. So there are two insights in what you say. The second one says, look, maybe there's another way in which your results don't extend in general to the debate, not because of the private equity versus strategic deals, but just the acquisition context, because it's a final period, it's an end point. At that point, maybe they behave differently, and in the ongoing enterprise, they might be much more, quote unquote, stakeholder friendly and so forth. We think that actually it might go in the opposite direction. Why? Because we all recognize that something that we stressed in the illusory promise, but we stress also in this paper, and then many people here recognize that in the ongoing enterprise, they are concerned, there is pressure from the shareholders because the shareholders cast the votes. And if they don't like what you are doing now, if you are maybe not pursuing enough profits, maybe they'll vote you out in a year or 2 years or 3 years from now, when activists will come knocking down. Now, in a way, this final period situation enables corporate leaders to treat stakeholders nicely if they want to, and that's the question, without fear of how shareholders will deal with them 2 or 3 years down the road. Obviously, they have to worry about shareholders voting in favor of this deal, but often this is not a binding constraint because the premium is very large. It's 30%, and we find that even when the acquisition vote is approved by a very large margin, they don't do anything for the stakeholders. And obviously, they could just offer 25%, the shareholders would still vote in favor. So in a way, if corporate leaders do want, whether it's because of norms, whether it's because of culture, whether it's because they've read enough stakeholder risk articles, for whatever reason, if they want to do it, in a way, this final period, which, in your work and in the work of many people, we worry that they have more agency problems in the final period. But that also means that in that period, they are relatively freer to treat stakeholders nicely if they want to. And therefore, this, I think, supports more strongly the view that we cannot really count on them to want to protect stakeholders beyond what would be good for shareholders and their own interests.
Marco Beck. He seems to vanish from my screen. Marco, are you there anymore?
Yeah, I'm there. Can you hear me?
There you go. Couldn't hear you. Okay.
Yeah, sorry. So you could be wrong, but you could also be right. So let's assume you're right. Then the question is, why do we have these things in the first place? So that's one question. But then if you're a stakeholderist, you would say, well, okay, these things don't work. What else do we have to put in place? And, that would then be the kind of question. So, is that an implication of your paper? I mean, does the US then need German co-determination, 50% of the boards appointed by the employees to get them that share of the pie? Or do we need an arbitration panel? I mean, clearly the directors here, if you're right, that they're not doing the job. So what would a stakeholderist have to do in order to make sure that the employees get their fair share in these buyouts?
Great. Delighted that you have this question, because it brings us full circle to some of the big picture observations that Renee started with. So why do we have those things? With respect to the constituency statutes, I think Roberto Romano and Mark Rowe suggested way back when those things were adopted that they were really aimed at helping insulation and entrenchment. We think that this evidence supports it. Why do we now have the push for stakeholder capitalism that Renee described so clearly in his presentation? It's obviously going all over the world, from the slopes of Davos to the halls, to the business halls of Manhattan. We think that it happens today because there is a big pressure in the world. People understand that we have problems with corporate externalities, so there's a big pressure to do something about it. Plus, there's a big pressure on shareholders, and therefore the desire for insulation is strong. And we think that we completely agree with Renee that corporate leaders are responding to those pressures. But the way we see it, that things like Davos and the Business Roundtable statement, they take this pressure and when they offer in response a discretion-based mechanism for dealing with it, they do two things. One is they deflect the pressure to do something real for stakeholders. And two, they gain some insulation from the marketplace on grounds that if you insulate us and let us focus on stakeholders, we'll do the social job, which is something that corporate leaders have long wanted. Which brings us to the last question of what should we do? And this enables me to say on behalf of myself and Roberto and Kobe that we are actually stakeholder-friendly people. We consider ourselves as deeply concerned about stakeholders. I mean, there are two kinds of views among people who criticize stakeholder capitalism. There is the old-fashioned Milton Friedman view. The market is working perfectly, society is working perfectly, shareholders own the thing, that's it. Our view is that indeed, corporate externalities are a substantial problem in the world, but stakeholder capitalism, as long as it's discretion-based, is going to have illusory benefits and is going to be counterproductive because it will deflect pressure to do something real and it will insulate managers. We would like to see real reforms. So to return to Renee's focus on climate change, our position is that, and we think that our evidence provides an epsilon in support of this, is that if we rely on corporate leaders to help address climate change, the icebergs are going to melt before this mechanism is going to help us. And what we need is for anyone who cares about this problem to adopt real measures like carbon tax or what have you that would affect corporate leaders directly by changing their standard economic incentives. And it's exactly because we are deeply concerned about externalities with respect to stakeholders. We think that demonstrating that stakeholder governance is going to produce illusory benefits is so important. And since I don't have, let me just say 2 sentences about, Marco said, maybe the solution is, and Rene had in his last slide, changing incentives. In the Illusory Promise, we have a part that says, look, maybe we could leave it not just to this question, we could change incentives by changing compensation arrangements to bring in ESG metrics, or maybe we should elect stakeholders to the board. And we explain why we think this would not work and would have substantial costs. And if any of you reads this and tells us, we'll send them a bouquet of flowers in gratitude.
So let's collect the last 2 questions and then give Lucian you respond. So that way we'll just be a little over before our lunch break. So the last 2 questioners are Jeff and Ron, Jeff Gordon and then Ron Gilson.
Right. So really, in a sense, this is to pick up on Marco's question, which is to say, are there changes in the governance setup that one could imagine in which the constituency statutes might be effective, for example, or in which other pressures would lead managers to seek the protections that don't presently exist? And so one area that I think could well be re-examined are golden parachutes, which I think give managers high-powered incentives not only to negotiate the best deal from a share price point of view, because they benefit along with the shareholders, but actively give managers incentives to seek out deals. Because the fact of exit is a chance when the CEOs and the management team can get truly rich. And so I think golden parachutes, which were once in effect a buyout of the CEOs the CEOs takeover resistance endowment, sort of a necessary cost in a regime in which the board had little power over the CEO, today has become a positive incentive to seek out deals, even deals where the cost to the stakeholders might be very considerable, but where the gains to management, just because of the golden parachutes, is what's driving the deal in the first place. So that's a potential reform dimension that might be pursued.
Thanks, Jeff. So sure, there is a lot of...
Lucian, why don't we collect Ron's question too, and then you respond. Thank you. Sorry. Ron, you need to unmute yourself.
It's easy to show that I think that Lucian's construction of the constituency statutes are right in the sense that they just don't do anything. The joke is stakeholders are worth $3 a share, and then you don't have to give it to them. But the easy move at that point, that worry that I'm playing with now, is the reference that, oh, well, the legislator, the political process ought to address this. Well, what I recall from the constituency period, the one statute that actually worked wasn't the constituency statute at all. The gains from a lot of the acquisitions were taking textile plants and moving them to the south. And Maine adopted a statute that simply said it was a plant closing statute. If you closed the plant within a period of time, you owed employees money. Didn't care why you closed the plant. If it was stakeholders we were concerned about stakeholders, whether it was current management who did them in or the next set of management. But then, Roberta, your work on the legislative process associated with anti-takeover stuff pretty much left one unhappy about the legislature and the notion. I look around, maybe New Zealand works, but it's a little hard to point to any other political process at the moment that we think is going to be particularly good about it. So that the discussion goes a long way towards saying constituency statutes were both hypocritical and as a result failed. But there's less work, or almost none that I can think of, that's looking at how a legislature would actually address this. That is, you'd start by trying to identify, in particular takeover waves, where the potential gain was coming out of the stakeholders' pockets, and then you'd address those. But those are going to change constantly. And as we know, the legislative process lends itself to petrification. So we've got a bunch of different processes. The adjective in front of it is going to be enlightened. We're going to find somebody we want to give discretion to. We're going to add enlightened before that group, and we're going to rely somehow trusting them that they'll do it right. I don't see much work that, in part because I can't imagine an outcome in which we're trying to identify a process in the real world in which this kind of balancing can be done when we're confident that it won't be manipulated for the self-interest of those who have the discretion. So the first step is easy, and it's easy to agree with. The second step, which is probably third best or fourth best, seems to me really hard to address, and part of the reason why the issue just won't go away.
Lucian, the last word to you. Why don't you take about 5 minutes or so, because we're running a little over, although I think most people will stay and respond to both Jeff and Ron.
Yeah, so thanks a lot. Obviously not the last word in this debate. So
just for today.
For the next 5 minutes. So first of all, with respect to Ron, we very much share your view that if you care about employees in acquisitions, the best way to deal with it is with legislation that would provide them with rights in the event of plant relocation, rather than counting on corporate leaders to add such provisions in deal terms. And similarly, if you worry about the iceberg, you should have carbon tax and not count on corporate leaders to do something in this respect. Now, the other thing that you said, Ron, and we heard it from various people, I think, including Jeff, when we first presented this work in his class, is there are many people who just have some despair about the ability of the political process to deal with stakeholderism, stakeholder externalities. And look, if you have, and people often say there is gridlock, there are vested interests and so forth. If you are indeed so pessimistic, I don't know that there is that much to do. What you can do is just move from Manhattan, far from the shores, because we are not going to address climate change with discretion-based stakeholder capitalism. Now, we are perhaps mistakenly, we are more optimistic. We think that there are avenues that things can happen, and we think that on some margin, people having realistic expectations about private ordering, not solving things without big ticket regulation, is going to help getting the reforms needed. With going to Jeff's point, briefly, we try to explain the illusory promise, why it's difficult to fix incentives by redesigning executive pay arrangements. You mentioned, let's play with golden parachutes. So various people in this room have worked on executive compensation over many years, and we see that even trying to design the best executive pay arrangement just to maximize shareholder interest is not that easy, and there are various problems. Now, once you're saying, let's try to get it designed so that we maximize the interest of stakeholders in general, if you do things that like we can golden parachutes or do other things, you can do it in one of two ways. Either you can weaken the power of incentives to favor shareholders, or give affirmative incentives to help stakeholders. Diluting the incentives to help shareholders just sends us back to a period in which we were all critical about pay without performance and the like. So you might say, let's give them affirmative incentives to serve stakeholders. We have reviewed the various arrangements that companies have in place when they try to work in some ESG metrics, and we see two problems. One is very often it's just like a narrow slice of stakeholder interests. So it gets us to the big distortions of multitasking. And secondly, since we are all aware that there is a big agency problem with executive compensation, so we need to have pay arrangements that can be reviewed by shareholders, all the ESG metrics that we have seen and that we can think about are such that it's very difficult for outsiders to review and figure out whether this is something that is providing meaningful incentives rather than being used to provide payoffs to executives with little performance either for shareholders or for stakeholders. So from the work we have done, and obviously this is not the last word of it, and we hope people will do work, but our impression from the work we have done is that it's very difficult to see how we can design ESG grounded metrics that would improve performance towards a stakeholder oriented objective, rather than just be used to increase executive payoffs without improving performance for anyone. Thanks a lot, Jeff.
Myself. Thank you, Lucian, Roberto, Renee, and everyone else. We are now going to be on our lunch break. I think Elaine was going to put in the chat instructions on the lunchroom if there is still one today, as there was one yesterday. We will return at the local time, which is also US Eastern time, of 1400, also known as 2 p.m. So see everybody then.
Hi, Jeff. That's working perfectly. If you want to click through to the next one.
I'm working on my slides now, and I'll send them to you, Elaine, and Jeff as soon as I get them done, which should be in about 10 minutes.
No problem. That's great. Yeah.
All right. So basically, I should stop sharing.
No, leave it there for the moment. So you're not in full screen mode. So if you want to just click, do you know how to go to full screen mode?
Is that full screen?
Yeah, that's working. And then if you want to click through to the first slide and just make sure that that's working. Yeah.
Is that working?
Yeah, that's perfect. So if you can do that all again when.
All right. Actually, let me try this. So basically, does it still show up here or not?
No, that's bad. That's what happened at the last event.
So basically, I need to do it. So what I should do is shift my camera. Let me get my there.
Okay.
Let me get where's the this always happens. All right, so I always have this trouble in class. So basically, where my controls is the question, right? So, whoops.
Do you want to stop sharing? And
No. All right. So basically, I now see. So basically, what I want to do is, all right, resume share. So basically, I just want to look at me. All right. So start video. So basically, am I full screen now or not?
So your slides are not in full screen, but it's
all right. And so they're full screen now, right?
I don't think so, but good enough. I can still see the top of your screen. I'm not sure. I think you're sharing. Oh yeah, it's just the window. It's not your desktop. This is fine for me, but I can still see the icons across the top. So if you want to click through this.
Oh, yeah. I see what you're saying. Right. Yeah. So basically what I need to do is to get rid of view. I just, oh no, what do I do?
Yeah,
Page display.
I can't see because the text is too small, but if you go to view and then towards the end of the view options, there should be a slideshow.
No, but this is a PDF. So
wait.
So it's full screen mode. There we go. That's it.
That's excellent. Yeah.
All right. So basically, if I were to have my, because I want to be looking at my slides. So basically, yeah. And so
the top of your head is cut off a little there on your.
Yeah. No. The thing is, if I'm looking over here at my slides, damn it. Okay. So if I do this, let me just see. So basically.
That works. I think this is a good setup.
All right. So that works. All right. This is weird. But we will survive. Okay. All right. So this is what I need to do. I need to have it. I'll leave it like this.
Yeah.
Okay. All right.
You want to stop and do it again just to make sure you have it, or?
Yeah, let me just stop share. Okay. So I've stopped shared. And now I will share screen. And it will be screen 2. Is this it? Okay.
Nothing yet. Oh, yeah, here we go. Perfect. Yeah.
All right, great.
And then just click through there.
Stop share.
Oh, that's fine. Yeah.
Okay. All right.
I'll let you know anyway if it doesn't come up clearly.
Yeah. Thank you.
No problem. Thanks.
Did I try to?
Of course.
Thank you. I didn't realize that it was 30 minutes before morning. I thought it was 30 minutes before. I only read the instructions more careful. Thank you.
Nobody minds. It's just Zoom.
How is it?
That's good. Yeah, perfect. And then it's taken. Yeah, excellent. Thanks, Nadia.
Good afternoon, everyone. It is time to resume our sessions for the last panel of the day and of GCGC 2021. We'll have Nadia Malenko from Michigan presenting her paper about the voting premium, co-authored with Doran Levitt and Ernst Mogg.
Thank you very much for having our paper on the program. And Daron and Ernst are here in the audience as well. So this is a paper about the voting premium. Shareholder voting is a central mechanism of corporate governance. It empowers shareholders to elect directors, approve major corporate transactions, and decide on ESG issues. And because cash flow and voting rights are bundled together in shares, the desire to accumulate voting control and exert influence through voting can give rise to a voting premium on the price of the shares. The asset pricing implications of control rights have been studied extensively. Theoretically, the main argument, which has been very influential, links the takeover premium to takeovers and contests for control. However, certain empirical facts cannot be fully explained by this argument. First, the voting premium appears to be largest in economies where firms are well protected against takeovers and control contests hardly ever take place. Second, some papers have shown that the voting premium is largest around shareholder meetings compared to other periods of the year. Moreover, if we look at the large empirical literature that tries to estimate the voting premium, additional questions arise. So this table shows the results of 40 studies that use 5 different methodologies and the average estimate of the voting premium within each methodology. These studies report conflicting magnitudes of the voting premium, both across methodologies and within studies using the same methodology. Some studies report a voting premium that is indistinguishable from 0, which is quite different from other studies. And moreover, other studies report a negative voting premium for some companies in their sample. So overall, these gaps and conflicting conclusions suggest that the theoretical underpinnings of the voting premium are still incomplete. And to address these challenges, in this paper, we develop a unified theory of blockholder governance and voting premium. In our setting, there are minority blockholders and dispersed shareholders who trade and then vote their shares. And this is motivated by well-established evidence that minority blockholders are common in developed economies, and they often exercise power through the voting process. In this setting, the firm's ownership structure, voting outcomes, and asset prices are all endogenous and give rise to a voting premium. And that allows us to study its determinants and try to understand and interpret the empirical evidence that I told you about. So to see how we do this, let me present the model. In our framework, shareholders trade and then vote the shares they own. So they trade in the baseline model. There is one class of shares. They trade in a competitive market. There is a blockholder and dispersed shareholders. And they trade from some initial endowments and trade optimal amounts for them. Importantly, the blockholder never becomes a controlling shareholder. So we focus on the case of minority blockholders. And also, the baseline model features one blockholder, but we have an extension to multiple blockholders that has similar features. After the trade, shareholders receive news about the proposal. You can think of this news as disclosure by management or recommendations of proxy advisory firms. And then shareholders vote the shares they own. You can think of an M&A proposal, a proxy fight, or ESG issues. And importantly, the vote base is endogenous. It is determined by the trading decisions. Shareholders who buy more shares will have more voting power. We assume that shareholders have heterogeneous preferences regarding the proposal, and I will refer to these preferences as biases. And by assuming this, we rely on substantial empirical evidence that shows that the preferences of shareholders are heterogeneous across multiple dimensions: governance philosophy, social and political ideology, time horizon, and others. And that this heterogeneity in preferences manifests itself in how shareholders vote. Specifically, a shareholder with bias B towards the proposal votes in favor of the proposal if this public signal about the value of the proposal and his bias are together, the sum is positive. And that means that a shareholder with a large bias towards the proposal who likes the proposal will require relatively little evidence to vote in its favor. So when voting, he will apply a low cutoff on this signal to vote in favor. On the other hand, shareholder with a small bias who dislikes the proposal will require a lot of evidence to vote in its favor and applies a high cutoff on this public signal. So let's see how these individual voting decisions translate into aggregate voting outcomes. So let's look at how total votes in favor of the proposal depend on the realization of the news about the proposal. So first, consider the votes of dispersed shareholders. Quite intuitively, the more positive is the news about the proposal, the more shareholders are who are convinced that the proposal is beneficial for them. So this curve is increasing. In addition, there is a blockholder who has this bias, and the blockholder follows a similar cutoff strategy. So once the news receives this cutoff, there is an additional block of shares, alpha plus Y, so the blockholder's endowment plus the newly traded shares that are voted in favor of the proposal. So altogether, this is the overall support for the proposal as a function of the public signal. And this jump implies that the blockholder has influence on the voting outcome. He's pivotal with a strictly positive probability. So how are decisions made? Suppose the decision rule is simple majority. Then the proposal is approved if more than 50% of shareholders vote in its favor, which means it will be approved if the public signal exceeds this cutoff Q star. You can think of it as the decision rule that shareholders follow. And also you can think of this Q star as essentially the decision cutoff of the median shareholder, the median voter, the voter with median preferences among the post-trade shareholder base. Note that in general, the blockholder is different from the median voter, which means that the decision is not fully aligned with the blockholder's preferences. However, by trading, the blockholder can affect the median voter and through this exert influence on the voting outcome. In particular, suppose the blockholder buys more, so we increase Y, the number of shares he buys. Then he owns a larger block of shares. And in addition, dispersed shareholders anticipate that the decision rule will be different and also trade differently. So all this, as you can see, moves the median voter closer to the blockholder. So by buying shares, the blockholder makes the decision rule more aligned with his preferences. And at some point, if he buys a large enough amount, he even becomes the median voter himself, in which case the decision rule is fully aligned with his preferences. Note that after that, further buying of shares doesn't change the median voter anymore. That's still the blockholder, even though the blockholder still holds less than the majority of the shares. So now that we understand how trading affects voting, let's look at the trading stage. For any given trade Y of the blockholder, anticipating the decision rule Q star, we just saw how it depends on the blockholder's trades, the share price is determined by market clearing. And to understand what will be the equilibrium share price and to understand the implications for the voting premium, we need to understand how much the blockholder will optimally trade in equilibrium. We show that the blockholder has two motives to trade. The first motive is the cash flow motive. Because shareholders have heterogeneous preferences regarding the proposal, they have different valuations of the shares, and that creates gains from trade. In addition, the blockholder specifically also has a voting motive to trade. As we saw, by buying shares, the blockholder moves the median voter towards his direction. This voting motive will be key for the voting premium, so let's understand it a little bit further by looking at the blockholder's payoff, which is given by this expression. So the first component captures the value of the blockholder's stake. This term is the blockholder's valuation of any single share given his bias, and this is how many shares he buys, the endowment plus the newly traded shares Y. The second component is how much he needs to pay for these newly traded shares, and then there are also some trading costs. So now we can see both motives to trade. What is the effect of an additional share that the blockholder buys on his payoff? The cash flow motive is captured by the direct effect of Y on the blockholder's payoff. And if that were the only motive to trade, and the decision rule were taken as given, then the block holder would buy this amount of shares, Y cash flow. However, the block holder also has this voting motive to trade. And this is captured by the indirect effect through the influence on the voting rule. In particular, by buying an additional share, the block holder can move the median voter, and the change in the median voter affects his payoff, both by affecting his own valuation of the shares and by affecting the price at which he is buying the shares. So this voting motive to trade means that the block holder will buy a different amount than if he were trading purely for cash flow reasons. He would buy some amount Y star. So now we can understand how the voting premium arises. When the block holder trades, he faces an upward sloping supply curve from dispersed shareholders. If the block holder only traded for cash flow reasons, taking the decision rule as given, then the price would be given by this function as a function of this Y cash flow. However, because the block holder also has a voting motive to trade, the equilibrium price is different. And this difference between the two prices is our definition of the voting premium. Importantly, this voting premium defined this way has an appealing empirical counterpart. It captures the dual class share premium. We show it by considering an extension to two classes of shares, voting and non-voting, and showing that this price differential captures the difference in prices between voting and non-voting shares. And the dual class share premium is the common way to empirically estimate the voting premium. However, we emphasize that the voting premium definition is generalizable to any firm, not necessarily with two classes of shares, because this voting premium component will be always present in the share price. And the easiest way to think of the voting premium is the price differential right before versus right after the record date. At these 2 points in time, the expected decision rule is the same, and the only thing that changes is that shares lose their voting rights. So now that we understand how the voting premium emerges, let's consider the implications. Our first implication is that the voting premium generally underestimates the value of voting rights. And to see this, note that if the block holder is the median voter, then the voting premium is zero. Indeed, if we consider the cash flow and the voting motive to trade, the second voting motive to trade is zero if the block holder is the median voter. If you remember, once he becomes the median voter, he can no longer affect the identity of the median voter by further buying the shares. But the fact that the voting premium is zero doesn't mean that the value of the voting rights to the block holder is zero or small. The voting outcome has been affected by the block holder's accumulation of shares because the block holder was not the median voter at his initial endowment. He moved the median vote and changed the voting outcome. And this difference arises because the voting premium reflects the marginal rather than the average willingness to buy shares. Our second implication is that the voting premium doesn't emerge from exercising control, but rather emerges from influencing who exercises control. And specifically, the voting premium arises exactly because the voting premium can affect the identity of the median voter, can move who is influencing the decision rule by his shares, even if the block holder himself has a small stake. In fact, the voting premium can be negatively related to the block holder's voting stake. To see this, suppose that the block holder buys few shares in equilibrium. His stake is small and his probability of being pivotal is small. Then, as we saw, the block holder is not the median voter. One of the dispersed shareholders is the median voter. And this means that the voting premium is positive. The block holder would like to buy additional shares and make the decision rule even more aligned with his preferences, but he doesn't do so because it is too costly for cash flow reasons, because voting and cash flow rights are bundled in shares. In contrast, if the block holder trades a lot and becomes the median voter himself, then the voting premium becomes zero. So this comparison shows the negative relation between the voting premium and the block holder's voting power. Our third implication is that the voting premium can be negative. And this is consistent with several empirical papers that document a negative voting premium for several companies in their samples. And to see the intuition, consider proposals that concerns the firm's environmental and social policies. For example, suppose that the block holder and dispersed shareholders both favor the adoption of an environmentally friendly production technology. And moreover, suppose that dispersed shareholders favor this environmentally friendly production technology even more than the block holder. As the block holder buys shares, remember, he moves the median voter in his preferred direction. So that benefits the block holder and increases the value of his stake. However, it also benefits the dispersed shareholders because they also like the environmentally friendly production. Essentially, what happens, shareholders benefit from the block holder's accumulation of shares. Their valuation of shares increases, and now they demand a higher price to sell their shares to the block holder, free riding on his accumulation of shares. As a result, if the block holder buys, the price which captures shareholders' valuations increases even more than the block holder's own valuation, exactly because shareholders are even more environmentalist than the block holder. And that means that this price impact of trade is too strong, and the value of control becomes negative. The block holder prefers not to accumulate voting rights to avoid increasing the price by so much. And as a result, he buys fewer shares than if he were buying purely for cash flow reasons. That gives rise to a negative voting premium that is consistent with these several studies. Now, this logic also leads to our fourth implication. We show that the price impact of the block holder's trades, which is a common measure of liquidity, arises endogenously due to voting considerations. And the reason is that, as I just explained, as the block holder accumulates shares and moves the median voter, shareholders' valuations change because they anticipate different decision-making policies. In particular, if the block holder and dispersed shareholders' interests are aligned in that the move of the median voter benefits dispersed shareholders, then their valuations increase, and that increases the price impact of the block holder's trade, reducing the liquidity of the shares. On the other hand, if the interests of the block holder and dispersed shareholders are not aligned, are in conflict, so that the movement in the median voter hurts dispersed shareholders and decreases their valuations, then the price impact is lower, so liquidity is high. So overall, this suggests that the liquidity of voting and non-voting shares will generally differ, and which of these two types of shares is more liquid depends on the conflict or alignment of interest between the block holder and dispersed shareholders. In the paper, we have some other implications. We show that the tension between exit and voice arises in our model as well, and that exit can be consistent with a positive voting premium. We analyze the premium in block trades, and the block premium reflects the value of the entire block of votes being sold rather than the marginal value of the vote. And we also analyze the market for votes and emphasize that the price of a vote that is traded separately from cash flow rights is fundamentally different from the price of vote that is traded in combination with cash flow rights. So let me now go back and try to interpret the empirical evidence that I started my presentation with in the context of our model. So first, our paper shows how the voting premium can arise in economies where takeovers and contests for control hardly ever take place. In our setting, the voting premium arises because minority block holders exercise influence through the voting process. It is also consistent with the evidence that the voting premium is largest around shareholder meetings compared to other periods of the year. We emphasize that estimates of the voting premium that are close to zero don't mean that votes are not important or are not valuable to their owners. And this is because of this difference between the marginal versus the average value of the vote. And this also means, for example, that the estimates based on the block trade premium, which captures the value of the block, could be quite different. Finally, our model rationalizes a negative voting premium, which has been documented in several studies. So to conclude, our paper presents a unified theory of blockholder governance and the voting premium, and we focus on the asset pricing implications of the blockholder governance and offer a reinterpretation of the existing empirical measures of the voting premium. Thank you, and I very much look forward to the discussion and your comments.
Thank you, Nadia. Now, Professor Ernst Ludwig von Paden from the University of Mannheim in Germany will provide comment.
Thank you. Thank you very much. Let me try to share my screen. And see. Can you see the screen now?
No, no.
No. Okay. So let me see. Sorry again. So what is it going to? Here it is. See? Sorry for this. Here we go. Here's your finding and this is what you should see. Do you?
Perfect.
Okay, very good. So thank you very much. Thanks for having me on this program, and in particular, thanks for having me discuss this paper, which is a beautiful one, and it was a pleasure to read, and it is not exactly trivial. So it's great fun to work through it. And I'm grateful to Nadia that she has presented these intuitions so well, because some of the formulas are unpleasant. And so I don't have to bother you with those, and can move, hopefully, right into my discussion of the paper. So as Nadia has, I think, made it very clear, this is a paper that asks a very simple but very basic and important question. And it's sort of like with many very good papers, the issue is really, why haven't people asked that question before? But you will see that it's in fact not exactly easy to address this question. And so maybe there's a good reason that this hasn't done before. So the paper asks the following deceptively simple question. Why is there a stock premium on shares bought by block holders, even if these blocks are too small to directly control the vote in a general shareholder assembly or the outcome of a tender offer? So, as Nadia pointed out, papers on corporate control and corporate governance very often consider the issue of who is able to win a tender offer or a majority contest. This is not the issue here. We're talking about smaller stakes and how do these smaller stakes play out. And the answer may be sort of at first sight, yeah, of course you want more shares because you can have more influence or something like that. No, but I mean, it's definitely not as easy as that. And the subtle answer that the paper is providing is what I wrote down here. It's from the paper. This is because in a vote, there is a difference between being pivotal and being the median voter. And so this is almost the summary of the paper. It really depends on how far you want to dig, and given Nadia's work, I don't have to go too far. Let me, at the moment, just link this to the first day of the conference. Remember Alan's paper that he presented yesterday. In fact, it's sort of funny. We could have had a very nice session on the theory on empirics of block holders or corporate governance with blocks. The quote here I have, in fact, is right. It's a quote from his slides. So I don't know where, but so I could recycle that. So his question was, do retail investors matter for corporate voting outcomes? And the answer is, in fact, up here. No, this is exactly why they matter. He didn't make that so clear yesterday, maybe because he hadn't seen Nadia's paper before very carefully. But this is the answer to the question Alan was asking yesterday. So, of course, retail investors matter for corporate votings. And clearly, they vote sort of, they matter for simple legal reasons. They have the right to vote. But more subtly, they have, in fact, a role to play in how sort of the larger interests are being played out. And this is what this paper now is looking at. And so the reason is, in fact, again, as Nadia said, the voting premium on shares does not emerge from exercising control, but rather from influencing who exercises control. And so that means this is where the retail investors come in, because they are the ones who will express their view, but they will express their view in a way that has been framed or that has been set up by the block holder in the model. And the argument is that in a strategic voting game, and we'll maybe talk about the notion of games a little bit later, which is not exactly clear in the paper. In the strategic voting game, disentangle the marginal profits from additional cash flow and the marginal profit from additional voting rights. So the first one is well known. We have been talking about this since Grossman-Hart 88 and whatever. And the marginal profit from additional voting rights is much less well understood. And this is where this paper comes in and tries to clarify what's going on. What I want to do in my discussion is I want to ask a few, or want to address a few issues, but hope to be constructive because it's literally what came to my mind when I was reading that paper. So the first question I really had when reading the paper was, what are block holders, in fact? And sort of that is something which one needs to be quite careful about, because in the paper in LMM, a block holder is defined by two distinct features, and it's quite important to understand what these features do to the theory. First, she owns a block, and that is, let's say, alpha, if you are in the basic model of shares, and she's the only one to own such a block in the basic model. And that is basically the theory I'm going to discuss, and that's the theory that is mostly discussed in the paper, I should also say. And the second point that defines a block holder is she publicly trades a quantity Y, and she does this before dispersed shareholders. That's how it is set up. So she has, in fact, two roles. And I was wondering which one is crucial, or maybe both are crucial. In fact, it turns out that the block ownership is not really crucial, because the whole theory goes through for alpha equals 0. That means a block holder who has no block. And in fact, it turns out that if you have no block, quite intuitively, as proposition 3 is saying, that the voting premium is mostly negative, but that's something that must be discussed in a little bit more detail. In any case, the theory goes through for block holders that don't have blocks. In fact, the question then is the second bullet point really required? And in fact, no, it's not really required either. The specific timing structure is actually not relevant either. In particular, this is not a paper about asymmetric information. So it's not that the quantity Y transmits any information that is useful later on. And in fact, the dispersed shareholders do not condition on Y either. That is not always exactly clear, but when you look at the formula, it's clear. So they maximize simply by looking at prices and their own valuations. So in that sense, they have bounded rationality. They're not using the information that they could use, namely the quantity Y that is assumed to have been revealed before. But in fact, they understand the cutoff point QE star, which is rational expectations. So these people are somewhat limited, boundedly rational. But in any case, here's just a small remark, which you may want to look at, Nadia. It's not a big deal. Formula 10 is a little bit misleading because here it's not demand for shares that depends on Y, but it's in fact equilibrium trades of shares that depend on Y. So that's an equilibrium relation. Upshot is here, it's neither important that the block holder has many shares, nor is it important that she trades publicly before the shareholders. The only thing that matters is that block holders have price impact and use this price impact strategically. So that's what the paper understands by the word block holder, and there is something to that. It's a strategic instrument, and of course the paper is about strategic voting and strategic trading in the context of voting. So let me now turn to the issue of multiple block holders, now that I have clarified what a single block holder is. And of course, now the question of what a single block holder is becoming even more important, because there are many small shareholders in firms, and there are many shareholders who would like to be taken seriously in the sense of influencing the trades of others. And the question is, how does that happen? So I've just written down here a large company close to where I live, SAP, the software firm, in Waldorf. So the 4 biggest shareholders of SAP hold something between 3% and 6% of SAP each. These are two very different groups of people. The first 2 are the initial founders, and the other 2 are BlackRock and Vanguard. So, and then there's a couple of investors who hold something between 0.5 and 1%. So in that sense, there's a lot of block holders around. And so the question, what do block holders actually do in such a situation, is important. And fortunately, Nadia was kind enough to provide an online appendix in which the 3 of them, discuss what the block holders in fact do when there are several of them. They have 2 examples here, many similar block holders, in which case the voting premium disappears, so the theory becomes a little bit less, let's say, interesting, although it's clearly what you would expect. And then an extreme case with 2 block holders with extreme opposing views, where the voting premium becomes very important. So there is discussion in the online appendix about what I would consider is the most important issue to consider. And in fact, next to that, I would think it would also be important to look at, in fact, what Alan was also discussing on Friday, namely the story of many different small shareholders. And so in Nadia's paper, there are homogeneous continuum of small shareholders. What we have learned from Alan was that, in fact, there are different types of dispersed shareholders of different account sizes and sophistication. And in fact, there is a correlation between stake size and voting turnout. So there's a whole life in this group of anonymous atomistic shareholders in Levitt et al. And so the conclusion for this first comment is, as usual with good and elegant simple models, the reality is more complex. Several relatively small but non-atomistic shareholders with some limited price impact and some voting impact. And the question is, how do those interact strategically? And what we have seen in the paper is really looking at 2 extreme outcomes in this continuum of possibilities. And I'm pretty sure that this is very much informative, but it's definitely not conclusive as far as I can see. Second comment, since I'm running out of time already, let me quickly, let me skip that. Let me just come to a discussion which is, I think, useful also for the audience to understand the paper better, because that's something where the paper is a little bit, let's say, a little bit brief on the practical or empirical side. So what we have and what the paper models is, we have a vote which is forthcoming, a general shareholders assembly or whatever, and you have trading of shareholders who may realign their shareholdings, and then there's a public signal at which, excuse me, a public signal at which people learn about the value of the proposal to be voted on. And before that, of course, there is a record date, and the record date is the crucial date at which it is determined who's allowed to vote. So the paper is explicit about that, and so we have first trading, and then at the date which I discuss in a second, it is clear who is a shareholder, and then people continue being shareholders or not, depending on what they did here. There's a public signal, and a few weeks later, often there's a vote. So very reasonable, basic trading and information structure. But of course, you can think about much richer structures. And I think these richer structures are important because that's what reality really is. Namely, there's more trading potentially going on, and there's potentially more signals being around. And so the question is, how does that affect this very basic analysis that we have just seen? So for example, you could have trading after the signal, which would be up here. So now people have recorded their ownership, and they may already trade out of the stock for various reasons that we could discuss in the model. And this is not unreasonable because they have seen the signal and there may be scope for trading. Also, you could, for example, have private information before the record date. And so that means there may be signals here which lead to different types of trading. So these are two examples that are relevant in practice. And what I've given here is a very nice paper by Vyacheslav Foss and Cliff Holderness. In fact, a ECGI working paper of April this year, so very recent, which talks about exactly this problem. So it really comes along your way very nicely, Nadia. And I'm sure, in fact, you know it, I'm pretty sure, but it would be nice to discuss that in your paper as well. Because what struck me when I read the Foss-Holderness paper is that, in fact, things are much more unclear than your beautifully simple description suggests. In fact, they were surprised by how unclear things are in terms of legal terms in practice. And so let me just give you the facts of the Foss-Holderness paper as a contrast or as a complement to what Nadia told you in her model. So a couple of findings which are in fact quite interesting and which we would now have to reconcile with the predictions and descriptions of the LMM paper. So finding one, trading volume increases before the record date. It declines around the record date and can increase, but not always, after that date. That is a richer prediction than what you have in your model. And in particular, it points to the fact that it may be important to include a second round of trading in the model to really make sure that you capture everything that's going on. Second finding, stock prices decline after the record day. So that is certainly consistent with what you have, at least I think you could argue it is. Most of this is driven by votes involving proposals by dissident shareholders. Dissident shareholders are shareholders with potentially large Bs in your model. So that's something which you could in fact work on and see whether this is true. I think it is, but the model by as such is currently, I think, too simple to address it. Finding three, for some important votes, and important in that paper is defined as being controversial and close, there is little trading activity around the record day. For other important votes, there are market changes in trading volume and stock prices. So it seemed to be that not everything is going the same way. So there's heterogeneity, which is potentially in the spirit of what you are discussing, but it would be nice to see how it really fits in. The most interesting and surprising findings, though, are the findings that this is all a big mess, practically speaking. And I was quite amazed to see that. They were amazed as well. In fact, it's not at all easy to say what is the record day and how do things play out. So your nice game, the strategic timeline that you wrote down, Nadia, seems to be completely unclear in practice. And here's finding 4. In 91% of all cases they study, and they claim to have a very large sample, which I guess it's true, given Cliff's reputation. Firms file a proxy notifying shareholders of the record date after the date. So that means it's not even clear whether you are trading before the record date or after the record date for most people. And in fact, it's even worse. The NYSE, where most of these firms are listed, they are looking at, requires that firms notify the exchange 10 days prior to the record date. And when you think that this is good news, it's not. However, the NYSE does not inform the public. It rather sells the information at a high price to select individuals. I couldn't believe that when I read it, but I mean, you can read it yourself. It's an ECGI discussion paper. And so that means that much of the trading structure that you are using and I was discussing in my previous comments is in fact not exactly clear. And there may in particular a strong role for private information that you don't model at all. Okay, I skipped the next slide, which I sent you the slides, so you will see that. I think there are 1 or 2 things that one may want to look at more technically, in particular this gamma cost here is something which I'm not fully sure I understand, and you need it, it's important, and so one would have to think a little bit more about why trading, in fact, is really unpleasant in the stock market. And the other thing is you mentioned multiple equilibria. Let me simply quote from Franklin Allen's slide of yesterday. I noted that from the screen. The possibility of multiple equilibria is mentioned in section 4.2. Is this important, and what can be said about this issue? So just recycle what was said, and in fact, that is an interesting finding that you have, and it would be nice to understand whether this is a problem or whether there's an opportunity for your analysis. And sorry, Mariana, it was a little bit longer than I had hoped, but almost in time. A fine piece of theory, diligent in execution and rich in discussion, set in symmetric information in a field that is mostly concerned with asymmetric information, which I view as a plus. Symmetric information is simpler, but of course, much of what's happening may be due to asymmetric information, and you may have to worry about it. And the more, let's say, nuanced final statement, the distinction between pivotal and median voters is insightful and appealing. How will it fare in the complex world of many asymmetrically informed small block holders and managers, documented e.g. by Faust and Holderness? So you have some more work to do, but I'm excited by your agenda. Thank you.
Thank you, Ernst. Nadia, would you like to briefly respond before I collect additional questions?
Sure. Thank you so much for this constructive and positive discussion. So just a few points, there were many. So yeah, we should definitely emphasize the difference, right, between the block holders and dispersed shareholders and what exactly distinguishes between them. As you point out, with multiple block holders, we probably should bring this more into the paper. There are very similar forces, but for example, what we show is there is a big difference whether these multiple block holders are aligned or are in conflict. And maybe we should emphasize this more and related to the main findings. Timing, yes, very, very interesting. So just to clarify the way we think about the timing, this public signal, we think about it, for example, as the recommendations of proxy advisory firms, which typically come before about 2 weeks before the vote after the record date. So that's our rationale for the timing. And the paper by Slaver and Cliff is very interesting. So I think our model could probably easily incorporate this uncertainty about whether the record date is before the trade or has already something happened or after the trade. So right now we assume it's 100% after the trade, but with uncertainty that would probably decrease, right, the magnitudes, and that would be consistent with they do observe a volume around the record date and the price drop, which is consistent with our paper, but their magnitudes are sort of small, so that would be consistent, right, with this uncertainty about the timing of the record date. So we should probably extend the model to capture this. And yes, information asymmetry, that's definitely very important. All of us have worked on information asymmetry in voting, as you know. So for this setting specifically, we wanted to abstract from information asymmetry issues and focus on the simplest setting that give rise to the voting premium, given this evidence about heterogeneity in preferences. But yeah, absolutely, it would be important to think about it. Thank you again.
Jeff?
Congratulations on such a fine piece of work. It seems to me that your work interacts with work that's been done by Josh Schmitz at Columbia on short sales. Because if we're thinking about the difference between a median voter and a pivotal voter and the extra price for that, the short sale market might be a very good one to examine because presumably I mean, as Josh shows, the price, the short sale value can vary a lot depending on the nature of the vote and other factors. And that might be a good place both to motivate some of what you show, but also to get some data that adds energy to the claim about the nature of what counts as the reason why you might see a premium for voting.
Should I respond or collect all the questions?
How do you prefer to proceed, Nadia?
Okay, yeah, maybe let me respond. Yes, thank you. We should definitely look into that. So we've looked. We have some extension that I haven't had time to discuss about separation of cash flow and voting rights. And for example, the share lending market, right, is one way to separate votes from cash flow rights. And one thing that emerges from there is that the price of a vote in the share lending market, when they are separately traded, like you said, right, separately from cash flow rights, is very different and would give rise to a different price than when it's bundled, like for example in dual class share settings. So we should definitely look at this paper and relate to it. Thank you.
Rolf?
Yes, thank you so much. Thank you, Nadia, for an excellent presentation. Extremely interesting. I can't help thinking a bit about the relationship between your study and Christian Rydqvist's study in 1988. And I noticed you had it there in the list of references. Now, Christian applied the theory of oceanic games, but I think the outcome, as I recall it, when we worked together, the major outcome of his study was just this value of the pivotal vote, so to say. Could you maybe elaborate a little bit on the relationship? That would be great. Thank you so much.
Absolutely. Yeah, so the way we see the difference is that in Christian Rydqvist's paper, there are these atomistic shareholders, but they have a collective action problem, but somehow outside of the setting, he assumes that they resolve it and vote collectively, right? And that's essentially what makes them pivotal and gives rise to a voting premium. So what we don't assume that these atomistic shareholders can somehow collectively resolve the collective action problem. In our setting, each shareholder just cares about his own value and doesn't in any way coordinate with others. So that would be the difference.
Marco?
Yeah, I mean, just commenting on Edo's SAP example. So you had the founders and then you have BlackRock and company. Now, of course, it's always possible that an activist comes in. So it's not just the static picture, but it's actually, that's not a takeover, but it's, and there will be a huge disagreement between the activist and the other people there. So I think in your appendix, that would be the example. Now, so what's then a situation where you don't have a disagreement? So it actually, it doesn't matter that these small shareholders influence the outcome. And I think the only example you can think of is a case where somebody controls 50% of the votes, and there it really shouldn't matter. So what happens in such a situation in your model in a controlled company where the control is really clear, both in a takeover situation, but also if an activist comes in?
Right. Yeah. So right now we specifically assume that the blockholder never becomes the controlling shareholder. Yeah. Right. So suppose at the point when he's fully in control, right, after 50%, at this point there is nothing, right? Neither the median voter changes nor he just always determines fully the decision, right? So once he becomes the controlling blockholder, the identity of other shareholders doesn't really matter. And we want to. Yeah. Sorry.
Yeah, I mean, it is the global corporate governance colloquium, and you can see Mariana who goes, because we have Brazil and, dual class and controllers, and I think they do have voting premium with controllers, so that might be a problem.
Yeah, so I actually wanted to ask you a question about this, because you say that you study why a voting premium emerges in the absence of takeovers or controlling shareholders, which is arguably the empirically most relevant setting. I think I'm with you with the takeovers, but not quite with controlling shareholders. And I was curious about that because one thing that we see in many countries is that you have controlled companies with dual class shares. You see them around the world. Now you see them in the United States. And you seem to refer to those studies that measure the voting premium in dual class shares for purposes of your context. But then I was a little bit confused about whether your model applies. I thought it didn't to companies that have controlling shareholders, which are absolutely not exceptional. Not even in the US, among the very top, the largest companies today. So if you could say a little bit more about that, because it seems like that you might be trying to explain some evidence that covers a scenario that is different from the one you were discussing. So I was curious about that point as well.
And yeah, so maybe the confusion is the way, so we definitely don't want to say that the takeover setting, right, and this context for control is not relevant. We definitely want to say it is relevant, that's why it has been influential, it explains part of the empirical evidence, but it doesn't explain, right, as I showed, there are many facts that cannot be explained just by the controlling, by shareholders competing for majority control. So our goal in this paper was to specifically focus on the setting where, and show that the voting premium can arise without context for control and majority block holders. So we see it as complementary to the literature where there is controlling block holders.
Are there any additional questions?
I have a question, if possible.
Hi, Lucian.
Yes, just a brief comment. I think that the focus of your paper, and there is a lot in it, it's about kind of the descriptive rather than normative analysis. And for this purpose, having this bias that you have, forget what's the notation, maybe B, is sufficient. You don't really need to specify what this B is. But I think that for people who will want to work with your framework and to think about what it means for policy, what it means for various things, it would be useful for you to kind of distinguish between different cases. So way back, people were doing those models. They had the cash flows and they had private benefits. So one explanation for the bias is that you have some private benefit, and then there's a question of whether that's part of the social welfare or not. And there is also the possibility, it seems like you have some sort of a preference that is not like a private benefit. You had some examples discussed in this forum. But I think that even though you don't need it for the model, it might be worthwhile for you to think about what is exactly the nature of it. Should it count as part of the social welfare? And lastly, my impression that if you look at most of the block holders that might be considering those things, my guess is that they would probably be moved largely by private benefits of one sort or another, rather than, I don't see Norges that might have kind of preferences of another kind going to increase its shares before the vote in order to affect the vote, whereas I do see, hedge funds that might have a minority position doing that. So I think that all of this, you could kind of try to expect to go further and provide a framework for others to follow by doing work that would specify what exactly is meant and what are the different possibilities for what this bias is.
I completely agree. That's a very good point. For example, right, the implications, whether these biases are coming from tax differences could be different versus if they're coming from some social preferences. And we have been potentially considering relating, for example, the size of the voting premium to welfare. So in our earlier paper where we didn't consider block holders, we actually focused quite a lot on welfare. And there we considered, for example, social preferences versus not social preferences. So we can probably think of the same logic in the context of this paper and relate it to the voting premium. So that's a very good point.
Ernst?
Since we have a few moments, I can maybe ask something. I many things to be discussed in this paper, but one question would be, I mean, this is about important votes at the General Shareholders Assembly. So, as I said, I mean, I would think about this paper more in terms of several block holders, small block holders, quite a number, and this is the way I think you should also maybe set it up, because that's sort of a natural framework. But now think about 3 different proposals being on the agenda, and people have different views about this one. Your theory definitely can't deal with that, because you are trading in order to push exactly one agenda, and now maybe these different Bs and betas get in each other's way. Is there a way of thinking about what happens in this type of context in the run-up to a shareholders assembly?
It's interesting. So one probably prediction would be with multiple block holders, the voting premium was less likely to be zero, because even if you are a median voter, right, on one block proposal, you are less likely to be a median voter on all these other proposals. So that would be one prediction. But then of course it will matter. So the size of the voting premium will be linked to which proposal is more important, right, and which of the biases like that would determine, right, in some sense, if we can measure the importance of the proposals. Mm-hmm.
Do you think there's a way of sort of getting a handle on this? I mean, your paper seems to be really tailored to this one big decisive shareholder meeting. So the one that happens in 10 years time, DuPont 2015 or whatever, and that's it. And the rest is something about other stories. Or do I overinterpret this?
Well, no, we were hoping we are being more generally about this. So typically in many shareholder meetings, there are contentious proposals. So of course we think about M&A or proxy fights, these are clearly important, but overall contentious proposals where proxy advisors give a recommendation that is against management, for example, or contentious ESG issues. So all of these, and usually within a meeting, I would say maybe there is often we can, as a late, right, the most important proposal, right, the one that generates most controversy. And the way to think of our model is specifically, this is the proposal that we are thinking of.
Nadia, just a suggestion, if you ever want to go comparative on this, we know that the issues shareholders can vote on varies drastically across jurisdictions. So in some jurisdictions, shareholders can vote on a greater number of issues. And this is also relevant regarding the controlling shareholder context, because in some countries you do have controlling shareholders, but certain decisions are subject to a supermajority voting requirements or majority of the minority voting requirements. In other decisions, in Brazil, this is really rare. So if you are a majority controlling shareholder, you usually carry the day, and the votes of block holders will always be minority votes. So this is something that you might want to look at in the
Absolutely.
future.
And we so the way I presented, we always had 50%, but in the model, this majority control is completely flexible. So we can look at how this majority control affects the size of the voting premium and the voting outcome. So that would be very interesting. Thank you.
Oh, terrific. Thank you for a great presentation. And now we'll have Jeff Gordon presenting his paper on systematic stewardship from Columbia Law School. Jeff. Jeff, you're on mute.
Okay, yeah, good. Thank you. So in a sense, the paper picks up on a theme that was developed really in a discussion earlier. In a sense, the despair between managers on the one hand, governments on the other, is there space for hope? And the new person in the room is the shareholder, not just the shareholder in some small sense, but the asset manager, the large shareholder. So to some extent, the claim of systematic stewardship is a claim that the asset managers can play a distinctive role, not just as a shareholder, but one that thinks about systematic concerns, not just own firm specific concerns. And so at another level, a news hook here is a surprising event. One of the biggest firms, ExxonMobil, basically 3 directors were added to the board. There was a defeat of the management proposed 3 directors, and here's the line: the top 12 were elected, and three of the activists put forward by Engine One, a firm that held 0.02% of ExxonMobil stock, succeeded at this. And part of the reason that they succeeded was because of the vote of the big three, BlackRock, Vanguard, and State Street, which in total held about 31% of the shares that actually voted for these directors. Now, to be clear, investors had a lot of reason to challenge ExxonMobil because of their performance. They're rather the underperformance of ExxonMobil. But Engine One is not Elliott Management. It's not a standard hedge fund energizer. Rather, it's a firm that believes over the long term, the interests of the shareholders and the stakeholders will coincide, will converge. So it really is a stakeholder-focused firm. And to be sure, their target was Exxon, and they were able to succeed because, in part, because the coalition of the shareholders who opposed could also think that Exxon had done poorly as a management team. But nevertheless, I think the best way to understand the votes of the big three can really be as systematic stewards trying to apply a different model of voting behavior in light of the nature of their portfolio investment, which has a very high level of diversification. So the idea of systematic stewardship is this. It takes the core idea of modern portfolio theory, which is that investors are trying to maximize risk-adjusted returns, not expected returns. And that portfolio diversification, we can eliminate idiosyncratic risk, but not systematic risk. And for that reason, focusing on specific firms in the portfolio, the upside is limited because those firm-specific interventions are idiosyncratic. So therefore, for a fully diversified investor, like an index fund, the way to improve risk-adjusted returns is by the effort to reduce systematic risk. So the critical move here is that this is not a trade-off model. It's not a model that says asset managers should accept lower returns in exchange for climate preserving values out of some sense of socially responsible investing. Rather, it would claim that a systematic risk like climate change, it mitigating that risk will enhance risk-adjusted returns. And so we're not engaged here in socially responsible investing, but rather we're driven by finance theory in the hunt for the best risk-adjusted returns, nor is this a claim that universal owners will internalize all of the externalities. There's an overlap where the interests of the systematic steward and those of the society coincide, but it's a finance theory-based conception of welfare, not a general theory. But nevertheless, it does offer a promising route to make headway on some wicked hard issues that now are before us. And so, to put it in grand terms, the goal of systematic stewardship is to provide a foundation for a form of engagement by large investors and asset managers with their portfolio companies and with the broader environment that fits their model of investing and their low-cost business model. So, summary of the talk, maybe I'll get on with it in the interest of time. So where does stewardship come from? Two factors. First is the concentration of share ownership in the hands of these large owners, which overcomes collective action issues of dispersed share ownership. Secondly, there is a theme that's kind of familiar to our discussions, which is the global governance deficit. These large firms are both the cause, the global firms are the cause and the and both part of the solution to many wicked hard issues. Shareholders have power over firms that are otherwise too big to govern. So the shareholders, unlike country, have transnational governance rights. I think that's a distinctive feature. And so the big move is we start with stewardship with a call that these owners should just vote as informed shareholders. That I associate with the Bebchuk-Hurst position, but actually it's morphed into a call of their accepting additional responsibility, especially in the EU, with the focus on sustainability. So again, I want to say this is not just about the universal owner, because I think we have to appreciate that given the distribution of share ownership, who owns these shares, there's going to be a difference between the interests of the shareholders and society at large. Nevertheless, there is significant overlap. That's the value added here. And there's also risk that governments will begin to load responsibilities on these firms that go beyond what I think the business model sustains. And the EU is a perfect example of that with sustainability and the particular directive that's on offer. So let me just say, again, a little bit more about stewardship, particularly in the United States, and where the business model, I think, is a constraining factor. Asset managers are rewarded for superior relative performance, measured in stock market returns. They compete on the basis of lowest fees. And so what we see is a high level of diversification. The index fund essentially is the limit case. So the question is whether stewardship is really consistent with this model. And so the model I'm trying to offer is a form of stewardship that is consistent with that model. So what are the kinds of stewardship? Well, they're guidelines for voting across the portfolio. We see that. There's in effect, the interaction between the performance activists and the investors, the asset managers that Ron and I described before. And then there is a performance-focused engagement on firm by firm. We don't see much of that, as Lucian has already shown. So what's the ESG stewardship that's possible? What's the model that fits the fund's investment strategy of extensive diversification and a low-cost business model? So first, what is systematic risk? It's risk that cannot be diversified away, obviously. But what is it? How do we identify it? Generally in finance, we've seen it move away from a structural model to essentially a data mining model. But I think there's an alternative approach. Robert Barrow started this, I think, in the sense there's an unexplained residual systematic factor that is the risk of rare disasters, the overhang risk of the black swans, the green swans, which has definite impact on price. The further point is that we believe that systematic risk can be modifiable. It's not just out there. It's not just fixed. Indeed, I would say that Basel III, Basel IV, which is a very expensive regime governing financial firms, is an effort to change, to reduce the level of systematic risk associated with financial sector. So the question is, what are the potential targets of this model? Well, one of them, obviously, is climate change risk and economic harm that would affect values across the diversified portfolio or manifest. And we're all familiar with the horrors of non-linear risk realizations, the Greenland ice shelf slipping into the Atlantic. That's a profound, massive economic harm, obviously. There's also financial stability risk. The great financial crisis shows the potential for that. There's one more contentious social stability risk, which is, I want to that's obviously going to be where a lot of debate occurs. But modern portfolio does create a distinctive risk for social stability because it limits the capacity of private firms to provide stakeholder insurance, especially for the employees, against the adjustment costs of economic change. And it adds an accelerant to the rate of such change. So let me just spend a minute on the mechanism for that. First, what modern portfolio does, I teach this in M&A every year. It promotes diversification at the portfolio level, not at the firm level. So what we see is an emphasis on focused firms, the effort to eliminate inefficient, unrelated diversification. We encourage risk-taking at the firm level. The shareholders are diversified at the portfolio level. They want risk-taking at the firm level, which means that there's going to be a higher rate of firm failures or the need to contract. So what's the result? There's going to be risk shifting associated with this, risk shifting on employees particularly. Senior managers can adjust to the change in risk because they get higher stock-based pay. The creditors can adjust. But I haven't seen any evidence that the employees adjust. So what it means is that the firm can't now credibly supply lifetime employment insurance, and the business cycle will be shorter than the career cycle. So the result of this, again, this flows to some extent from modern portfolio theory, which is inherent in the way that these large funds invest. It's not just a heightened dislocation in careers and life circumstance, but a growing setup that the setup, a growing sense that the setup produces the unacceptable distribution of gains. And so we run the backlash risk with systematic implications, and that's the point. So how would we implement systematic stewardship? Well, there are basically three strategies, one of which is that we could empower the ESG activists through voting. The Engine 1 case is a clear example. We could empower the managers through voting. So, for example, if exercising their business judgment discretion, managers wanted to have a soft regime vis-a-vis employees or build housing or whatever, conceivably a systematic steward could vote against the activist who would be going after the management team. A third way is that the asset manager could take actions on its own initiative. These are portfolio-wide through guidelines as to how they would vote on specific shareholder proposals, or perhaps firm-specific proposals or proxy contests, which would obviously be the most aggressive. So the argument that I make is for prudential reasons, politically prudential reasons, 1 and 3, which is to say to vote, as in the Engine 1 case, as a shareholder for some shareholder who's got directors who may have a different agenda. And 3A, which is to say you have your guidelines and then you vote again in response to initiatives put forward by others, seem to me dominating 3B, which is the most aggressive form of action by asset managers. And I think the systematic stewards essentially should lead from behind. They make clear how they're prepared to vote on proposals put forward by others, but they should be exercising their power merely as voters. And in a sense, the Gilson-Gordon model here of the performance activism applies in the same way to potentiate asset manager voice as applied in the ESG setting. The activists will be presenting proposals if the asset managers think they satisfy their systematic assessments, then they can vote in favor of them and therefore determine the success as to how an Engine 1 type proposal will go. The final point I want to make is to rebut the common ownership critique, because I think that's very important. So the argument in general is that coordinated action by large common owners will raise price, reduce output, and what we see is classic antitrust harm and the reduction of consumer welfare. The irony, of course, is that the action by common owners acting out of systematic stewardship will also raise price, or could well, and may reduce output. Gasoline prices may go up as the supply goes down. And there can be other factors. But I think the crucial difference is the impact on consumer welfare and social welfare, which distinguish the two cases. So the point is reducing the risk of a systematic shock, reducing the risk of an economy-wide negative event will improve consumer welfare. In other words, by improving the performance of a diversified portfolio, you're also, by reducing systematic risk, getting better risk-adjusted returns for the portfolio, you're also improving the welfare of everyone. And why is that? Because the connection between portfolio values and the real economy. The damage to the portfolio values or the gain to the portfolio values are associated with damage or gain to the real economy, meaning the livelihood of everyone. So this is a case where collective action, even if you take the common ownership critique seriously, the fact is the impact of it will be to increase rather than to reduce social welfare, even for those who don't have any stake in the portfolio returns as shareholders. And so the claim is this is attacking this kind of interaction ought not be the objective of antitrust policy. There's a flip as well to the common ownership point. So given governance deficit and give the systematic threat, climate change, and which is an existential threat that governments are having trouble dealing with, we need every tool we've got. And the exercise of power by common owners is therefore a virtue, not a problem. So if, in fact, the asset managers and the large owners do have influence over these firms in ways governments do not, then the willingness to engage on the systematic dimension may make common ownership and the wielding of power of common owners a positive, not a negative. In other words, you need parties both with diversification to see the need to reduce systematic risk. They have vision on systematic risk precisely because of their broad diversification, and it's their heft as owners, massive owners, that gives them the power to promote systematic risk reduction. So there's a certain twist here that if you think particular systematic risk, climate change risk, are indeed existential and they come prior to worries about the effect on the airline ticket price, for example, then the things that become the potential source of criticism of common owners, in fact, become maybe the strongest case in their behalf. I'll stop there.
Thank you, Jeff. Jonathan Macy from Yale will comment. Hi, John. You're on mute.
There. Are my slides visible?
No.
No.
Oh, great. Okay. Try it now. Thanks, Jeff. How does this?
Yes, yes, perfect.
Oh, good. Okay. Okay, great. Now, I'm trying to, okay. So I really like this paper. It's really interesting. I have 3 kinds of overarching questions that I'm going to address during my remarks. Number 1 is what makes BlackRock and these other firms like State Street and Vanguard so special? 2 is there's an embedded assumption here that we can really distinguish a performance dissident shareholder like an Elliott Management, let's say, from an engine number 1. But I'm not sure we can do that other than by their claims or their reputation. And it'd be very easy for an Elliott to do exactly what engine number 1 did, as reasons I'll point out. And 2, where are the agency costs? It's pretty rare that I get outflanked on the libertarian right when I'm commenting on someone's paper, but Jeff has solidly outflanked me. Is it really the case that nobody at BlackRock, Vanguard, or State Street want a kind of want to have a kind of an easy life, if you will. So let me get started here. Very optimistic state of the world in this paper, so that companies are acting as though everybody's interests converge, and the world is going to be a happy place where the lion will lie down with the lamb. I love that. It's really a paean. Here's my first big question about the paper is it's a paean to these systemic stewards. The systemic stewards are BlackRock, Vanguard, and State Street. But suppose I'm a diversified shareholder myself, just little old me. It seems to me the theory that Jeff has would be that I'm going to act in the same way as BlackRock, Vanguard, and State Street. Or even if I'm non-diversified, I still have to walk around on this planet and worry about a social unrest. So aren't we all undiversified investors? In other words, I don't understand why in the model in this paper, the BlackRocks, Vanguards, and State Streets are acting any differently than a little old undiversified investor like myself. I want to say, so the goal of the paper is to understand, defend a remarkable event in corporate history. I want to look at this engine number 1 initiative and say, is it so hard to understand? Is it even remarkable? And why defend it? And no one's attacking it that I'm aware of. I don't know even, I guess I'd be more interested in knowing what the attack would be, which I can't figure out. But so I certainly agree that this was an interesting event. But what's remarkable to me is not the take that Jeff Gordon has. Jeff Gordon's take is, wow, we elected 3 directors to this 12-person board, excuse me. To me, what was remarkable is we elected these other guys. Like, what in the heck is going on here? The company lost $22 billion in 2020. It's gotten dropped from the S&P 500. Here's a chart of the share price performance. There's been a little bit of a kick lately attributable by everyone I've been able to read to the activist campaign. But this is, the red line is Exxon and the blue line is the S&P 500. If there were ever a poster child for an activist investor on purely shareholder wealth maximization grounds, I would think that Exxon would qualify. I totally get Jeff's point, and he's absolutely right. There's a lot of rhetoric in the campaign about what we care about stuff. But what I want to know is, I looked at Exxon's annual report. These guys are wildly share price performance compensated. They had even in the last 3 years these very significant efforts to motivate management through share allocations. This is not and there was no indication that I got that that we would have any change in that, or there could be at least any rewinding. Also, it's kind of a normal company, profit maximization. with respect to the S in the ESG, and I'll get to the G in the ESG in a minute, Exxon is expecting $200 million in charges for job cuts in 2021. They laid off 1/10 of its workforce, mostly in Europe, in order to produce cost cuts. This seems to be it is a kind of another general point that I have, which is that I think that Jeff is really maybe onto something with respect to the environmental part of ESG. I'm not sure that his model has as much predictive value with respect to the social part or the wealth and income disparity part that we know about. So there's, other than what engine number one said and the way that hopeful people glommed on to their rhetoric in the election, I'm not sure that we can really distinguish engine number one for even much on their rhetoric from a kind of shareholder wealth maximizing kind of model. They seem a little bit like your garden variety. I guess I call it value investor. Jeff referred to it as a performance investor. Same thing is they have a long-term commitment to cutting underproductive capital expenditures, increasing free cash flow, strengthening the balance sheet, securing the ability to cover its dividends. This is not, this is Warren Buffett talking. It's not Che Guevara, I guess I would kind of say here. Similarly, but what I want to turn to now in my last remaining few minutes here is Jeff Gordon is 100,000% right. Something is going on here. And I think one thing to focus on, what I would focus on is not necessarily so much BlackRock and Vanguard, but I would focus on the timing of this. People say, well, there's been other constituency statutes forever. There's nothing really new going on. I think Jeff Gordon is 100% right. There is something really important going on. The 2019 statement of the Business Roundtable really was a sea change. Those guys had been saying for decades, we're all about profit maximization. Now we care about ESG. So what is it? If we have a change, what is it that's caused this change? My view is we're in the midst of, and in a kind of a what I would call a pathetic but still undeniable libertarian turn. And the turn is not that we think the private sector is so great. It is that particularly if one looks at when this occurred in 2019, this big switch, we have a view that the old system didn't work. And something we have, and this is, I'm very, very interested in our non-US participants' take on this, but I would say from a US perspective of somebody who teaches corporate law, long there's been this kind of what I would describe as a not at my table kind of approach to corporate law teaching, which is I'm teaching corporate law, a student says to me, well, what about the environment? What about this massive inequality in wealth and income? And I'm saying, well, this is a corporations course. Those are great questions. You really need to take employment law if you're interested in that, or workers' rights, or take the class in environmental law. And corporations are out there, they're obeying the law, but we have this kind of rigid compartmentalization with respect to the issues that are at the fore of ESG investing. And what we see is that this compartmentalization doesn't work, that it doesn't work in a practical sense, that the government is going to step in and solve environmental problems, or the government's going to step in and deal with wealth and income inequality. So this is sort of a bastion of last resort in a way, the ESG turn, and it represents a kind of, in my view, desperate but hopeful attempt to decompartmentalize corporate decompartmentalized corporate boards. The other thing I would have to say is another issue with respect to why now is we have a great confluence of private interest, right? You've got management interest in the quiet life, turning off the intense focus of activist investors and others in share price performance and leading a happier, easier life, and the interests of course, environmentalists and the like in trying to deal with the environments. So another question I have, and I don't know what to make of this exactly. This is a small point really, but the model that we have of BlackRock and the others, Vanguard, State Street, it's kind of a no agency cost model. You know, these guys don't have any private interests. They're just maximizing the value, you know, lowering costs, and maximizing the value of a diversified portfolio. It could be that this is a way, and you know, so in terms of adding a little agency cost flavor to this, maybe the idea is that BlackRock, Vanguard, and State Street, by engaging in this kind of activism, are able to justify higher costs. So there may be a private interest element. Does not detract at all from what Jeff Gordon's point is. I think a very good point, because this kind of activism is not free, and if people are willing to pay for it, then they are. But I think time will tell as to how much they're willing to pay. But so the other thing is, there's some lessons about the way these people act that I think get a little bit of short shrift in this paper. And the story that I want to tell is during the 07-08 financial crisis, there's a lot of evidence that people at BlackRock and Vanguard and State Street, they realized that allocating space in their portfolio for highly rated by credit rating agencies, CDOs and residential mortgage-backed securities would give them higher returns, but the returns were really not as devoid of risk as the credit ratings seemed to indicate. And just as a matter of survival, fund managers had to flock into these inferior but highly rated securities because they were underperforming in the short term the portfolios of other investors who were more highly who had a higher percentage of their inventories in these other securities. So there is some evidence that even these big funds, not the fully diversified funds, but at least managed funds at places like Vanguard and the like, State Street are not, their Fidelity are subject to certain amounts of transaction cost and coordination problems. So I think, as I said before, I think that the argument is stronger as it relates to the environment than as it relates to social issues. And I'm not sure that the Vanguards and the BlackRocks are that, I don't know what the right term would be, but as free of agency cost as we might think that they are. So just by way of conclusion, I think that the recent success of the ESG movement is attributable to a confluence of private interest of management with a secular loss of confidence in the ability of government to address, much less to solve, these important problems of the day. And this loss has played it conveniently into the hands of corporate managers who wish to avoid accountability and have a little bit of a quieter life. I leave with an overarching question, which is, why can't I do as good a job as an individual diversified investor as the BlackRocks, Vanguards, and State Streets? But Jeff Gordon, thank you for a really interesting and provocative and important paper, and I look forward to the discussion.
So shall I respond to that before questions? Marianne, is that the way to? Yeah. A couple quick thoughts. The Exxon Mobil anecdote is not formally part of the paper. I was just being a little cute in a way. And I certainly agree that there are many performance-related reasons to shake up that board, but it was Engine One, and their pitch was not the Elliott pitch or the Starboard pitch, right? They want to transform ExxonMobil in a way that is driven by a climate change related view. So I don't think it's traditionally performance driven, and it could well be that BlackRock et al. Would have voted for Elliott management, but I do think it's motivated by their concern about wanting to strike a blow for what I'm regarding as this systematic risk of climate change, and ExxonMobil is a pretty strong symbol of that. The point you raise about the fate of the undiversifieds is I think a serious one, right? So, I mean, in general, there are two ways that a diversified investor or a portfolio investor can improve risk-adjusted returns, one of which is increasing expected returns across the portfolio or elements of the portfolio, and by reducing systematic risk. And so part of the reason that I think asset managers support the traditional performance-based activists is precisely not just that they think they're going to achieve anything, given the idiosyncratic elements of it, with regard to a specific firm's performance, but the governance externalities associated with the activist success, in the way that all firms in the portfolio are better governed, or have more of a shareholder focus, if you want to put it that way. So the undiversifieds already are at risk of a portfolio investor. The decision by BlackRock to have a uniform classified board rule, or a rule against it across the portfolio, is going to be bad for some undiversifieds who's in a firm where the best fit might involve a classified board. We've crossed that bridge. So the undiversifieds take the world as they find them, in a world in which the diversifieds are really king, I think. The point you make about the does this model work better for environment, particularly for climate change and for financial stability, than social risk? And I take the point, right? It's easy to get consensus that climate change is a systematic risk, that financial stability is a systematic risk. There's a theory by which some elements of social dislocation can be systematic, and that a party cares to reduce systematic risk might attend to it. But there's a lot of fact finding and slippage there, and I don't want to overclaim. And part of the point that I made is there a set of serious, wicked problems for which activism by these asset managers is in fact incentive compatible with their core business model, for which we could look to them for that, and without claiming that therefore there's, the full set of issues is going to be in any way addressed. And obviously the social dimension is one in which there's going to be a very substantial gap between what we might expect from a systematic steward and from what might be important social questions to take on.
Elizabeth?
Thanks. This is a fantastic paper. And I take the key point on systematic stewardship to focus on producing risk-adjusted returns by reducing systematic risk. My question relates a bit to the internal-external theme of the comments. And my question is whether the scope of your theory, Jeff, is only for how asset managers of index funds should respond to governance issues like voting on board elections and shareholder proposals and whatnot, or if it's actually can be understood as a broader way of understanding what many shareholders might want. For example, they might be agnostic about whether it's done through internal governance or external regulation, but your theory tells us that they want a reduction in things that produce systematic risk, like climate risk, social risks, financial stability. Or maybe they even prefer external rules of the game, because that would be cheaper, or would support laws that would do that to reduce systematic risk. But in their absence, or in their anticipation, like forward compliance, they want it done through governance to the extent possible, because that maximizes risk-adjusted returns at a low cost. So I wonder if you're setting it out in the narrow sense of the theory that we should use finance theory to understand how asset managers should use their governance rights, or if you would support understanding it as in the broader sense of the theory.
Yeah, no, that's a great question. Right. So Elizabeth's point is acting for their beneficiaries should BlackRock play a lobbying role. For example, you've got to address climate change risk with a carbon tax, right? And write letters. Or for financial stability risk, become a major player in what the Fed is doing on the implementation of Basel III. And because that's how you would really serve the interests of the beneficiaries, by picking the optimal set of rules, whether they be internal or external, that will have the effect of reducing systematic risk, right? I mean, that's your point. And here I think, you know, I'm driven back to consistent with their business model and what we can reasonably expect. Because I do think that insofar as they play an active role in the political process, they will become the target of attack. So there's leading from behind in a certain way. I do think the only thing we can legitimately expect of them is to play the internal role. And your point is well taken that that's second, third best relative to an external set of rules like carbon tax. But you know, I just don't think we can overclaim what the realistic possibility of these investors are going to be able to do in a sustainable way that, as I say, doesn't result in a massive attack that blows up their ability to act as the provider of low-cost diversified investment products for their beneficiaries.
Tobias?
Yeah, thanks, Jeff, for a very inspiring paper. Let me push you a little bit. I think I buy the basic incentive story that, you know, risk-oriented investors certainly care about these problems because they're systematic. I mean, the World Economic Forum, not exactly a bunch of sandal-wearing activists, is also listing 5 out of 10 most important risks to financial stability to be climate-related. So I think this is totally understood. But I think there's one aspect which makes portfolio investors potentially not the ideal candidates to push for a full greening of the economy, simply because macrofinance models, so integrated assessment models, teach us one thing: there's a trade-off between pushing for green investments or pursuing a green investment strategy on the one hand in order to reduce the systemic risks that you're talking about, and on the other hand, foregoing some of the diversification benefits that you can reap if you also invest in brown assets. And if you look at the time horizon that many of the asset managers are explicitly stating that they're pursuing, it's unclear whether over the next decade, green assets will automatically and systematically outperform brown ones. And therefore, I think this concern that there's a trade-off, which might not be present in John's individual investors who care about the environment. That I think is a realistic concern, which beyond everything that has been said is also worth considering.
So I mean, I take your question being, what do we think about an index fund that divests from brown investment? Right. You know,
I mean, not only that, also if you're pushing, all your portfolio firms to become greener, but there are some others that are still brown out there, then you have the same effect. But I think you got the point.
Yeah, the way I'd like to frame that, I was once chair of the Columbia Advisory Committee on Socially Responsible Investing, and John has a similar role at Yale. And we receive petitions for student divestment proposals all the time. And to my way of thinking, the ExxonMobil case shows why divestment is probably a bad idea. And it is precisely because voice is as ESG intermediaries now arise. There now is the occasion for the expression of institutional voice on that dimension in a very meaningful way. And my feeling is that the effect is not only in the potential to change the behavior of any single firm, but to change the politics within which these external decisions are made, to come back to Elizabeth's point. So I think one of the best carry-on effects of of what's happened at ExxonMobil, yeah, they may run their business better following John, but if they're going to be subject to a climate change sensitive regime all of a sudden, then their political foot dragging on this entire issue could well reverse. If we're going to have to play by the climate change sensitive rules, and by God, every competitor in this business is going to have to do that. And ExxonMobil is very powerful politically. So if you think that, firms that are now face a change are going to want level playing field, then all of a sudden the political environment in which resistance has been manifest may well change, because again, we're now bound, and so we're going to push for uniform rules for everybody, and so that to me changes the way to think about divestment, because it's not just are we sullying ourselves with returns on a brown asset? It's sort of how do we affect systematic change, and both we can vote now, it seems, to affect the behavior of individual firms, which in turn will have the political carryover that I think is necessary in this area. But the paper doesn't present a well-developed theory of what to do with brown versus green and this political story, but it's kind of what I'm thinking in response to your question.
I'll be collecting 2 questions at a time now. So Ernst and then John.
Yeah, quickly, basically following up on Tobias maybe, but your theory, Jeff, is, I think, deeply depressing. It may be the right theory, but it's deeply depressing, because what you're basically saying is that governments have failed to resolve problem number 1 globally, and now let's have it done by an investment fund. That is also showing where things go wrong, because it's not just about combating climate change. Climate change is a global risk that affects people very differently. And so it's a deeply political issue. There are people who are suffering potentially a lot in the next 30 years if climate change happens. There are others who are suffering a lot if we are combating climate change, and there's many people in between. So it's a political issue, which is about, in fact, the S component that Jonathan was emphasizing. And I also share Jonathan's view that BlackRock is probably worse at the S part than the E part. And so now you are saying, okay, we have the fortunate situation that we have a global risk, and investment funds are good at understanding risk, so let them take care of it. But it's a high price, which usually is paid by many others, and that's what politics should be about. So I think you should at least emphasize that politics plays a role, and that what you're suggesting as global stewardship has a very positive connotation. It's maybe just global loss limitation or something like that. So it's much more defensive than this very positive goal, I would think.
Positive, negative depends on the baseline of what your prior expectations were, I guess.
Yes. Getting more pessimistic by the hour.
Yeah, right. Well, so one way to think of this is opening well, remember, I don't see these funds as first actors. They are responsive to proposals put forth by others. So let's take certain social proposals, right? So one could imagine that if a social activist fund presented a proposal that or there are two dimensions, right? One of which is the proposal by the social fund, the activist fund, which could present a case that mitigating that there's a particular systematic risk in the way this firm did business with respect to employees. And, then the persuaded systematic steward might vote in favor of it and affect a change that otherwise wouldn't happen. And furthermore, it could be that managers inspired by their internal ethics or push from their own employees might behave in what you would regard as a pro-social way. If there's a contest by an activist on performance grounds, then insofar as this appeal to systematic elements, then the fund can vote in favor of management. But look, I mean, this was offered as a happier alternative to the rather grim discussion between Ron and Lucian earlier, in which governments were completely frozen and there's nothing to be done. My point is that there's an actor with potential power who at least is concerned about a certain set of very important risks, and who would find it, this is the claim, understood in its interest to act, to be receptive to and act in favor of the mitigation of those risks, and that in turn, here the climate change point, could have a positive catalytic effect on politics, which is frozen because some of the actors here see no reason to resist, change their obdurate behavior. If the shareholders force them to, then they themselves may play a different role politically. So I see it not as, as more optimism than less. And it's as I say, it's not a nirvana prescription, but it is a definite way in which you think funds that have a purely economic interest can nevertheless play a positive role in the addressing of serious global social and climate problems, for which at the moment we don't really have a great set of tools.
I was just quickly going to say, in a way, this is like we're looking at the steamship Earth and it's foundering, and Jeff is saying, there's some life rafts out there, and maybe we should take a look at that and see how far we can get on those life rafts, because certainly. So in that way, I'm sort of on team Jeff Gordon, that this is kind of an optimistic way of looking at things. I had a couple of quick questions, Jeff. I don't know if there'll be time to answer, but we can talk later. But one is, of course, the portfolio model you're looking at looks at risk-adjusted returns. The Enron case is sort of a happy case where we're reducing risk and increasing returns. So it's kind of a no-brainer, but won't there be a lot of kind of marginal cases where we're reducing risk, but we're also reducing returns?
Yeah.
And, sort of the outcome of the model becomes a little bit trickier. The other thing is, and this is, I've come around to your way of thinking a lot in this comment session, thinking that one thing that these BlackRock vanguards are doing is they're taking a situation where you might have a management that's highly on a path-dependent managerial course. They have a lot of human capital in a particular managerial strategy, which is, dig for oil and stuff like that. And this is a way of breaking that log jam in a very important way. So that's something that occurred to me during the question and answer that I think is in a way helpful to your project. So thank you.
Right. Yeah.
Jeff, if I may, I would like to have the last questions since we are running out of time. So Marco and then Chris Havazi.
Yeah, this is just a quick comment on what Elu said. I mean, let's not forget that we have lived through a time where leading politicians said my country first, and there are still politicians who say this. And in that sense, globally diversified investors who care about the future of the planet, because that's their financial interest in addition to their ethics. I mean, that actually sounds pretty good. Now, it might be depressing that we need investors to care more about the future of the planet than some of our elected politicians. But maybe there might be a positive feedback loop here, and then these people who care about the planet because they invest in the planet, that they actually might influence having governments elected that also care about the planet. That's at least, maybe the hopeful scenario.
Chris?
Oh yeah, thank you. Yeah, this is kind of dancing around similar themes to what Jonathan and Elizabeth have been asking about. And I was just curious that there seems to be kind of an underlying theory about the proper scope of action for the systematic stewards here. So for example, in the paper, you talk about the importance of reducing social instability to systematic stewards, but then you narrow it to only social instability caused by financial instability. And so it seems to me intuitively that the systematic steward would care about almost any source of social instability that could affect financial markets, as opposed to only the ones caused by financial sources themselves. And so I was wondering if this paradoxically would lead to a situation where financial stewards might move broadly into both public sector and private sector lobbying, because basically all studies show how effective it is in terms of increasing returns per dollar spent on lobbying.
I meant to say that the social dimension was not limited to financial instability. That is to say, one could imagine, I mean, indeed, the whole setup of modern portfolio theory, I think entails a major risk shift. And I've elsewhere argued that this calls for new form of social insurance to match the private sector element here, but insofar as one could identify, I mean, so suppose a smaller version of Google is challenged for building housing for its employees or for the community, then a systematic steward could well decide to defend that management or vote in favor of it against the challenge that, hey, you're burning shareholder money here. So I don't mean to limit it to the financial stability case. And your point about, the leverage effect of money spent in politics, that's a version of Elizabeth's point, which could well be true. But my concern is the sustainability of a politically active BlackRock over time. Just because I think once you inject yourself in a very point of the spear way in politics, you put a $1 trillion business at risk. So that's again part of why this is there's a positive here, but it's limited, and we I don't think can expect these funds to be at the vanguard. But the happy part of it is that there may, and this picks up the point we've been discussing earlier about, the millennials and the Gen Zs having a different set of objectives. And, Michal Berzuz's paper about funds marketing themselves appealing to those groups. Well, those funds can put issues on the shareholder agenda and begin to shape a discourse in which the systematic elements associated with their proposals become more salient and get more reflection, and perhaps become, a basis for consensus that this is a reason why they ought to be adopted. So it's to open a space for a different understanding of the way that institutional investors can play a role without thinking that they're going to be really at the vanguard. As I said, they're going to lead from behind. And part of the role of others is to help frame a structure within which they are the majoritarian owners. And but they have to be persuaded. And so, there is a space here, I think, on this dimension that they could be persuaded. Thank you for the comments. I appreciate it.
I would say thank Jeff and Nadia for a terrific panel. This was a terrific conference. And so I'll now call Henry Hansman for his final remarks.
Henry, you're on mute.
The constant injunction here, unmute your mic. So I want to say that this moment brings the end of our formal portions of our 3 days of conferences here. And on behalf of Yale University and the Yale Law School, I want to thank all of you for this year's, and all of you who participated this year, for submitting papers, for commenting on those papers, for chairing sessions, for refereeing, and for submitting those papers to begin with, and for moderating the various sessions. I also want to thank the two other sponsoring organizations again, the ECGI and its affiliate, the GCGC. Of course, everybody who's had anything to do with ECGI and GCGC knows that they're essentially front organizations for a single person, Elaine McPartlin, who actually organizes and runs these meetings all by herself. And she generously lets the rest of us indulge in the pleasant fantasy that we're actually doing something useful. So for that, she deserves very special recognition. So I thank you all, and I look forward to seeing you again next year in June in Oxford, where I hope we'll meet in the flesh and not just virtually. Enjoy yourselves until then, and be well.
And I'll just ask Tobias maybe to say a few final words.
I'm happy to do that. I mean, we've had 3 welcome addresses, which is too many. Now we have 2 goodbye statements, which is also too many, but let me keep it to the minimum and just add one thing. So first of all, thank, of course, Henry and his team at Yale for putting together this great 2 conferences, which were definitely a success. I've said that before, but now we have robust empirical evidence that it's really the case. And the second thing is, in addition, I want to qualify some of the thanks that Henry has just said, because Elaine is great. We all know that. Marco is great. We all know that. But they're not exactly alone. There's also Noreen Khan and Vanessa Paget, who have been working tirelessly in the back, and they've been done all the dirty work of putting together guest lists, collecting papers, promoting, tweeting, preparing videos at the scene. Maybe not that great for all of us, but anyway. So the thing is, there are some more people that we have to thank wholeheartedly. And then again, I also hope to see you again in person at Oxford next year. 3rd and 4th of June are the set dates. Thanks and stay healthy.
Thank you.
There's a place we meet afterwards, right? That's in the link if we want to.
That's right. There's a link in the chat, and you can click on that and even go there. And it's also, it was sent to you by email if you lose it in the chat or if you can't find it, but you can copy and paste it.
Okay. Sorry then. Thanks.
Thank you. Have a good night, everyone.
Bye-bye now.